interested than most people, by the way, in the balance sheet.
I think that Kevin's a brilliant guy, and I think that we'd all be very lucky to have him.
Kevin is very talented, but I don't know if it's going to be him, but he's a very talented guy.
So you're here tomorrow to ring the bell. Congratulations, man. You have done so much. 1.8 million YouTube viewers. People love you. People look up to you.
13 years ago, I stood over there looking at this very door, wondering what it would be like on the inside. Now, I have my name on the New York Stock Exchange badge, and I can go inside. I took my enthusiasm for the market and money and started learning everything I could about real estate. I would be the most transparent governor that would exist, and you'd have my commentary every single day. I became a licensed financial advisor.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Always great to have you on. Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
It is time to introduce the company. Introducing
Reinvest.
Invest at Scale. Welcome back to another Market Open live stream. We got the green Luigi mug today, which is hopefully optimistic that the market will go up after this week. I do think we have a little crap to deal with this week. Quite a bit. Bessent, Iran. We've got, what's going to happen with the treasury market? What's going to happen with NVIDIA earnings? A bunch of earnings this week. There's a lot. This week has like the weight of the world on its shoulders. End of month coming up. It's not quarter end, but end of month. So there's a lot. And I think that's, it doesn't help that Samsung was down as much as it was in the Korean market. So a lot of people are going to be looking at the memory sector today to see what ends up happening with our pricing over here. I do think there are, we'll go through a good bit of memory research here today, but I think a lot of folks have to remember that the market is often driven by expectations. And so what did we have with Samsung? Samsung announced their quote-unquote shareholder return plan. They announced it Friday after the market closed. And it was a program that is promising like 90 to 111 trillion of Korean dallahalas going back. And that just wasn't enough for the market. The market was expecting a bigger buyback and bigger return plan than they had in mind. So look at this, Samsung down 8.7%. That's quite a lot. That's a big move in a day. Now, obviously, memory stocks have been doing very well. So we're not back at the Leopold, full margin, all-in debt levels of June and July. But, the stock's still up 259% over the last year, which is freaking awesome. But, now the question is, are we getting visibility potentially into price decreases? The second derivative turning negative. And if the second derivative turns negative on pricing growth and they're not buying back as much as expected, what does that mean for a company like Micron, who's obviously expecting a significant buyback? A lot of people are expecting big buybacks here, mostly because the executives are like, oh yeah, we're going to return so much capital to shareholders. Yeah, that's great. Cool, that sounds wonderful. But then you get UBS that comes out, and UBS is like, oh yeah, we're going to return like, I don't know, how does 40% of the company, we're going to buy back potentially 40% of the company sound? That's great. That helps. Thanks, UBS. But does that actually end up driving reality? If Micron comes out and says, oh yeah, we're going to do a buyback, and it's only 10%, right? Oh, that's disappointing. Thank you so much, One Grateful, for the $10 donation. Appreciate that. So, welcome. Let's do a little bit of a pre-market check-in here. The first thing I want to do regularly beyond what we've obviously already sent out in our Alpha report. Of course, remember Alpha report. Many of you have already read through that, and I think that's very important for this next week. It's going to be very interesting to watch what happens with this spread between the 10 and the 2. The 10 and the 2 is exactly what Bessent is trying to manipulate. And so if you look, you could see the 10 years down 2 bips and the 30 years down more at 3.5, the 2 years flat. That's exactly what Bessent is trying to engineer. And so the more you see this unwind, which you could just really track via the 10-2, the more you see it unwind, the more you basically see Bessent's credibility and capabilities failing. Sort of like the emperor wears no clothing, right? So it's unfortunate because, unfortunately, we do have this big expectation that, the government can be there to paper over problems, whether it's the government, the Fed, or both of them combined. And these latest interventions kind of make you realize, like, oh, crap, there's a limit to what they can do. And then you go back and look at Kevin Warsh's history. We've broken it down before on the channel, but I mean, just to give you a little preview, back in 2008, when everything was going to, HE double hockey sticks, Mr. Warsh was a proponent of raising interest rates, going into a crash. And then everything hit the fan, Lehman Brothers, things went horrible. And most of the people on the Federal Reserve Board of Governors say, no, we need to run the money printer. We need to bail these companies out. Now, obviously, some free marketists say, no, just let it all collapse. But Kevin Warsh wasn't in there of the mindset of, no, let it all collapse. He was worried that they needed to control inflation. And so he's like, no, we need to raise rates because inflation's going to go crazy. And he was totally wrong. Inflation went down. We were almost facing deflation. So, and if it weren't for the money printing, we would have had deflation. A lot of deflation. So it's kind of crazy. And so that's the person that we kind of have as our security guard right now. So his credibility from 2008 sucks. And it doesn't help that Bessent is now falling on his own sword or tripping on his own sword. It's like a clown show. It's like, you get this like, oh, these are your new emperors. And they come out with their gladiator swords. And then, Kevin Warsh is like, hey, guys, you see all these scars I have? Guess how I got them? And then Bessent is like, watch me use my sword. My arm. Like, that's the clown show that's protecting the government right now from, a really bad market recession. So if you have any lack of faith in the government, it should probably be even more lacking now. In other words, you should have less faith now than you did previously. That's not great. But anyway, we'll see what happens. So, I think this is an interesting line coming through here. Look at this. This is in the Alpha Wire. Dave & Buster's strengthens executive team leadership to support growth. I think they're trying to pull a Red Robin here because Red Robin's business financials have been terrible, but the stock has actually come up quite a bit recently. And part of it is, in my opinion, because not only did they get some more bailout financing, but they've also rejiggered their executive staff. And if Dave & Buster's just trying to do that as well, then I'm going to pin that. So I'll pin that in the Alpha Wire. Red Robin got bailout financing and rebuilt their executive team right before the stock doubled, from bottom even more. The fundamentals of the business haven't been that great. I don't know what they've been very recently, but people get excited about turnarounds. So, keep an eye on it. So we'll pin that. So what's kind of cool is when we pin in the Alpha Wire in your app, in the Meet Kevin app, it'll come through like this. So it'll be pinned up there. And you could use that in the Meet Kevin app. Meet Kevin app's free right now, so you're welcome to to use that as much as you want. I just keep it up, you know. The only thing I wish I had on the iPad, the desktop has it, but the only thing I really want on the iPad is the auto refresh. So I don't have to kind of pull down to refresh, but that's coming. All right, so let's see here. We've got the Qs that are down about 0.5%. We have a lot of weight on markets today. The thing to really watch today is what's going to happen at open with companies like SanDisk, SK Hynix, and Micron. So those are going to be fun to watch right at open. So we got the bell in about a minute. We'll see what happens with these. And beyond these, overall, we just got to get through this week. We got to get through Iran sanctions. We've got to get through Jackson Hole. Of course, we'll be covering that. We got to get through the, whatever, sanctions plan Scott Bessent comes up with, which he wrote a piece in the Financial Times that was very unenlightening. He didn't actually really have much to say, which is also a little bit disappointing because it's like, well, we want a little more color here. Yeah, no. Oh, and then, of course, you've got the Canadian trade war. That's not fantastic either. But, I mean, the Canadians, politically, I should check their elections calendar, but politically, there's a lot of desire to really, stick it to Trump. Yeah, they're tired of this nonsense back and forth as one of our close allies. So, anyway, let's get the bell.
You have to decide who's hurt because they sell in Canada, who's hurt because they build in Canada. If you want to do build in Canada, Jim Foley has said over and over to me, we are hurt. We're hurt for us. Canada and Mexico. Right. So that's the one you would buy if you're worried about what will happen.
All right, we'll come back to this a bit more. Let's get to the opening bells. You just heard it there. Of course, here are the big
Man, that is low
United
energy.
States Tennis Association celebrating this year's U.S. Open Tennis Championships over at the NASDAQ in Times
How are
Square.
those U.S. Open people so boring? We need some more energy at the bell. Man, we rang the bell. We hammered the crap out of that bell. Yeah. Anyway. You don't really hit the bell. You hit this little thing with the gavel, and you push a button for the bell. Anyway. All right, so SanDisk, we can see it here. It's pulling the Samsung, at least first minute. Oh, wow, dude. The Q's just dunked at the open. Hopefully it's just open selling. This is why I always like to say, give the market a good 5 minutes of stability before you get too freaked out by the market's behavior. Because you got to think institutions, they put their trading plans in over the weekend, after hours on Friday, in the morning hours of Monday. And right when the market opens, that's when you've got what's called liquidity. And so the pre-market can really be a misnomer. It could be way too high. It could be way too low. And so when you get the real trades that start clearing at market open, that's actually, I think, you got to let that volatility settle for the first 5 to 10 minutes or so. Which is actually exactly why companies, a lot of people are like, oh, but it's going to be so great. We're going to have extended market hours. We'll be able to trade more hours in the future. NASDAQ will have another window that you could trade in. Maybe we'll have 24/7 trading one day. You realize 24/7 trading, guess who that makes more money for? Does that make you more money, or does that make the market makers more money? You don't even have to understand the mechanism of how the stock market works to know the answer to that one. It's the jaded one. It's the suits want the market open longer, so you have thinner liquidity because the liquidity is now spread out over more days. And what does thinner liquidity mean? Wider spreads. What do wider spreads mean? More money in the pockets of the suits, which is great for a company like Citadel, rebates for Robinhood, and the brokers could actually be a little bit higher. But it's bad for you. It means worse spreads on your option. I didn't even know spreads could get worse on your options. Yeah. Worse option spreads and, unfortunately, worse actual stock spreads too. So it's I don't think the most ideal, but whatever. People get really excited about it. People have also been very, very excited about Bloom Energy. This one has really been retracing down a lot, and they have very, large turbines. I'm just kidding. They don't have turbines. They're actually a fuel cell play. And they have pretty good pricing power on those fuel cells because you can set them up in like 3 to 4 months, substantially faster than you can set up natural gas turbines. And I don't really understand fully how it works, but I think it's very fascinating that you could basically chemically turn natural gas into energy without just lighting it on fire, which seems kind of cool. Anyway, that's been a big data center component because, hey, I could stand up a data center way faster. It takes years to build your very own natural gas facility, let alone to get the permitting for it. It's crazy. So we'll see. Look at this. We're getting a little bit of a discount here on Palantir. Palantir's had one heck of a run. Now down about 4%. Given a little bit of a give back here. We do have a support line at 164 we'll be paying attention to. We do have a price target on the Qs for this next week here, and let's just put it this way, this in our course member live streams, which of course you could be a part of over at meetkevin.com. The price target is lower than where we sit right now. But we actually are chalking this up to an opportunity. We expect a lot of volatility this week. We've been talking about this for a while. Since we hit 735 on the Qs, like, look, we've got a price target, and it's down from here. And so far, we are down 29 points since our, unfortunately, short-term bearish price target on the Qs. And that wasn't to be a bear. We actually see it as a buy the dip opportunity, but it's just because of all the bull crap we have to deal with. Worsening Iran, Treasury Secretary Bessent wears no clothes, Emperor wears no clothes reference, and Jackson Hole with Kevin Warsh, who's so far like the thing, because historically he has such a lack of credibility, and because Bessent is now losing credibility, you actually unfortunately increase the risk of him having to do something to build credibility because he doesn't have any. So the Warsh credibility is a hawkish risk. I don't like that. All right, what else is going on? So let's just scroll around here and see what else we've got cooking. So we got Robinhood. Robinhood had a little bit of enthusiasm last week. A lot of this is coming off of the back of the crypto rally because the profit made on crypto is somewhere about, or at least the revenue, is somewhere around 10x the revenue that Robinhood makes off of actual stock buying and selling. They make very, very little money on just buying and selling. Okay, so then you've got Moderna coming down again a little bit here, another 8%. There is a lot of trading volume in this. So it's not uncommon to see some of this juice come out. This is a very, very normal kind of post-enthusiasm bleed out. And I'm very curious to see if it stabilizes at 126 or if it keeps going down. Could be some opportunities there. Obviously, the company still loses money, but massive hope. And it's not really a cancer vaccine. I know people call it a cancer vaccine, but it's more of a cancer therapy that they're working on, which is also very important. In fact, while a vaccine would be cool, I think this is more of a first stage. So software's trying to hold on a little better than hardware today. Most hardware stocks seem to be really taking an L right now. Here's Intel also moving down. Really peaking out here. Look at that. Wow, peaked out at 142. You're almost down 50% on Intel from peak. It just shows you some of the pain that happens with leverage. You should be, in my opinion, in a place where you're looking at your portfolio going, wait, I have a portfolio? I don't even look at it. If you look at your portfolio every single day and you're like, oh man, I just lost X $1,000 or I just made X $1,000, I'll tell you, that is like the worst psychological thing you could ever do, because you will feel like a king when your portfolio is thick and green. And what it does is it breeds laziness and overconfidence. Two of the worst things to have in the market. Then you leverage up more, you go balls deep when you shouldn't, and vice versa. I see this on mostly on social media that I hate it, and so I barely try to look at it. But, you know, you'll go on, like, I don't know, Threads or X or Reddit or whatever, and people are, oh my God, why the F is Samsung down 9%? Can someone explain it to me like I'm 8? And I'm like, okay. First of all, tell me without telling me you are way overexposed to a single stock. If you wake up and go, what? Why the F is this stock down? You got too much. You got too much. So, you know, that's not a good place to be. I think a great place to be is you're like, oh, what? That stock's down? Oh, I didn't even know, because you're not trying to look at your portfolio today. Oh, that stock's up? Oh, I didn't even know. So it just creates too much emotion. Okay, so what do we have here? We've got 10-2. The spread's still at 47. Just kind of watching this. I'm very curious to see how this ends up playing out. But then again, we still have the Bessent meeting coming up. So we'll see. We'll also watch the Alpha Wire to see what ends up coming through. Also, just getting a note now. Trump build in the U.S. and there are 0 tariffs. And then... yeah, it's interesting. Okay. So, tariffs on all cars, trucks, both large, small, automobile parts, steel will be increased to 50%. It says all cars. That's interesting. So, something Trump really wants to zero in on. It's just, the thing is, it's not profitable to build in the U.S. I'm sorry. As much as I want to, you know, promote the American worker and you know, really showcase, hey, buy America, we're going all in. It's just more expensive. Part of it is because we have a lot of worker laws and taxes and I mean, they are protections. Let's not be, you know, let's not mislead the fact here that worker protections are a good thing. But as a result, from a capitalistic point of view, it's way more expensive to do business in America, especially with how litigious things are in America, especially some of the more litigious states. And the issue with that, unfortunately, is it's way cheaper to build cars in China or in Mexico or somewhere else. And frankly, if we all drove Chinese cars, they would be way cheaper and probably just as good. I think that's coming. I think in the future we'll all be driving Chinese cars, and we'll all actually be saving money. Like, would I rather go buy? You know, I just saw somebody on you know, I think it was on Reddit. I don't even know why it was on there, but it was on Reddit, and somebody's like, "Oh, I'm gonna help my dad co-sign because he's on Social Security. He's gonna get a loan for 1.9% on a $40,000 Subaru Forester." And I'm thinking to myself, do you really need a $40,000 car? Is the better answer not, oh my gosh, I get 1.9% in a day, you know, at a time when interest rates are 7%. Isn't the better answer, wait, I can not take on that debt and get a used car for 15 grand. That's pretty good. I wonder what used Teslas are going for now. Anyway, I'll look really quick. But Bitcoin, by the way, on its way to our $80,100 price target. It keeps moving closer to that, which is pretty cool. We've been talking about that in our Alpha membership as well. So Bitcoin's in there as well. Let's go look at ordering a Model 3, and let's see what their existing inventory is. I'm just very curious. So I also don't know where the existing inventory sits. Do they just show you new, or... They keep changing around the website. That's the order now page. I don't think you need to pay $40,000 for a new one when... oh, there it is. Certified pre-owned inventory. Model 3 within 200 miles of 93004. So this puppy's got 52,000 miles. That's a lot. 1 month of FSD. That's boring. Some of these are... there's actually... That's the all-wheel drive. You know, from 40K, that's not as much of a discount as I would have expected. I would have expected more of a discount on some of these Model 3s on the used side. So that's with 50,000 miles, $28,000 for a performance all-wheel. So if I were to order a performance Oh, wow. They're 47 grand now? Well, I mean, that's still like a $20,000 discount for 50,000 miles. Huh. Yeah, I mean, that's a pretty good discount, though. Anyway, okay. I just wish the FSD were included. Oh, well, you're gonna get a used one. Hey guys, we've got FSD purchased on all the Teslas that we have, and I mean, it's so wonderful. We're such big fans. Okay, Qs are now falling off a cliff even more, baby. That Samsung sell-off is really pissing everybody off. Damn! What is going on here? Well, it's... You know, another thing you see, check Car Gurus, way better deals there. Oh, okay, well, that's a good recommendation. I have to admit, I'm not very well versed in cars, so thank you for pointing that out. Okay. That's why, like, I remember when I was learning, probably one of the hardest things for me, and you know, I managed. I think very well. I think my flight training days were really good, and I learned so much. I really enjoyed it. But you know, when I became not only a licensed pilot, an instrument pilot, multi-engine pilot, and then a jet pilot, I think probably the hardest stuff for me was being able to regurgitate to you how like the turbine engine works. You know, like, oh, all right. Bleed air and, you know, all this nonsense. It's pretty impressive. And I think it's remarkable and wonderful, but mechanics are not my strongest. So, anyway, it's very interesting. All right, so where are we? You'll notice Salesforce and software actually still holding up over here, despite this memory sell-off over here. IGV had a glorious bounce at 101. IGV is heavily exposed, though, to Palantir and Cyber. So I don't personally invest in IGV, but I do like using this as a little bit of a software proxy. 101 is a pretty regular bounce level. Look at this, 101, 101, 101. That's in the last 3 days on the 5-minute chart here. Multiple bounces on 101. Zoom out on the 1 day, and you've got, this is a retracement line, which we've got some areas to justify 101. But again, very heavily exposed to cybersecurity, which has been on the pricey side. It's come down a little bit the last few days. You could see the retracements come down a little bit. We've been, you know, one heck of an uptrend here on cyber. And CrowdStrike, you know, same thing. This uptrend has slowed a little bit. Now, this should stabilize. Let's take a look at this. Let's draw some gray lines on these puppies. And let's see what we have here. Yeah, so this is a, you know, decent uptrend, a little bit of what you're seeing at Salesforce. Salesforce, you know, you had this as a downtrend, and this is the uptrend that we've really been riding right here. It's been perfect. We've had this line drawn since probably about early July. We've been watching this uptrend start and buying it, right? We've been buying Salesforce since about the 160 range. So remember, if you're a course member, you get to buy trade alerts as well. Well, yeah, any trade alerts. Okay, CrowdStrike, Cloudflare, and SentinelOne they've all been kind of coming down off their top in just the last maybe 6 days. And IGV is heavily exposed to cyber. So something to keep an eye on. Another one to watch is take a look at Netflix. Netflix, I think, bottomed at like, yeah, 65. I was going to say mid-60s, like 67 or something like that. Look at this, though. This is very, very similar to Salesforce. So look at Salesforce again right here. See this downtrend right here, this downtrending channel? And then now we're getting the bottom, right? The Q3, Q4 software bottom. Let's go, right? Let's go. And what do we have right here on Netflix? Look how similar. Downtrend, and here's that uptrend starting. That's very clean. Very nice. So then somebody here says, super funny, SanDisk like 200 down, volume kind of low. What's down with SanDisk? So I highly encourage people watch my really long video on SanDisk if you're an investor or exposed to SanDisk. I think I have like a 50-something minute video on SanDisk. It was really long and really exhausting to make, but I think extremely useful. And so I would keep an eye on this and some of the components into SanDisk. The most important thing when it comes to memory stocks, which we'll be talking about shortly as well, we've got some memory stock research to go through. One of the most important things that you have to remember with memory stocks and bit storage is really the market has most to do not with how sold out they are or not with how great pricing has been. It has most to do with the expectations of the future and how long it can last. Anytime you get a rugging of expectations, that's when you unfortunately get disappointment. So again, let me see here. I got to convert this 90 to $100 trillion won to dollars. Okay, let me pull that up. I'll just take a second. Okay, so we'll pull that up. And that'll lead into some of our memory talk. But I want to see that expectation versus reality a little bit more clearly. I know the buyback was less than expected. But what we should do is to lead into that, we should pull up the Micron UBS 40% buyback expectation. Because it was a UBS call. And yeah, here. Yahoo is reporting it. This was like a month ago, right? But that went viral. You know, people went crazy over this prediction. Okay. UBS. This looks like this must be an op-ed. But anyway, where is the UBS piece? UBS here. A UBS analyst forecast the company could generate as much as $400 billion in free cash flow through the end of 2028. That amount of money, especially for a business like Micron, has had its fair share of downturns in the past. It's staggering. The analyst believes the company could retire as much as 40% of its outstanding shares with that money. Okay, so I'm actually curious what else they're saying, but historically, you know, the companies want to hedge for a future downfall or slowdown in pricing. And so whether they keep more money for plant, property, and equipment and the expansion that they're doing and the actual build out, or they just save money for a rainy day after retiring debt, you know, that tends to take more capital than people like. So what happened with Samsung? So Samsung also missed on earnings per share. They missed on revenue by about 0.25%. So very nominal actually there. They missed on earnings per share by 1.77%. So a little bit more. Does that really justify a 9% sell-off? No. But they also had their shareholder plan that they revealed. Just leave the cues right here for a moment. Pull this up. Okay. So the shareholder plan, I got to turn this into dollars. The midpoint's 100 trillion won. That works out to about $72 billion is roughly what that works out to. Okay. Yeah, we keep dumping here. We are heading straight to the price target we said in the course member alpha reports, which we've been warning since 7:35. So in the short term, should be no surprise. Okay, let's see here. Got it. So there were expectations that Samsung would return as much as 200 trillion won. So they came in at 100 trillion. They came in at literally to the dime, the lowest possible end. I appreciate that video you made, Kevin. Oh, well, thank you. Appreciate that. I mean, look at Ubiquity. Ubiquity is going to get caught up, I think, in sort of the hardware madness, and it's a very low volume stock. You know, it doesn't get a lot of attention. It has a, very, very tight ownership concentration, and so when they go to sell, it really hurts the stock fast. But it's a fantastic company with massive pricing power, and they will be at the forefront of artificial intelligence in prosumer, whether it's camera security, networking equipment, or otherwise. I really like Ubiquiti. Anyway, so they were expecting as much as a $200 trillion package. At least 140 was a regular expectation. Yeah, and the returns they announced were really closer to 90 to 110 if you include some dividends, maybe closer to 104 to 110. Barclays had increased its buyback expectations. Let's see. Okay, so let's see here. JP Morgan, dividend, okay. Dividend-heavy structure was key to the disappointment. Investors wanted a larger, more immediate buyback. Oh, that's really interesting. Let me see, there's a whole article on this. Okay, it says here, it remains unclear why Samsung management team chose a dividend over a buyback, as we believe many investors prefer the buyback as a more effective option. Right, well, because they want to see the stock get pumped up. But honestly, it might be a little bit of a signal that Samsung thinks the stock is too expensive, right? That's possible. Because if you're buying back your own stock, oh, I bet you that's exactly what it is. Just think about this logically for a moment. Okay, let's say you run, an ice cream stall, and your stock's trading for $1,000, and you're looking at the financials going, $1,000. That's nice for this stock. I know the books. This puppy's worth like $500 on a good day. And then it's trading for $1,000. People are like, hey, you should do buybacks. It's like, yeah, we'll return some shareholder capital, but let's just do some dividends. Why? Because if it goes back to $500, if you bought the share back, now you've got an L, right? So I that's kind of interesting. So let me pull this. Okay, let me get this now. Okay, let me pull this. So, okay, that's the JP Morgan piece. Cash dividends were prioritized over share cancellation. This is a quote coming from, who is this? NH Investment Securities. Okay, NH Investment Securities. Cash dividends were prioritized over share cancellation to prevent Samsung Life Insurance and Samsung Fire and Marine Insurance from exceeding 10% ownership. A threshold for, oh, interesting, non-financial affiliates. Okay, so some of it had to do with mechanics as well. That's interesting. Samsung Life owns an 8.5% stake in Samsung Electronics. Okay, so there's a little bit of that as well. So like a regulatory structure. But that could also be cover. Okay. All right, interesting. So that's now weighing on our market. Kevin, just looking to get your input on tax lien investing. I hear that all the time. The thing about real estate is there's no magic bullet in terms of where the deal is. I actually find most of the best deals are, properly priced listings, even if they get multiple offers, that are fixer-uppers that come up on the MLS. But yeah, I mean, we look at them too. The problem is a lot of the auctions, whether it's through tax liens or otherwise, they are competitive, and you have to be careful not to overpay. So I see a lot of people get really excited. Oh, well, trustee sale, it's going to be a better deal, cash only. A lot of people go into these and they get hyped up on the auctions and they end up overpaying. So you have to treat every single real estate deal you look at as what it is. It's got to pencil out, and if it doesn't, you don't touch it. So expectations, regulatory outlook, that hits Samsung. Let's get a little bit more color, though, on Micron. And so I've got a little bit of research on my iPad here that I've got to beam over from this weekend. And I find it very interesting because there's a lot on the memory sector that we could look at. So, memory. By the way, shout out to anybody who's been playing Mecha Chameleon. I've been playing that with Jack and Max. It's freaking hilarious. Okay, so this was the Nomura research piece. Let me pull this up because it was really good. Okay, so we're going to pull this up. Okay, we got that. That'll just take a second to pull the rest of. That's the memory. Okay, we'll start with that. That'll be good. I don't want it to be too overwhelming. Sometimes I have so much research that if I put it all into like one segment, it ends up being like a 2-hour video, and then I just like delete the video and start over. It's like, no, it's usually like 20 minutes, man. Like my own attention span isn't strong enough to withstand too long of content. So let's see here. All right, did we get this pumped in here correctly? Yes. But it's honestly out of order. Why? Why, Apple? The file names are literally in order, and you gotta open the documents in a crazy order. It doesn't make sense. It's all right. Whatever. Doesn't so much matter. Okay, let's pop these open and go through some of these because they're really exciting. Okay, so this is the memory piece. Pull this up here. Where is the first page? As soon as I can find the first page, I can go through it. That's pretty good. Okay. Got it. And now I just need a little arrow tool, and then we'll be able to go through this memory piece. It'll be really fun. Okay. There's a lot of really good color, I think, on this. You'll like it. And it took me forever to go through as well. Which I actually like. Like, I'll sit down with a cup of coffee in my moss garden, and we'll really crank out some good reading. There's nothing like a good moss garden. I hope you have a good moss garden. Okay, so, okay, that's just, I was just watching CNBC. They're just talking, they've literally had the same spiel over and over. They could use the TGA to buy back bonds. Yes, we know. We know. All right, let's talk about memory. Okay. Memory stocks are getting hit hard, and they're taking the NASDAQ 100 down with it. Part of the reason that led to this 8.9% sell-off in Samsung stock has to do with expectations versus reality, but a whole nother piece, in my opinion, has to do with the industry and the suits starting to talk about this. A shortage cycle, or a structural shortage in memory stocks, does not prevent cycles. Now, I want to be clear. This isn't like, oh, everybody should be a bear on memory. There are some really important components, and this is a very large research piece, and we're going to go through the most important components of this right now. So we're going to go through all of it. I've already read through all of it and highlighted it. It's going to be great. But we've got to understand first, before we hit the Nomura piece, about how the physics of a bottleneck don't prevent the cycle. And the real question is, where does the cycle end? And what are the warning signs for that end? Do we have any of those warning signs now? We're going to talk about those. But all of that makes the most sense when we think about expectations versus reality first. So, for example, Samsung stock just cratered in the Korean stock market, 8.9%. That has now led Micron stock to drop about 8%. You can see most of this is just now occurring and still falling off a cliff at the time we're discussing this segment. SanDisk down about 11%, and it's taking other stocks down with it. The Nasdaq's going down down to 703. We're down off 735. In our Alpha membership last week, we argued 735. We're going down from here, and we might be going down sub 700 soon, and that was a projection we made last Monday morning, and it's been straight down since last Monday morning. Now, that's not to be bearish. There are a lot of things going on. Part of it has to do with the memory sector. The other part has to do with Bessent's failed credibility, topic for a different video. The other has to do with Jackson Hole, also topic for a different video, although we do have a coupon code JHOLE for the Meet Kevin membership. Massive changes to the benefits and pricing structure coming. So you want to get in before that because you're going to lock in some lifetime access and some longer term access than other people will. So get in before the 27th. And of course, then you've got a trade war with Donald Trump. So those are all, and Canada. So those are all things that could be accelerating some of the pain that we're seeing right now. We don't want to ignore those and pretend that those aren't also accelerants to what's going on. But let's be clear, Iran and a trade war and Bessent and Warsh, those things don't bring Samsung stock down 8.7% in a day in Korean trading. This is very specific to the memory sector, which is exactly what we want to harp on right now. So what happened with Samsung? Well, Samsung had earnings and the expectations got missed. It wasn't so much so that expectations just got missed, okay? We missed on earnings a smidge. I got it right here. We missed on revenue by 0.29%, nominal. We missed on EPS by 1.77%, also nominal. Does that really justify an 8.9% miss? Not really. This is something to know, though, for companies like NVIDIA. Markets expect that that NVIDIA is going to beat expectations. And so the way you have to look at NVIDIA is not, oh, NVIDIA is going to beat earnings. It's that we already expect NVIDIA to beat earnings. These are the earnings expectations. Okay, we expect those to be low. The market's expectation is earnings are going to come in here. But markets' expectations are built on, historically, they beat earnings by X%. And so even if you miss, like you could beat on guidance, but you miss those market expectations, stock craters. But it wasn't just the miss on earnings with Samsung. It was also something really important that they pointed out, which Micron could end up going down the similar road. Buyback expectations. Markets had been expecting 100 to 200 trillion Korean won of buybacks for the company. They came out and said we're going to do between 90 to 110 buybacks and dividends. That's the low end of the expected range. And that really pisses markets off. So just to visualize that a little bit more, let's get the whiteboard, and then we're going to go into some of this Nomura research on Micron. So if markets are expecting 200 to 100 trillion won, this is like $72-ish billion to $140 billion of buybacks. If that's what markets are expecting, typically you look at the midpoint. And the midpoint consensus estimate was 140 trillion. That's what people were looking for. This was the range, and this was deemed realistic. They ended up coming in between 90 to 110, some listed as 104 to 110. But the point is it's way lower. The other thing that they're doing is rather than just doing buybacks, they're focusing more on dividends. And this has an optics issue. When a company buys back stock potentially high, they look like a frickin' clown if the stock goes down. Now, obviously, the company can't predict exactly what's going to happen with their share price, but let's just put it this way. If you're Salesforce and you take on $25 billion of debt to buy your own stock at $191, when the stock goes down to $160, you look like a frickin' clown. And that's where I looked at the financials and I'm like, I'm gonna buy Salesforce in the 160s because they look like a frickin' clown. And I think they're buying back the stock because they're really bullish. And even though it's down in the short term, it's going to go up in the longer term. And it has, you know, it's at like $210 now. It's really rebounded on this. But the optics are terrible when you buy a stock for one level and then it goes down, even in the short term. By doing a dividend, they're not buying back the stock at a certain price. So that could be a little bit of a tell that the company thinks we're closer to a cyclical top. So another thing that, you know, I've been talking about on the channel or our Alpha membership is that everybody wants to get really rich in the stock market. The best time to really place your bets in the stock market is when you're closer to the bottom. If you're closer to the top, like let's say we're here, it's a lot harder to time the near top to the top than it is, you know, the bottom of the top. But the problem is, like, is the bottom here or is it here? Is it here, right? So it's like finding the bottom is harder and you gotta have the balls to get through that pain. So, you know, we could be more near a near top, right? Anyway, so that gives us a little bit of color on Samsung. This expectation really got missed. And it's not just the optics that they don't want to do as many buybacks, but it's also this expectation that this number is way smaller than expected. Micron has expectations set by UBS that they could make enough money to retire as much as 40% of the company outstanding stock. And that comes from UBS because the company itself said, hey, you know, we're going to return most of our free cash flow to shareholders. And so then UBS made calculations and they're like, oh, they could buy back 40% of the stock. And then, of course, you know, Twitter and FinTwit and Reddit just runs with the headline, which is, oh my gosh, they're going to buy back 40% of the stock. No, probably not. But the point is, if Micron now comes out and pulls a Samsung and says, hey, we're going to buy back 10% of the stock, that would be a really good announcement from a point of view of like, oh, they're doing big buybacks, right? But it would be really disappointing from expectations. Now, part of the reason that Samsung did buy dividends to a greater degree than buybacks has to do with their other subsidiary companies and companies that have exposure to Samsung Electronics that can only hold a certain percentage of shares, otherwise they get hit by the regulators. Some of that is just really weird technical regulatory bullcrap. And so that's how they're trying to brand it. I personally think they don't want to be suffering the optics of buying their stock back too high. And so that's why they're preferring the dividends. But it makes for a good excuse to blame the regulators. Always makes for a good excuse. Okay, so now let's go into the Nomura research piece because that also applies to what's happening here in this memory sell-off. And this will help us understand, is this temporary or what are we up against? Okay, so what I wrote over here on this piece is Econ 101, okay? This time is not different. And I don't want to, again, sound bearish. It's just a matter of when, right? But at some point, it all does come crashing down. And what they're basically arguing is exactly that. They customers amplify the swings in chips and memory stocks when chips are scarce. Called over-ordering or even double ordering to make sure they can secure the allocation. And when that scarcity eases, they'd rather part with their deposits and not necessarily fulfill all of the contracts they've committed to, then risk being in a situation where they wish they had the contracts and they don't. And so that's where they say the phantom demand, when the cycle turns, can be immediately canceled. And again, and you get those non-refundable deposits that companies like a SanDisk keeps. You know, SanDisk got a lot of upfront capital, by the way, for, and this happens with a lot of the hyperscale, the neoclouds as well. You know, whether it's an NBIS or whatever, they get a lot of upfront money so they could sort of keep investing in the infrastructure. And people see that upfront money and think, oh my gosh, this company has so much cash flow, but forget that that's actually a prepayment for contracts years out. If they get canceled, you're not getting those extra deposits again. So that does create a potential downside when those cancellations come. We're not saying those cancellations are coming. We're still in a massive shortage right now. So this is in the future. So actually, let's take a look at where we are right now. This is where Nomura thinks we are in the cycle right now. They think we're over here in boom. And they actually suggest that the shortage stage is not likely to turn down at all, which is remarkable. They actually think we're going to stay in shortage for quite a while. They argue that the latest reading of what they call the CSI, which, I call it crime scene investigation, but this has to do with their shortage index, is at 103. And essentially they argue anytime you are above 100, you are in shortage for chips. And anytime you're below 100, you have too many chips. And so we've been in these too many chip cycles before, like for example, March of 2023, or you could go back to 2014 or whatever. It's a regular sort of boom and bust cycle, right? Shortage pressures may fluctuate or ease at the margin, but the evidence does not point to an approaching regime change in supply slack. In other words, they think that the shortage situation is going to continue. So that's actually bullish on shortage, right? This is why I'm saying, this isn't to be bearish, it's to look at facts. Let's look at some facts here. Let's look at some more. For most part of the past 4 decades, the semiconductor cycle has followed the global economy. But now they actually argue the semiconductor cycle is becoming its own source of basically GDP growth. That, in my opinion, is actually a risk factor. It's a risk factor because what's happening is you're accelerating the economy that was actually kind of bleeding towards recession. AI has really accelerated this economy into boom mode, and that's great. But if the AI trade slows, then the underlying economy has less of that sort of stimulus that it has been getting. And so this is a good point, though, that typically semiconductors follow the economy. GDP does well, people buy lots of chips and computers. Now it's people are buying a bunch of chips and computers and GDP is doing well. Most of our GDP is driven by the AI trade. It's why Goldman Sachs thinks we would be in a recession if it weren't for this boom in artificial intelligence. Global economy is in the midst of the largest investment boom since the 1990s. And in Korea, at least, housing prices are soaring again, strong liquidity, twin super cycles of liquidity and housing. Physical bottlenecks are leading to massive pricing power. Unusual combination of multi-year AI demand and a supply base that is adjusting only slowly. AI spending no longer follows the replacement cycle for consumer electronics. And those commitments change little within the year, even as prices rise. So NVIDIA just raised prices for their server chips by about 15%. And it's leading to expectations of, oh my gosh, this is going to lead to bigger margins at NVIDIA. My expectation is a lot of those price increases are solely because of memory, which that makes people really bullish on memory, that higher prices can sustain for longer. In fact, that's actually exactly what Nomura research says. The latest Nomura CSI reading stands at 103.8 in July, close to the highest reading in the sample, which suggests the chip market remains in deep shortage territory and that we could sustain high chip prices for longer than we could in past cycles. In other words, they're starting to make the argument, guys, this time is different. This cycle is going to last even longer than in the past. And part of that could be true. I actually think a lot of it has to do with Claude. Now, I'm not trying to oversimplify when I say these things. I try to give you just my mindset of here's why I think something is happening. I think Claude for coding was such an innovation that mostly because of memory expansion, right? We kind of broke through the memory wall by getting access to a lot more memory for coding purposes. We were hallucinating way less finally in coding in larger code bases or for cybersecurity because we broke through at least the first blockade in the memory wall. There's still some memory wall, obviously, and there are massive shortages remain for high bandwidth memory. You need a lot more DRAM, which is a commodity, to make high bandwidth memory, which is in steep, shortage. Probably expecting high bandwidth memory prices to double next year. It's a phenomenal product, and it's very expensive, and it's critical in those GPUs. But I think a lot of the big memory boom came from coding in Q1, like March, and then into Q2, April. That was kind of our Claude moment. The problem with that is, I don't think we're going to have a Claude moment every year. I don't think it's a coincidence that Anthropic wants to IPO right after the Claude moment. And look at the chart, folks. Look at the damn chart. This is the memory chip shortage indicator. And it literally peaks right here at the moment of Claude. The Claude frontier explosion for mostly coding. But then you also get the GPT catch up with Codex. Sorry for the crappy handwriting. This is why I usually like to type. The handwriting's just not that great. But whatever. I don't think that's a coincidence. So I don't think it's a coincidence that Claude Cowork is probably what peaked us. I don't think it's a coincidence that Anthropic wants to IPO on the back of that, because their year-over-year numbers now are going to look the best. Their ARR at $65 billion as of the last day of July is really delicious for, promoting an IPO. But are we going to maintain those growth rates? Well, you'd probably need another AI Cowork moment, but where's that going to come from? Maybe it's going to come from healthcare. We've got a lot of talk about Moderna with immunotherapy drugs for cancer now and their partnership with Merck, which is very impressive. Really big fan. Let's keep going on the article, though. So, the latest Nomura CSI reading for July is close to a record at 103.8. Recent monthly movements have been small, which indicate there is no confirmed turn in the shortage cycle. So, I want to be clear here. Nomura, this is why I said at the beginning, this is not intended to be like a bear piece. Nomura is telling you guys, there's no sign this is turning around yet. And so that's why I write in my notes, right? But we are coming after the Claude explosion. So I think Anthropic helps us measure a cycle like major boom in healthcare AI. Could all happen. All of those things can happen. I personally think AGI is not going to happen. I personally think robotics are 15 years away. And do healthcare AIs need to run on frontier models? Or can they run on, Alibaba's Quen? I don't know. But that is, something to consider as well. So the model points to gains for pricing in memory stocks through 2027 and beyond. So Nomura's, notice how they start with hey, this time's not different. We're still going to have a cycle, but this cycle can last longer than previous cycles. Okay, this is where I get into my Micron numbers. So I know I shouldn't do a chart like this, but I do it anyway because I think this is a chart that represents investor psychology. Usually, when you have earnings at a company that explode like this, okay, these are the percentage growth levels of earnings per share growth at Micron. Earnings per share exploded like 900%, 25 to 26. This is an insane growth in earnings per share. This is just my quick little spreadsheet, right? The problem is, in my opinion, because technically, you're comparing to a low base. You could use a log chart and really smooth this chart out to get rid of some of this extremeness, this exponential growth here. But the reason I like this chart is because I think this is your chart of investor psychology. The people YOLOing into Samsung stock or Micron stock in June when everybody was leveraging up to the boobies, what ended up happening? People were leveraging up because they saw this nominal growth. But those numbers don't last, even though Micron's revenue is expected to go up for the next 4 years. They're going to make more money on top of more money on top of more money. Their growth rate converges to zero. And that is a problem. So when does the stock peak? Well, does it peak closer to where we are now? The post-Claude moment? Does it, peak after the Anthropic IPO? This is crystal ball kind of stuff. But the point is, the markets care about expectations. Remember how we started about expectations? The market is already expecting pricing to come down for memory. That doesn't mean it's bad for Micron stock, right? The markets already know memory prices are going to come down in the future. We know the growth rate, the second derivative, the growth rate of memory prices is turning negative. The question is not that it's going to come down. The question is, how long is the cycle going to last? That's what Nomura is saying as well. They're like, look, right now we're in massive shortage. This time is not different. The cycle will end. But that's not the problem. The problem is when we have the boom, the usual boom cycle looks like this. Can this cycle, instead of looking like this, look like this, where you plateau longer, okay? That right here, this fat, so to speak, that is your reason to be bullish, that the cycle can last longer. If these expectations get compressed because Anthropic stops spending as much money, for example, because remember, high bandwidth memory, this is kind of important. Small sidebar. Most enterprise artificial intelligence, in my opinion, and what we're seeing with, like, what we're doing with our artificial intelligence at Reinvest, most artificial intelligence for inference does not need as much memory as the frontier levels of training. This is, in my opinion, logical. The frontier models, and training the frontier models, they need those Blackwell GB, 200, 300s, the Vera Rubin stack. They need the latest and greatest massive memory stack to keep those frontier models going. Open weight models and enterprise applications, they don't need that much. They can operate on substantially smaller chips, older chips, in-house chips, open weight models that are more compressed. The more we use those, the more we compress the need for high bandwidth memory. It's still going to go up in price. It's still in shortage. But the more these open weight models come, the more you reduce that plateau. And that's how the market trades for memory stocks. The market doesn't trade on, oh, memory prices are going to go down in the future. Yeah, no. Every jerk off and their mom knows memory prices are going to come down again in the future. We know the second derivative is going negative. The whole cycle is dependent on what keeps this getting fatter. If robotics come out and all of a sudden we need to train, which eventually we will, all of these vision-based systems on, for what's it called? GPU vision, robotic vision, that's where I'm going with. All of the robotic vision that needs to be trained is going to use a lot of hardware, a lot of GPU, a lot of high bandwidth memory. But if that's 15 years away, we could have a big down cycle before that. If that's a year away and the Optimus robot is coming, hey, we could S-curve this up again. That's how memory stocks trade. And that's what makes it hard to be exposed in debt to memory stocks, because if you're margined up on memory stocks, you are setting yourself up for oopsie doopsies, just like situational awareness did. They were a real lesson here. So let me go to some of the other pages I have right here. Okay, yeah. So technically, we are right here with pricing. So you can actually see that the midpoint expected range here of export prices to a CSI shock is that we still have time where memory prices go up. The second derivative is going down because the line is flattening. And then soon the first derivative will go down, right? The first derivative goes negative. Memory pricing starts coming down. Usually, 2 to 3 years after the cycle starts. The cycle really started in about Q4 2025. And by 2029, you're just outright negative. That's already built in. It's just how fat can we make it? That's what memory stocks price off of right now. And that makes them hard to invest in with debt. So just be very careful, because the volatility will be massive because you're trading expectations. That's why Samsung stock's down 8.9 or 8.7%. AI and high bandwidth memory have become large enough and sufficiently wafer intensive to tighten deliverable supply chains across the broader market. This is actually important because really what's happening is memory has become so critical that all components related to chip manufacturing are getting more expensive, and pricing power is going through the entire stack. Okay, what else do we have here? Today's constraint, harder to reverse. Wafer allocation, basically it's taking more time. And these shortages can persist longer. Again, they think between through the end of 2027 and beyond. However, they do flag that historically, double ordering becomes very normal. And when that double ordering gets canceled, you get a massive reversal in momentum, and that's not ideal. Now, could that actually benefit NVIDIA? That's another argument. I could make the argument that NVIDIA could actually benefit from memory stocks coming down because they could keep GPU prices elevated, but actually make more money because they're spending less on cost of goods sold for the memory supply. It's possible. This is okay. Then we talk a little bit about Moore's law here. Typically, chips are a source of a deflation because transistor density doubles every 2 years or so. Every generation of miniaturization yielded chips that were faster, more numerous, and cheaper per unit. This is why semiconductor prices come down for decades. And they are a persistent source of deflation. However, because of the way high bandwidth memory is manufactured, that it takes so much of this DRAM that you stack together, you're creating a structural shortage that's just going to last longer than previous cycles. It's still going to be a cycle, but going to last longer. In the first half, year over year, memory prices increased 135%. And if you just look at the second quarter post-Claude, memory prices were up about 400%. Now, I think that's actually a really important note to make, is that the highest gain in memory prices actually came immediately after and sort of during the Anthropic Claude moment, if you will. That's important because it reiterates this concern of what is the catalyst that keeps it pumping. Let's go see if we can find the price increases. They're listed somewhere here in the Micron statement. I'll pull them up. But just from memory, we went from like, oh yeah, prices went up 110% year over year or whatever it was, to prices went up 400% or something ridiculous. Let's see here. Oh, okay, yeah. Okay. Well, this is the Micron example. Ready for this? Sales of DRAM increased 343%, primarily due to low 260% increases in selling prices and mid 310% increases in average selling prices for NAND. So not exactly 400%, but my point is, Q2, this is the Micron Q2 piece. Q2 was even more extreme than Q1, like substantially more extreme. These numbers, if you pull up the Q1, were at like mid 110s range is what they wrote for this. So most of that price increase that they're talking about in the No More Research piece aligned with the second quarter, not the first quarter, which is again important because it helps you pinpoint why. Claude. Okay. What else do we have here? Actually, I think... Oh, I just got to the end of my No More piece. That is my No More Research. So, what are the bottom lines of that? Like, what does that mean? Does that mean, you know, this stock sell-off is durable and we're going to hell? No, it doesn't mean the cycle's over. We got a lot of crap going on in the market today. It's going to create buy the dip opportunities this week, you know, thoroughly with Jackson Hole coming up. We'll be live streaming that, obviously. And of course, we'll talk some memory bottom lines here, but just a quick note, you can use that coupon code JHOLE that expires on August 27th. That'll be a pretty big expiration because we're including some more benefits for members who joined before that date. And then there'll be a big price increase as well. So remember, joining could be a tax write-off, and you get our research and our alpha report and trade alerts before, along with access to all the courses. It's pretty awesome. So check that out over at meetkevin.com. But bottom line for memory, where do we sit bottom line on memory? Bottom line for memory, you're going to be in a shortage for a while. But at some point, we need expectations to keep pumping the cycle to actually enable those like 40% Micron buybacks to happen. Otherwise, the companies will end up leaning conservative. Say, well, let's not have bad optics at buying our stock back too high. We'll do some dividends instead. We'll keep a little bit more capital for debt payoff, which is smart, or, CapEx. The issue is all these companies are building out machinery and capacity based on their expectations of future demand, or in my opinion, not realizing how every single memory-related company is trying to throw money into expanding capacity to capture that demand that we have today. And that's usually how you end up getting into an oversupply, because it's not like they coordinate all of their build-outs, even if, some brand that they do, they don't. So anyway, I think that's a useful primer on what's going on with the memory cycle. If you're really bullish on memory, in my opinion, it should be, because you expect that fat portion of the curve, that plateauing, to either last longer, or you see S-curves that maybe I don't. Again, robotics, healthcare, AGI, I think these are a little further out than markets expect today, and that creates some downside risk for these plays. SanDisk is sort of lumped into this, even though it's a storage play. You could check that, my full Samsung or SanDisk video, just search it on YouTube, meet Kevin SanDisk, and you'll see it. But that gives you a full-on breakdown on memory. All right, that was a lot. So, well, yeah, I mean, that's that. So what do we got going on here? We got the Qs. Still, I mean, you got some recovery going on here. Bounced 702. It's not bad. Not bad. So a little bit of a bouncy doodla here. I wonder if we've gotten any of our announcements yet from Bessent. I mean, we've just been talking about memory for so freaking long. But I think that's really important. There's a lot of color in that. I see Zelensky comments. And then we had the Trump on the vehicles. But no, nothing quite yet. So still a little bit on standby here. Salesforce still pushing. You've got Intuit trying to push up intraday here a little bit before earnings. You've got Palantir stabilizing around 3%. Tesla's trying to recover here. So you got a little bit of a recovery coming in. Oh, wow, we're almost there. My target is 80,100. We're almost at our target. Look at that. That's a 5-minute chart here. So really, within the last hour or so? Really getting close to our target. We'll be there soon. And let's see, Walmart. That looks like a strategic bounce. We got this 104 line. Nope, it's literally riding the line. See, we dropped under that line on Walmart, and now we're riding it. 104. Let's see if it can hold. AMD. Oh my gosh, look at that bounce on AMD. Sometimes the lines just scare me. They're too perfect. Too scary. But that's all right. Okay. Let's go see what some of your commentary is. BBG, what's BBG? Bessent announcement is 2 p.m. Right. He's supposed to have a press conference at 11 a.m. But the reason I look, and you should pay attention to this as well. You could do this by, if you go to the if you download the Meet Kevin app, you could see it in the Wire service. But the reason I like to watch the Wire service is because usually they announce these things via a press release, and then they do their press conference. And it gives them an opportunity to kind of watch, like, initial reactions and how to answer questions better. Like, I remember this back, the Biden administration. Good old Biden. They would always do this. Anything that was going to be announced, they basically pre-released it. Now a lot of people say, well, that's because, he's got dementia. Okay, fine. Fair point. But it's very common for politicians to do that. Press release what's supposed to happen before, and then actually hold your presser on it. So, long and short of that, there is a reason to watch what's going on with the press releases. Okay, so memory. Okay, good. Let's go. Let's see what else. The yield market is another one to watch. I got a lot of people that always ask, Kevin, what about the mortgage plays? Let's do some fundies on the mortgage plays. The sad thing about the fundamentals on the mortgage plays is they're so related to what the 10-year treasury is doing that it doesn't really matter what the fundies are. It's like the fundies matter to the extent that, is the company going to go bankrupt or not? Are they going to be able to survive? But beyond that, mortgage plays really move heavily just off of the 10-year treasury yield, which is just in a terrible place right now. 10-year treasury yield right now, what are we still at, 4.7? Let's go look. Let's take our little last update. It is, yeah, basically 4.7. Still down 4 bips, though. That's good. Still at 47 on the spread. Yeah. Okay. We saw the, oh, it is Canada auto tariffs. Okay, okay. That was missing from the headline. Let me take a look at this. So this is, Trump said Monday the U.S. will raise tariffs on the imports of cars, trucks, and auto parts from Canada on Jan 1. I mean, everybody expects daco on all this stuff. This is really not a surprise. Okay. Okay. Let's see. Let's see. Okay. Good. So Greer, they wanted more. He had an interview this morning on CNBC. I saw him just sort of yapping about, you know, basically America first, which is fine. I get it. I you know, not sustainable, not anymore. But I personally a really opposed person to tariffs. We don't need Canada, they need us. I mean, really just like extorting your relationships doesn't make a good friend. That's my take. But, you know, I know not everybody agrees with that. Okay. So, let's see. Okay. 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 So, still getting a nice little bounce here on AMD. That is nice. Full ported Soxel at the top. What do I do, says Cody. I have no idea. Yeah, so it's a leveraged. Is it 2 or 3? Oh, it's Soxel's the 3X. Yeah, I mean, because there's a lot of hope for, you know, this spending from SpaceX and Anthropic, that it's really going to push these puppies up. But it's tough with leverage. So let me look at the underlying semiconductor. It's the Philadelphia semi. So semiconductor index. What is? Why do I not know the ticker for it? Hold on. Oh, it's just socks. Oh, I should have guessed that. Thanks. All right. So I need to know what the components of it are. It's all sponsored results. Come on, man. What? Like, can somebody just give me the damn components? There we go. Like, the first, 7 results on Google were just sponsored. And I'm like, bro, you guys that desperately need to make more money? Jeez. Come on, Google. Like, I get it, okay? You make money from advertising. But it is so hard to distinguish the difference between a core post on Google now and a sponsored post. And they don't even just keep the sponsored posts at the top anymore. They start, sprinkling them in between, and I'm like, oh, my lordy. All right. Let's go look at this. Yeah. Wow. Holy moly. Yeah, I mean, this is a hardware index. So I've got NVIDIA, TSM, Broadcom, Micron. Oh, Micron's a big allocation. Well, now, what's the allocation in it? Oh, it doesn't say. Let me see here. Let me just see if maybe, by allocation. I really want to see it by allocation. Okay, here we go. Oh, wow. So, unfortunately, when you're in Soxel, you're 3x exposed to a 7.7% position in Micron. So, you know, when those expectations shift or the Korean situation happens, that hits the index pretty hard. Wow, that's a big allocation in there. TSMC's 4.5, Marvell's 4. fantastic company. Lamb's in here. AMAT. I mean, these are all really good companies. The problem is Soxel, and I'm not saying that like it's now and it's definitely the bottom. You know, you could end up getting Nvidia pull a massive rally here post earnings, and you know, once you get through Kevin Warsh and whatever, it ends up you know, skyrocketing again. You have your next hardware 2.0 rally, but the real concern is, you know, when a 3x ETF goes to zero, it doesn't come back. When Nvidia goes down 33%, it's going to come back. The leveraged ETFs don't. So getting out of it is always hard. You know, probably like psychologically. I mean, it comes down to your own portfolio too. Like, what's your situation? You said you full ported, but like, you know, what's your income? What's your net worth? What's the percentage of this exposure to your income? No, you know, those are all the personalized questions. This is why I don't know those, so I can't give you personalized advice. But I know what a lot of people do in a situation like that is just trailing stops, mostly because it's just a psychological. You know, if it keeps going, that's just where it triggers, and then you're out. But if it booms on, let's say, Nvidia earnings, it lowers the floor, and you can kind of trail with it. I see that a lot. Very strategic. And I mean, the good news is right now the market is recovering from some of the initial drop that we had. That first 30 minutes here, it's a little brutal, you know. So we bottomed out around the 700 level. Doesn't necessarily mean the pain is over. You're probably going to get more of that end of the day accelerated selling that you get from the leveraged ETFs. SOX is part of that. So that's another problem is the leveraged ETFs, they'll have to basically sell into red at the end of the day. And so that sucks. Like, Soxel is going to have to sell at the end of the day, and sometimes that actually leads the market to sell off worse at the end of the day because they're basically selling into weakness. And usually our logic is, oh, we should be buying into weakness. But that doesn't work with leverage. As usual, leverage is the death knell. And so I love the components in SOX. I think there's some fantastic companies in there. You know, but leverage will kill the staying power. Okay. So, yeah, I mean, you can't give me some of your numbers. And then expect personalized advice, because then it turns into paid personalized advice, and you can't do that unless you have a financial advisor relationship, right? So there's a real limit to what you could do here, but we'll do some summary thoughts outside of these exact numbers. So we'll do that in just a second. Let me just see what these headlines are coming in. This is more Zelensky. 3 vessels entered port of Odessa despite daily Russian attacks to block operations. Zelensky says there will be talks with Russia on the Black Sea. Yeah, and then they just projected another truce. You know, the Russia thing is just this ongoing crap, and it just sucks. You know, it'd be nice for that to be over too. Just geopolitical wars. It'd be nice to have no more wars. You know, it just seems like we keep going in the wrong direction. Oh well. Oh well. All right, let's listen to the Doomers for a moment. Curious what they're up to this morning. So, the Doomer Boomers. Okay.
Has implemented 50% Section 338 tariffs on billions of dollars worth of Canadian goods, including things like hockey sticks and alcohol. And Mark Carney has announced that Canada is going to retaliate. As of September 8th, the day after Labor Day, tariffs on $20 billion of imports from the United States, things like dairy, U.S. steel, other things as well. Electronics, for example, will face tariffs coming into Canada. So that is where the tit for tat has gotten to us to this point, where the president is now suggesting things will escalate even further. The timing is interesting, though, Danny. January 1st would indicate that there may be some room for negotiations between now and then to avert that from happening. But our colleague Josh Wingrove is reporting that Canada is not under any assumption that things will resolve in the near term. The Canadians, according to his reporting, do not believe that there will be substantial negotiations before the midterms and may be preparing to ride this out for the long haul, as in until President Trump is out of office in January 2029.
And of course, we're still awaiting details on what economic D-Day could mean for Iran and its trading.
Right. I mean, everybody folded when the tariffs first came out. Pretty much, I mean, a lot of people, the Europeans, the Canadians, the Chinese really didn't, you know, but that deal never got finalized. We never finalized the trade deal with China. We just have sort of like short-term, one-year plans. You know, the next one I think expires in November, so that'll be another thing. But there was a lot of folding to Trump, and I feel like now, almost like for political leverage, there's this incentive for like home base standing up to Trump, especially, and that could worsen actually going into midterms. You know, you go into midterms. I mean, tell me what you think about this, but you go into midterms, and let's say, which is likely, they lose the House or the Senate. That's kind of the perfect time for other countries to stand up even more, because then they could go, see, politically you just had a loss, and now we're gonna, you know, sort of strengthen our fists, if you will. I don't know, that's an interesting thesis.
Kinetic action. They have already pointed to what they say has been success of the existing economic measures, keeping in mind Iran has been under sanction for nearly half a century. The U.S. naval blockade has been maintained for months now, and Bessent in this Financial Times op-ed pointed to 80% inflation in Iran, the weakness in the Iranian currency that we have seen as of late. He even likened what he and the administration are trying to do to compare to the effort in World War II and FDR and Winston Churchill. So it goes to show you how far the administration would like to reach here in hurting Iran economically, but it remains to be seen whether or not other countries will be buying into this.
Kaylee, really excellent work as always. Bloomberg's Kaylee Lyons looking forward to Balance of Power today, kicking off at 1 p.m. Eastern. Coming up, we're going to be speaking with Invesco's Kathy Krinsky about what's driving demand for metals. That's up next. This is Open Interest.
All right, interesting. All right, let's do a little sort of short summary on the Soxal piece, because I do think that's interesting for Cody here. So let me just pop this in here really quick. Okay, so just take a second here. Okay. Okay. So, Philly index. There we go. And socks. All right. Let's try to help you out, Cody. Cody, who's 35, just asked, hey, Kevin, I full ported into Soxal at the top, which is a 3x leveraged semiconductor ETF. What do I do? Here's the first thing we have to know. A 3x leveraged ETF carries a lot more risk than just these fundamental holdings, which these are fantastic companies, but on a day when Samsung misses expectations for their buyback and they come in at basically half of the most bullish estimates for their buybacks, the entire market goes down. And it could be literally something as silly as expectations getting missed in South Korea that brings an entire semiconductor index down. And that in alone is one of the greatest lessons in avoiding leveraged ETFs, especially 3x leveraged. Did you know there were applications for 5x leveraged ETFs? The SEC actually finally put their regulatory pants on and canned those applications denying anything over 3x leveraged. And thank goodness they did, because in July, all of those 5x leveraged ETFs would have gone to 0. And the thing about a leveraged ETF is when it goes to 0, it doesn't come up again. A 3x leveraged ETF only needs to see 33% selling on average of the underlying stocks, approximately, we're rounding here, to see the entire index go to 0, and then it's liquidated. And liquidated at 0 means you get nothing back and it's not bouncing up. If NVIDIA goes down, even if NVIDIA goes down 80%, just to be ridiculously extreme, it's not going to 0. And that psychological driver is unfortunately why most people are going to sell out of a leveraged ETF at the worst time. It means you buy at the worst time and you sell at the worst time. That's the unfortunate psychology, because you know on the way down there's a risk of it going to 0. So you have people who would otherwise diamond hand an individual stock that can't diamond hand a triple leverage because they know there's a chance it's actually going to go to 0. Obviously, any company could go to 0, but I would say 10,000 3x leveraged ETFs will go to 0 before a company like NVIDIA goes to 0, right? So there's a possibility to each. It's just probabilities for all of them. Now, while I can't give personalized financial advice to Cody, one of the things I find is that if you're thinking about that darn index every single day, you're probably overexposed to a single security. And one of the easiest ways to take the emotion out of it is set a trailing stop. So that way, NVIDIA earnings come in and the entire semiconductor index rebounds because we get over some of the Kevin Warsh or Scott Bessent concerns or Iran D-Day concerns, and this puppy rebounds like it deserves to. Great. Then your floor of selling has moved up. You set a 20-30% trailing loss, that thing moves up nicely, great. And then if it goes down again and you ding out, you ring the bell, great, you just picked up some extra capital. But if it keeps going, at least you've removed the emotion and you don't ride it to 0. Personally, I think the lesson in all of it, and I know it sucks for Cody's situation because he's already in it, but I think the lesson to everybody else, if everybody else can win from that, is leverage is exactly what destroys in the stock market. Best case scenario, you're allocated in such a way, it doesn't matter if NVIDIA goes down 80%, because you look at it and go, whatever, it's on sale, I'll buy a little more, I know it's not going to 0. NVIDIA's a great company. The components of the Philadelphia Semiconductor Index, they are great companies. AMD, Taiwan Semiconductor, Broadcom, what a fantastic company. The ASIC chips that Marvell and Broadcom are making are really the future of AI on cheaper chipsets. These are fantastic companies, but you could get paper handed out of fantastic companies because of leverage. Stay away from leverage. Hopefully that's helpful. All right, let's go back over here.
Right, as the long-term rates came down and people are like, we need to make sure we have gold. But also the central banks. Remember, last year, gold was doing it was the best performing asset, 53 new all-time highs. I love that stat. All right, but, this year, the gold, we lost some of the luster of gold just because people wanted cash and people were concerned about what Chair Warsh was going to do with rates. But now, the central banks are back in. One of my other favorite stats, PBOC, right, in the month of July, they bought the most gold they have bought since October 2023, and the Central Bank of Korea hasn't bought gold in 13 years, and they were also back in.
Kathy, this has been so excellent. Not enough time. You're going to have to come back and join us.
Great,
Buying
so
gold.
great to see you.
Gold and Bitcoin have really done well very recently here. Gold's still not at its all-time high from the disaster that we had with, the Kevin Warsh peak. I still don't think we're going to regain that high, but we have seen a recent rebound. Part of it just because of the failure of credibility in frankly, the United States Treasury Department. It's not good. So, we'll see. All right, let's see what else we got. Let's see. All right, so what do we got over here? Let's see here. All right, that should help. Are we still bottoming on the day? We're stable now. See, now we're trading sideways. What the heck? Let's see here. So we've got SanDisk. SanDisk coming back nice as well. I mean, they were down as much as like 12% there for a hot minute. That was wild. All right. Let me pull. Okay. All right, let's go see how soft we're doing. Let's go to IGV. IG Bizzle. IGV also pushing up again, which means Cyber's probably pushing up a little bit. Yeah, and Palantir must have bottomed. It did. Yeah, Palantir for a minute was up. Or, sorry, was down like 4%. That was wild. That was quite an extreme little panic there at the open. But not uncommon. It happens. Little paper handers. And sometimes it's forced paper handing. Like, I don't think by any means that somebody like Leopold wanted to paper hand. You know, I'm sure he looks back and is like, man, I wish I could go back and not have had that exposure. And, you know, I'm sure he's going through a hell of a lot of woulda, coulda, shoulda thoughts. And it's unfortunate, but it's the exact, you know, triple leveraged ETF problem. And it doesn't make anybody a bad person. It's just, it sucks. I feel like almost everybody, and I hope it happens less, but it won't ever. Almost everybody kind of has to go through the lesson themselves. Like, that's why we stay away from debt. And it sucks because a lot of people would save money if they could learn from somebody else. So that's why I like talking about it so much. And I feel like a broken record, but I feel like it's a tool to say, hey, here's an opportunity for you to learn from the mistakes of others, whether that's me or anybody. The dumbest trade war revisited. Ooh. Let's take a look at this. So, this is by the editorial board. President Trump took exception last year when we called his tariffs against Canada and Mexico the dumbest trade war in history. Well, yeah, that's a great way for... Donald Trump basically gets really pissed off. And I think it's so funny when he gets pissed off by the media. And I'm not saying, like, I'm here to shill for the media. I'm certainly not. I'm just saying I think it's hilarious because he does not take criticism really well. And then I love it when he's like, worst newspaper in the world, you know, all this. And I'm like, all right, come on. They're not that bad. But Elon does it as well. You know, it's like, what's it called? Reuters will come out and they'll leak something from the inside. And then it's often like, fake news, wrong. And then it turns out to be right. This happens a lot with Elon. But I think that's kind of entertaining with Trump. All right, I want to see what the article yaps about. We'll do a brief look on tariffs. I don't want to spend too much time on tariffs. I mostly think that we kind of already have a pretty good idea on what's going on with the tariffs. Got dumber this weekend as Trump escalated another round of border taxes on Canadian imports a mere 10 weeks before midterms. Yeah, see, I think this is a mistake. When is Mark Carney up? Mark Carney, next election date. Okay. So it says the next upcoming election for Carney's government are the 3 federal by-elections scheduled for August 31st. So is he up? Oh, next general election is 2029. Okay. Okay. Wait, I want to hear this.
For NVIDIA's chips.
NVIDIA doesn't need to profit on the models themselves. It profits on everything that runs on them. The Grok chip going live today is the hardware half of that same bet. The speed layer for the open models, NVIDIA now wants to build itself. For all of that, though, look at the share price, down about 2.5%. Stock just can't catch a bid. It's fallen, for the 7 straight days, its longest losing streak since September 2022, down almost 7% over that stretch. As Mizuho's Jordan Klein put it in a note this morning, buyers are in just no rush ahead of Wednesday night's results. Why try to be a hero ahead of that print?
Well, speaking of it, I mean, you're going to be talking a lot more about it between now and then, Christina, I have a feeling. But do we have any key expectations there in terms of what we'll all be looking at with NVIDIA, assuming, as usual, they report a very strong number?
Which is, see, you use the word assuming, right? The market already expects NVIDIA to provide these strong numbers. The market already expects the CEO to be extremely bullish, saying that, everybody is...
That's what I was literally saying. I'm like, people already expect a beat, right? It's already priced in.
Which we spoke about just in the last hour, and also why you saw price hikes, reports this weekend saying they're going to increase prices for their systems anywhere between 15 and 17%. And of course, the circular financing narrative that came up with that $500 billion initiative with those 6 financiers. I think the narrative that Jensen Huang and management will have to be on the call is just, it's not about circular financing. This is us deploying our money in smart ways. We have a lot of money in terms of free cash flow, and that is why we are very aggressive right now and acting almost like...
Keep in mind, NVIDIA concentrates their risk by accelerating their investments into these smaller companies. It's great when it goes up, but when it goes down, it's an accelerated risk. Now you have fewer orders and losses on your books.
Christina Bartonevelis. For more on this market, let's bring in Lazard Asset Management CIO Eric.
So that's very interesting. I want to look at this with the Grok production a little bit. I don't know if to call it Grok or Grok, what to call it. I always think it's kind of funny, but we'll pull that up. Let me see if the Doomers are yapping about that at all, or if there's anything on the wire services. No, wire services a little quiet. Kind of still waiting for the Scotty B presser. Oh yeah, here's the memory. It's a little memory talk. Let's listen to that for a moment.
What NVIDIA built into the prior pricing, so there's a lot we don't know at this point. Recall that Jensen Huang has said repeatedly that they predicted that the amount of memory they'd need 2 years ago. So they've been working on locking in supply. They've formed these long-term agreements with the multiple suppliers of memory. So there's a significant amount of detail we simply don't know.
Mark in the chat is saying, I'm having trouble logging into the app for Alpha. If you have issues, just the very first thing to do is make sure your email is the same as that you actually use to buy the courses on. Most, like I would say 90+% of the issues, probably 95% plus, are just the email's wrong. Period. You use Gmail instead of AOL or vice versa or whatever. Really common. And so I do hate to say that, but that would be just something to double check. But otherwise, just email us. We'll help you at staff@meetkevin.com. We'll take good care of you.
The underpinnings of what's paying for all of this.
Yeah, I have to be clear on this point because this is among the bigger concerns for investors, is this concept of circular financing or vendor financing. And so the consortium that was announced with groups like Blackstone, BlackRock, Apollo, KKR, it shifts the risk. It shifts it off of NVIDIA's balance sheet elsewhere, and that is most appropriate.
I mean, not really, because if NVIDIA is taking stakes, they don't actually shift the risk at all. They actually amplify their risk. So the guy's wrong.
Generating roughly $1 billion of free cash flow every 2 days. They have a responsibility to put the cash on their balance sheet to work. And if they're big believers in AI, like we are, and I'm sure they are, why not invest in the AI opportunities? So sort of the classic eating your own dog food. I think the optics of circular financing, that is putting money into your customers to buy your product, it's not a great look. I totally get that. But NVIDIA has to put its cash to work. I think what would soften the blow for...
You literally do not need to put your cash to work. You can literally sit on it. Bam!
In buying back its own stock.
And you expect them to do that?
I do.
I want to talk about the distinction between depreciation and the economic lifetime of a GPU. Because right now, what I see is lots of NVIDIA executives posting on social media about Vera Rubin being in full production. At the same time, like that KKR BlackRock deal, they're trying to sell that this is a highly utilized cash flow generating asset for many years to come on older, obsolete generations. How can both of those things be true at the same time?
I think they can be true because of the way the market evolves, that the most leading edge applications, the most demanding, will require the newest generation of accelerator. And in order to be efficient, in order to have the best profitability, one wants to utilize the most leading edge tool because it will be more efficient. Basically, fewer tokens pulled. However, we've seen that the older generations, the Amperes, the Hoppers, are still being used. And so what we're observing is the market's broadening in that the most leading edge applications, the most demanding applications will require the newest generation. But the older GPUs, the older accelerators, have useful lives that could extend many years.
Simon, many of your industry colleagues, including our team at Bloomberg Intelligence, expect to hear something about China. Does it matter to you if NVIDIA can sell some kind of GPU into the Chinese market?
No.
Honestly, not really, because...
Thank you! Yeah, no, it doesn't matter. I want to take a quick extra look here at just the technicals of SOX and SOXL. SOX and SOXL. So let's just look at these on the week chart here really quickly. So if I look at SOX and I go to, it's probably a reasonable level. Let's see, 2022 chip bottom. That's funny. That's when I went heavy on NVIDIA and then I launched an ETF around pricing power chips. Okay, let's go drag all the way to here. That's hilarious. The bottom. Okay. So 208982. It's so crazy. That was before AI too. I mean, neural nets still existed, obviously. Oh, wow. That's actually sitting really nicely. Look at that retracement. That's pretty decent. All right, we're going to lock that into place. But I want to consider this with SOXL. Ooh. So, yeah. I mean, you're at the bottom rung almost. And the moving average is 43 bucks for this. So it's almost like, you know, you almost have to stay away from these unless they're under their moving average. That's interesting. Wow, they started SOXL in 2010. Holy smokes. That's crazy. But anyway, yeah, your distance from moving average on a leveraged ETF. Do we have like a leveraged software ETF? Let me see here. SOFL 2x. Huh. Sounds like SOFL. SOFL. Delisted. Wow. What happened? When did it delist? In 2025. Oh, it must just not have gotten. I mean, it's fine. It performed okay. SOFL delisted. SOFL delisted. Insufficient investor interest. That's fine. That's fair. Oh, 1.29% fees. Wow. Okay, so are there any leveraged software ETFs that are still open? SOFL, that's the one that closed. What are the other alternatives? Let's, because I want to go look at some of the tickers for them and just Let's compare. No 3x leverage for software. Interesting. I mean, you could go triple Qs, T triple Qs, but we already know that. $2x SWAR. 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 Let's try that. 80,100 is the Bitcoin price target. So here we go. But why is this not? No, this is old too. It's also delisted. That's very interesting. The software ETFs just didn't make it. Yeah. Yeah. All right. Oh, very well. I was going to say, there would be something interesting about looking at the moving averages. Let's look at T triple Qs. So, T triple Qs is that's at the 100-day moving average. That's actually very interesting. So it's almost like, can you justify buying them under their moving averages on leverage? I mean, you could almost make that argument for any stock, picking something up under a 200-day moving average. But then there's still the risk that you end up with a Nike. You know, like Nike's been under its moving average for a very long time. I mean, look, this is the 200-week moving average. We have been under that, you know, since 2023. We've been under the 200-week moving average for 3 years. So, you know, no easy way to say it. But I guess what I would say is, I think that the way to look at it is a 3x leverage is probably most risky above the moving averages. Even on T triple Q over here, you could see that reversion back to the 200 and the 100s. Yeah. All right, let's listen in over here.
Probably being most analogous with Amazon. You know, it has e-commerce roots and now a massive cloud computing division where it has the mainstay of its AI activity. Just describe the company to us.
Well, they really are diversified. And when we were talking about Alibaba just a few years ago, we were really thinking of it as that online retail powerhouse. But just like Amazon, and we heard Andy Jassy talk about their push into chips even, they are trying to spread their wings and spread into a lot of other areas. And that includes cloud computing. And they have also backed some of these companies that we're also seeing as AI developers. Minimax and Moonshot have also gotten an injection of support from Alibaba as well, as a way of trying to diversify their holdings and their resources. So they are really, Ed, in a lot of ways, looking at AI as the next frontier and also something that they can integrate into other platforms. Right. If you think about AI and the way that Amazon is trying to integrate it for its users, for its consumers, it's really an essential. And it is also something that it can sell then as a cloud computing platform to other customers too.
Shep, as a quick sidebar to the main Alibaba story, we saw leadership, management participate in the offering, buy shares. What do we need to know?
Well, I thought that was so interesting, too. When we looked at the shares dropping in trading earlier today in Hong Kong, it might have raised some questions. Well, what does that mean about appetite overall? But they are putting skin in the game, and that is chairman and one of the co-founders, Joe Tsai. He bought the U.S. equivalent of $10 million of shares, and Eddie Wu, the CEO of Alibaba, bought about $5 million of shares. So they are really putting their own skin in the game, and they are trying to make sure that they are giving their own personal sign of support to this offering to signal to other investors that they're in it too.
Bloomberg's Mike Shepherd, thank you very much. Let's stick in Asia. SoftBank is planning the biggest retail bond sale.
Pretty big fan of what Alibaba's doing with Quen. And I think that's one of the reasons why NVIDIA is getting into this open weight competition, which makes a lot of logical sense. Okay, let's go look at, there's not only the Grok news with NVIDIA, but then there's the NVIDIA open weight news. And I want to look at, I want to look at the pricing for Google really quickly. I just want to look at Google's debt and see what that's trading for on the secondary. Let's see. Okay, because they raised $84.75 billion. And that was the upsized round in June. That was basically right at the SpaceX suckening. Remember, we're pulling all that money out of the market. That's when they raised some good money. Basically timed it perfectly at the peak. So, Gus is asking, biggest question is what pops the bubble? I have my eyes on Anthropic. They are very interesting because if their profitability doesn't accelerate, then we have a problem on what we're underwriting a lot of data centers for, you know, especially under the Elon hype of, oh yeah, we're going to be able to charge $30 to $50 long term for these compute prices. Really? Are you really going to be able to? Okay. So, let's go. Let's take a peek here. Okay, where is, I want to see what Google's trading for now. The Qs are still slipping a little bit here. We're sitting at, what are we at? We've got, yeah, down $0.14 right now. Hood's green, Amazon's green, Palantir's only down 169 now. I've got Bitcoin's almost at 80K. That's awesome. Okay. So okay. Got it. All right. Now what about the Googs? And then I want to go hit NVIDIA. Okay, so this is up 1.4 now. It's still a little bit under where Berkshire acquired, which I want to say was 359 with some of the discounts they got, because they, you know, that was announced somewhere around like the 370s range. Okay, let's go take a peek at that, and then we have a couple of those journal articles to look at. So Google's price, Google after their suckening, that was their sort of top, because they issued at the end of May. It was like May 29th. Yeah, that was their final. Yeah, they sort of topped out on the 22nd, so I wonder how much writing was on the wall for it. Okay, the Google preferred, here we go. So the Google preferred was two $9.6 billion $50 par value, 6.25% mandatory convertibles. Oh, wow. They actually have a premium conversion price. So they convert at $440, 444 to 440. I see. Okay, either way, you get converted, though. It just depends on what ratio you get. So it gives some downside protection, basically. That's a little complicated, but that is very interesting. That's an interesting way to raise money, because Google's raising at 6.25. SpaceX, CoreWeave, we know, is somewhere at over 10%. And that we could see with the Wall Street Journal, CoreWeave, 10%. The financing, Yeah, that's this. CoreWeave raises debt. And this is another thing that's interesting about debt right now is CoreWeave has a junk rating. They're raising at over 10%, but they don't actually disclose that they're raising at 10%. Okay. Let me pull up CoreWeave, and then we'll be able to see that. Okay, so CoreWeave, they have earnings report. Here we go, August 11th. So this is the CoreWeave earnings set, and if we scroll down to, I should have bookmarked it, but somewhere here we're going to see their weighted average cost. And I want to say it's 9%. I don't know where it is. Weighted average. No. 9%? Nope. 9%. Dang it. Let me see if I can find it another way. We'll find it. But I think this will be very important for seeing just how impactful all these rates are that are coming out. So Amazon, for example, I'm just looking at some of their bonds. Amazon issued bonds for 4.25. Those are a 5-year bond, 4.25%. Their 30-year bonds are at 5.8. Oracle's raising money on a 3-year at 4.5 and on a 10-year at 5.7. SpaceX is raising on 5 years at 5.35. So SpaceX is raising for more. Okay, I want to see some more of these. I want to see like CoreWeave. Yeah, okay, here's CoreWeave. So CoreWeave, here's a 5-year at 9.75, and then they sold it for a discount. So that's how you got over 10. That's interesting. XAI was issuing debt at 12%. So they actually got a big discount by merging or getting acquired by SpaceX. They reduced their cost of capital substantially. It's actually kind of smart. Meta on the 5 years raising at 4.5, but they're also raising 40-year debt at 6.4. All of those become more expensive, unfortunately, as rates go up. So that also hurts the, what's it called? The outlook for these hyperscalers and spending. Bessent's meeting or press conference is in like 2.5 hours. We're still bond yields right now. Fortunately, they're still all in the red in anticipation of Bessent's call. So that'll be interesting. Oh, let's see them talk about the foldable phone here.
Is foldable phones. But it's actually double that in China, right? So the vast majority of foldable phones in use in the world are in China. So that's going to be pretty successful for Apple there, I believe. But I'm really into the size of it. I'm really into how you have this small thing that can fit in your pocket and you open it up and it's about the size of an iPad mini. So all in all, pretty pumped for this new device and looking forward to getting my hands on it in just a few weeks.
Every Sunday, Mark publishes Power On, and I really recommend you subscribe and read it. Packed full
I'm kind of excited to see what they do with that as well. There's a rumor that it won't have a crease, which I'm very curious how they're going to pull that off. No crease. That'll be fascinating. Okay, so... Okay, let's go look at the NVIDIA deals. Okay, here we go. So NVIDIA just posted this. NVIDIA's Grok 3 now in full production with world-class speed for agentic AI. This is obviously direct competition to Cerebras. So NVIDIA today announced that Grok 3 LPX is the interactive AI inference accelerator. That's a fancy way to say our Cerebrus competitor, is now in full production, an extension of the Aruba platform. The Grok 3 LPX delivers a major boost in AI inference by enabling ultra-fast token generation for highly responsive agentic systems. This is the core thesis behind... Somebody says, Gus says, Kevin, do you feel you're over-invested in the current market? No. I mean, yeah, I think you should look at, like, just look at the numbers for reinvest, okay? Because, like, I run the company. It's like, let's understand current allocation, okay? So, here, why don't we break it down for you? Ballparks. All right. It's a good little topic. Gus wants to know about money allocation, so let's answer his questions. How am I allocating capital at my company called Reinvest? If you couldn't guess, that's what the shirt says. The whole idea is make money and then reinvest it. Get it? Simple. All right. So, companies probably, if we have, call it 100 mil of real estate and other assets. So those are going to be liquid assets, treasuries, cash, or whatever. It probably breaks down roughly like this. I'd go about 80 of that is going to be direct real estate developments, accessory dwelling units, apartment buildings, single-family homes. And most of this, I would say the vast majority of this, is in very competitive areas. So whether those are speculative builds in really desirable areas like a ski and ski out area, or Southern California coastline is another example. Obviously, that's not where ski and ski out is, right? But really desirable land where people want to be there because of the weather or the proximity to a mountain or something that gives it more than it's just a roof over your head. It has some sort of draw to it. That's where the vast majority of our real estate is. The reason the vast majority of the assets are exposed here is because, in my opinion, the real estate market is going to set up for this ridiculous boom after the next cycle downturn, which, in my view, is not real estate. It's more likely to be stocks, AI. Unfortunately, as AI spending slows down, I think you could have that sort of cyclical downturn, and it's going to be painful. But that's okay. We'll, buy the dip through it. And it can include stocks as well. But my belief is there are 3 sectors that really, really take off after the next sort of crisis. And I think they have different buying opportunities. The 3 sectors that I think really take off are, number one, the mortgage space, because I call this practical AI. So I call it PAI. It's your practical AI application for how many thousands of mortgage applications and people's paperwork and their social security numbers and their tax returns and their W-2s and all that bullcrap. How much can we process, how quickly with AI to give you the best loan at the best rates as quickly as possible, right? So I actually think mortgage practical AI is going to be huge, as well as real estate AI that's practical. So, for example, Reinvest is building and has out a beta version for our Homes AI product. And really, and the point of this is not to be a pitch, it's just to show you how practical AI could actually work, is rather than some kind of chatbot, you actually have a tool that goes through listed properties and says, hey, here's a deal you should pay attention to. We think, based on our artificial intelligence, we estimate this is what the renovation is going to cost. Based on our AI, this is how much of a fixer-upper we think it is, and here's what we think the after-repair value is using our own algorithms that we've trained. That then gives us a practical tool, because now I could look across the entire country and pull up a thing, hey, I'm going to visit this county, show me the best deals in this area, and then I can napkin math underwrite the best deals on there to fact check, because you should always fact check your AI. And that is called practical AI, right? I could do more loans, I could do more real estate deals, I could operate faster as an agent or broker, investor, or whatever, right? Then I think the next practical AI place is actually healthcare. So that's healthcare PAI. You know, the companies like Moderna that's got its therapeutic cancer solution, basically, in partnership with Merck, which just, you know, was one of the first cancer treatments to go into phase 3 that is based on artificial intelligence mutation mapping to take what used to take scientists 2 months to do for one patient and turn it into a few hours for one patient. And now you could really scale up vaccine therapeutics before the patient dies, which is really important because you're in a race against the clock. AI is enabling that. You know, this is just getting started, practical application in healthcare. And the practical application is also software. So software AI, whether it's cybersecurity or artificial intelligence in bookkeeping or, you know, police body cameras or whatever, these are the 3 next sectors, in my opinion. Now, unfortunately, I think that if rates go to 0 at some point in the future because there's another crisis, unfortunately, stocks end up getting hammered between now and then. And the time to buy the stocks is, you know, potentially in the future with a heavier hand or a heavier allocation, right? So of this 80 in real estate, you know, maybe it's probably closer to 83.5 if I want to be a little bit more exact. I'm just ballparking here, okay? Call it about 16.5 ballpark is going to be cash and securities, and maybe about, I don't know, 9% of that is in stocks related to some of these visions. And so you could see that the company's got like $15 million in cash for developments in real estate, and you can see the real exposure is real estate. And so a lot of people say, oh, well, you know, you're just bullish on real estate because you're so allocated to real estate. But you have to remember when this company was formed and why we're building what we are, because I think that, like, I respect people being jaded. I feel like I'm jaded myself as well, like a jaded person. But that's good because that's how you protect yourself, right? But I started this company in June of 2022, and that's because I had a thesis, and the thesis was, and you know this, if you've been here for a while, you know this, by 2032, rates will be lower than they have ever been before. That's my thesis, right? So I built the company on a 10-year thesis, and I thought that the time between June of 2022 and 2032 would actually be a time where a lot of people look and say, oh, I don't want to own real estate, rates are too high, which is exactly why we're buying real estate with cash. We have no bank debt on that portfolio, right? No bank debt, that's huge, right? So it's like, you're not getting margin calls. It can't be done. So that's really incredible. So that's where the thesis comes from and the allocation. And I think, you know, when and if rates do come down, there's a really big opportunity, not just in real estate, but also I'd pay attention to it, PAI, practical artificial intelligence. And that's why, like, I didn't know when I started the company in 2022 that we would, you know, build out our software and eventually license it. Like, we had, back then we called it our wedge finder. It was a neural net to help us find deals. And, you know, this is something that I've actually been training this software since like 2018, you know, back when we called them big data and neural nets. You know, now it's all like AI and your custom algos and stuff like that. But I never thought we'd be licensing out, you know, real estate software or stock software or whatever. And that's just sort of in addition to what we're doing. But that's also because of my belief that the next cycle is the big winners, so the practical AI application layer. That's different from the infrastructure layer, right? The infrastructure layer builds, right now it would appear for a lot of software stocks in the bottom, the infrastructure layer comes first. And then the practical AI application, you know, the real profits and the boom comes in the future. So I think that's really cool. But so, you know, I think it's worth looking at that. And, you know, it's obviously not personalized advice for you, but it's just a way of saying, hey, I think there are opportunities in stocks and there are reasons to have little allocations or smaller allocations to some stocks that could do really well. over the long term. But I mean, those are more like upside hedges because like, let's say rates don't go down to zero and the economy just booms for the next 15 years. Well, then a little seed of equity allocation can boom into, something that performs quite well over the next decade or 15 years. Let's say there's a robotics revolution or we actually get to AGI and the economy just booms even more because of that, right? Great. It's sort of like why people have a little bit of a Bitcoin allocation, right? It's like, man, if I put, X% of my portfolio into Bitcoin, if it goes to 1 million, that helps offset everything. And if it goes to zero, it's a smaller part of the portfolio. Now, I don't have any crypto exposure. There's no crypto on that list. I got enough in the little seed of the stock market exposure. I think we are closer to a near top in the stock market. And that's not me being bearish. I'm super bullish on the companies that I like being exposed to. But I think that if this is the cycle, okay, think about when I launched a fund around stocks, an actively managed fund around stocks and a venture capital company around stocks. That was in 2022, in like November of 2022. That was the chip bottom. And that's what we were allocating to. Or the venture capital company that we started in 2023 that went into robotics and SpaceX. Those have been, 3 to 5X's, which is great. And I think now, unfortunately, we're probably closer to near top on stocks. So I think, there's still room and who knows, maybe we'll S-curve up, we'll get robotics or whatever. But I actually think during that same time, real estate in certainly transaction volume has come down, but some of the overbuilt areas, you've actually seen price declines on rents or prices in the less desirable areas. And so the pain of interest rates has already had its impact in a lot of markets. And I think that's now behind us. And we're sort of here in real estate. So I like buy low, sell high, right? So I would say real estate's probably somewhere here. And people are free to disagree with me. And I think stocks are somewhere here. And you might even make the argument that we're somewhere over here, right? After what you saw in June and July. So, I'd rather be more allocated here than here right now. That's it. Simple thesis. I think it's good, though, to map that out clearly. So that way people know, like, oh, okay, got it. So, 9% securities, 91% cash, in the cash and securities bucket, calling treasuries, obviously part of the cash. And then out of the whole bucket, cash and securities is like 16%, 16.5% or whatever. And real estate, market value real estate is like, 83.5% of that. And so that just shows you, I guess, where my longer term mindset is. That doesn't make me bearish really on stocks. It just makes me more bullish on real estate. We can be bullish on both, just more bullish on one over the other right now. Hopefully that answers your question. So Gus says, fair allocation investments is wise at the moment, high risk environment at the moment. So Gus thinks we're in a high risk environment. Yeah. I agree with that. A lot of reasons, for volatility and a lot of concerns. Yep. Fair. So awesome. Cool. All right. Let's go see what else we have over here.
To show that how important it is, especially I think you have a platform where you can trade futures contracts tied to stocks or things like pre-IPO. These are all happen in the U.S., but these platforms that are only allowed outside the U.S. that just, I think logically speaking for these people, it just don't make a lot of sense. So I think there are a lot of them pushing regulators, I think, to be more innovative and to allow these kind of markets to be legally offered here in the States.
Bloomberg's Miguel Shen with the story. Thank you very much. Now, coming up, a South Korean AI startup aims to create K-pop robot idols backed by industry veterans like G-Dragon. Got the details next.
That's a top. That's a top.
For GLP-1s, I don't know. I can't speak to that. Is it a trend for us to continue to improve the quality of beef? You bet it is, because we have been working on continual improvement for generations, and we're going to continue to focus on making our cattle better and making that quality of beef even tastier.
Oh, yeah. The cows we slaughter are gonna be even higher quality than ever before. You should see the drugs we give them. Sorry. That doesn't sound bullish. Oh, look at that recovery on the Qs, by the way. That's nice. Look at that. We just really popped off here in the last, actually about last 20 minutes here. Nice little pop here. Let me see what's going on over here. So we've got U.S. eyes China overcapacity tariffs of 7.5% before Trump Xi Jinping talks. Okay. Great. Okay. Let's see here. That's really it. U.S. Okay, we see that. We see that. Kraken investigating issue with token deposits. Oh, Kraken. Not Kraken again. Okay.
Jackson Hole later this week will get his expectations for Fed Chairman Warsh's keynote and rate policy at large. We're back in a moment.
Is this how you're hoping to retire?
Okay, let's go. I want to look at this bond issuance thing. This is interesting. So I got this. Let's pull this up. So this is average coupon by bucket. Oh, that's interesting. Okay, there we go. So now I've got these grouped into 40-year debt, 10-year debt. Well, that's weird. Why does it show up like that? Let's fix that. This is... Oh, there we go. That's issuance. Okay, we know that. Okay. Fix that and come back. Frickin' knuckleheads. Okay, we'll come back to that. So, ooh, Bloom just went positive. Look at that. Very interesting. So, Bloom's been on a little bit of a downtrend. But did just go positive on the day. It was, I mean, that's quite a bit of a reversal. Let me see here, because how much was it down? It was down at, wow, it was down at 185 this morning. I wonder if somebody got liquidated. 185, so 207 divided by 185. That's a 12% swing. That's crazy. Let's listen in here for a moment.
K-pop. Bloomberg Asia entertainment reporter Sohee Kim reports from Seoul.
As much as Samsung and SK Hynix have thrust South Korean markets into the spotlight this year, the worldwide popularity of groups like BTS and Blackpink, shows like Squid Game, and beloved romantic dramas have been an economic boon long before the meteoric rise of large language models. Music, films, video games, and other Korean cultural industries generated over $113 billion in revenue last year and more than $15 billion in exports. They employ about 690,000 workers, more than double the combined number at the memory chip giants. South Korea's entertainment sector has grown more experimental and ambitious as competition intensifies. One startup looking to disrupt K-pop's traditional idol system is Galaxy Corporation. It's looking to blend AI characters and life-size robot idols to create content without the limitations of human performers. CEO Choi Young-ho says they are not looking
without
to
the limitations of human performers. Yeah, so now we're gonna have robots. We're gonna have robotic Taylor Swift. Man, this is just getting ridiculous. And there are now startups circulate. It's way too early. This is the peak robots. So that's it. Sell the robot shares.
For 10 years of preparation that humans need. That's how AI is changing everything.
Galaxy was founded in 2019 and started as a TV production studio behind the Netflix hit Physical 100. Its current roster includes K-pop superstar G-Dragon, actor Song Kang-ho from the film Parasite, and San Francisco Giants right fielder Lee Jung-woo. Galaxy has now opened a 16,500 square meter robot park in Seoul, where visitors can interact with around 50 different types of robots. Toy plans to open new robot theme parks in other major cities, including Dubai, and run a robot idol tour from next year. Among its partners is Unitree, China's first publicly traded humanoid maker.
Even if the hardware, the robot, is made in China.
Unitree just went public, and they've, after their initial sort of like IPO discount, they've really gotten beat up. Let me see here. Unitree. So yeah, look at this. Kind of just keep going down here. I mean, they are off peak, almost down half now, which is pretty remarkable. But it's not surprising. They underpriced these IPOs so substantially, and it's mostly because they want to market. But then you also wonder, like, how much money are these companies leaving on the table? Oh, that is interesting. Yeah. There is a note that, like, this filing came out like 48 minutes ago. But, no, it's a couple hours ago now. Nancy Pelosi buys Bloom Energy and Intel. And so we've got 1 to 5 million in shares for Bloom Energy. And then in the money calls at $100 1 year. About 15,000 shares of Bloom Energy. Wow. Okay. Let's see. Okay, let's take a look. So, 15,000 shares at 207 now. That's $3.1 million of exposure to Bloom Energy. Okay, let's see what the financials are sitting at on Bloom. That'll be kind of fun. Bloom Energy Investor Relations. Let's pull up Bloom and do some numbers on Bloom. Okay, let me pull up the financials and we'll do that.
Something like 84% of all applications now are run through AI. So effectively, there's that huge kind of baseline, and the applicants who can kind of succeed that are basically the ones with the human skills and the ones who kind of really craft.
This is probably about hiring. Like, I mean, everybody's using AI, but the question is, how could you stand out and not solely rely on AI? I think that's where a lot of people get hit. If you sound too much like a robot and you're only relying on AI, well, then I may as well just only use AI myself. Like, what do I need you for if you only rely on AI? So you kind of have to, like, in hiring, prove your skills. And it's hard, but beyond AI use.
Kind of rely on AI, they've got to all think of ways, that they don't get cut in the first cull just because, quite intelligently they're using the tools available to them.
Bloomberg's Tom Metcalf in London. Thank you so much for joining us. Now, coming up, we're going to get back to NVIDIA as investors prepare for the Super Bowl of earnings season. Stock down 2%, down for a 7th straight day. We'll have the details. This is Bloomberg Tech.
All right. Okay, so Bloom Energy, pulling that up. It's taking me a second here to get it. Okay, we got that, we got this. And then we could run a valuation on this puppy too. And then we'll come back. We still have to do like Google debt and stuff like that. A few little things on the table here to work on. Okay. Here we go. So, Bloom Energy, their last quarterly was... So this purchase was done on July 24th. Oh, right during the Leopold. So she bought the dip. Did she? July 29th. Yeah. That's basically right where we are now. Right there. July 24. Right here. So that was high on the day was 218, low on the day was 183, which is very similar to what we just saw today with the low at 185. And then the high could end up going all the way up to 218. Very interesting. So now the Pelosi trackers got to buy in on the Pelosi positioning. Okay, so Bloom, their last quarterly was July 28th. Okay, let's go take a look. Bloom Energy, BE, 10Q. Okay. So, okay, here's the balance sheet. And then here's the income statement. And there we go. That's where I want to start. Cash flow. The cash flow statement. All right. Big dollar hollers from their fuel cells. This is expected. Stock comp almost doubled. 2x. Okay. So this is inventories. That's fine. Receivables. Okay, nothing crazy here at first glance. What is this? Investments in unconsolidated affiliates. Subnote 11. What is that? Represents related party investments in unconsolidated affiliates. Okay, so see note 7. What is that? It's in unconsol. Let's go find out. It's note 7. Here it is. The company and Brookfield Asset Management entered into a joint venture which are housed in an AI infrastructure fund. Okay. AI infrastructure fund. AI fund. We account for each investment. Brookfield. So, $68 million exposure into the fund. And there's some additional commitments. I mean, $68 million relative to their income of $1 billion. That's not that big of a deal. So this is the AI fund commitments, about, call it 90 million total exposure with commitments, with leftover commitments. Okay. Here I've got debt payoff of 11.8, but we're issuing stock. So paid off about 13, 14, almost 14 billion in payoff. But 23 billion in stock issued. So we're issuing stock, which makes sense that you're issuing stock, and you're issuing a lot more stock now in the first 6 months of 2026, probably because the stock was at basically highs. Yeah, I mean, you went from 100 to, now 200. The stock's doubled. Fantastic. Oh, good on them. I don't see 12 million in purchases for Bloom Energy. The filing I have, I see 10,000 shares and 5,000 shares and call options. That's all I'm seeing right now. But either way, it is It's millions. So, which is a common theme right now is energy exposure. Contract assets, inventories. Plant, property, equipment. So we do have free cash flow. Still 222 mil of free cash flow in 6 months, which is about 444 mil of free cash flow annualized, which a market cap for them, $60 billion market cap. So 60 divided by 0.444 equals, okay, I did that wrong. 60,000 divided by 444 equals, oh, I guess I'm not doing that wrong. Oh, I know what I'm doing wrong. Duh. 0.44 divided by 60 equals. There we go. Yeah. So less than 1% free cash flow yield. Lower than Palantir. It's pretty low, especially since, you know, some software companies will have a cash flow yield of like 7 to 13% right now. Okay. So balance sheet is right here. They've raised some nice money, man. 2.67 billion in cash. Restricted, I care less about those. Here are my bills. I've got deferreds are 327. So let's add this back in. Okay, 1123 minus 327. About, call it 800. 800 mil bills. And if I go over here, I got recourse debt of 2.4 long. 2.4 bill long plus MISC. Okay, so I've got enough cash, plenty of cash to pay my bills. That's why they raised money, is because they still have that long-term debt. And, you know, now they've got plenty of liquidity to pay their bills. How much did they raise? They raised, oh, they only raised $23 million here. So it's actually a relatively small set of issuance. It's not that big of a deal. They've got plenty of cash. Okay. So here's... let's see here. Looks like Tesla's giving up to a $10,000 tax deduction. Oh, really? I want to finish this analysis, but I want to look at that really quick. Let's see here. I am noticing more people using my affiliate link to buy the cars. What was it? It's meetkevin.com/Tesla. I'm pretty sure that's what it is. Meetkevin.com/Tesla. Because there was a while there where, oh no, it's not that. Oh, I wonder what happened to it. Oh, I gotta figure it out. Man, it's not that one then. Oh, metkevin.com/Tesla. Duh. M-E-T. metkevin.com/Tesla. But yeah, they brought it back, which is cool. Order with the referral code, and then you get, I guess now they're doing $400 off solar panels and power walls and 3 months of FSD. I mean, it's better than like the 1 month, but referral applied. Oh, that's cool. Okay, so let's see here. If I look at where did you see this cash? We were looking at the all-wheel drive, right? Oh, that's there are various different all-wheel drive models. Monthly subscription. Where's this $10,000? Show pricing details. Yeah, I guess I don't see that. It's under finance only? Oh, financing credit, huh? Let me see. So that's really like an interest buy down, huh? Destination fee, order fee. I don't see it here either. Maybe you got some special tax credits in your state. Anyway, let's go back to Bloom. Here. Okay, so revenue for the company is more than doubled, right? So hop in here. This is, we're up, divided by 401. We're up 2.65 X on revenue. Cost of revenue is 709.7 divided by 294. 2.4x. So some pricing power there, right? Like the revenue is accelerating faster, but not much faster. Product costs went up. Actually, that's negative PP right there. Ooh, 2.99x on product costs up. So really, service stabilized. Installation went up, divided by 38.2. No, installation's only up 38%. And service is up a fraction as well, 14%. So product, basically what's happening here is they're able to sell it for a higher price, but the costs are also higher. So they're able to sell for higher prices, but costs are higher at a higher rate than price increases. And install/service not growing as fast makes gross margin look like it's improving. Because, yeah, obviously the cost of installing those aren't skyrocketing. The labor stays pretty similar. G&A, I mean, this is fine. 173 divided by 110, more marketing, everything. This is fine. 57% here suggests pricing power as well. So that's pretty good. Yeah, let's look at the forecast on the valuation for them, just to see what the suits are forecasting, and then we can actually jump in on what we think this company's worth. So let's see here. Loom. Fundies. Okay, here we go. So EPS projected end of 2026 is 255. Forward growth 4 years is 84.75. That's phenomenal. Plus 58.29 plus 2897 plus 2503 equals divided by 4 equals, I mean, projecting 49% growth, obviously tapering off to about 25. So call it 50% growth on 4 years projected, tapering to 25%. So if I now, let's see here, margins, gross profit, their margins are still in like the 35% range. It's very good, even though they're a manufacturer. So let's say you could go with like a, I don't know, just go with like a 2.4, maybe not that high, maybe like a 2.2 peg. That could be interesting. So let's see what this puppy's worth. If I go with 2.55 times 2.4 times 50, I get to about 306, which is pretty good. Suggests upside. At 2.4 peg. Okay. So let's see here. I'm trying to think of growth forecasts for this. Okay. That's at 2.4. If I now run it at 25% forward growth, at 2.4. Oops. 25. Dang it. Okay. 2.55. Well, I mean, it should be half, so it'll be like $150 times 2.4 times 25% growth puts it at about $153. So that's interesting. Let's see here. So it really comes down to where you think growth will stabilize for the company, which that also then plays into the Anthropic situation. Because, you know, if they could keep booming and the services they're providing, great. The forecast growth we have, yeah, 50%. That sounds right. Is a manufacturer. So it's possible that could be too aggressive. And then forecasts on earnings are right. So let's do, this we'll call it an aggressive, you know, aggressive, more software level, you know, 2-4 peg. Right, because software, high margin software, high margin software, 2.4 to 3, maybe slightly above 3 for software. I might be a little aggressive with this. And it also depends on how these margins sustain. Because if the margins compress, because what's driving revenue? Let's find out. Is it pricing? I mean, obviously unit growth is happening, but let's go look a little bit. Revenue. Let's see here. Revenue. Oh, they have a partnership with Oracle. That's also very interesting. And Oracle got options to buy 3 million shares at 113. Oh, lucky them. Okay. Good for them. So they're nicely up on those warrants. That's very good. So they made a good buy there. The AI infrastructure fund is a little bit circular. We know that. Here's their debt. Their debt's a 0% convertible. Are you kidding me? Oh, that's so nice, dude. Look at that. $3 billion of a convertible. That's 3 months ended here. Yeah, and then they paid off a bunch of... They actually paid off a bunch of their 0 convertible. Wow. Kind of surprised by that. But anyway, that's great for an interest point of view. Okay, somewhere here, I should see a little bit more on their revenue commentary, but I think I missed it. Yeah, I'm already at subsequent events. I mean, now every company does this a little differently, but cap calls, we saw the Oracle piece, the loans, the joint venture, we saw that. This is all balance sheet crap. That was Oracle. Oh, I really must have missed it. They don't exactly make these documents really easy to read. No, it must still be down there. Stock comp, contingencies, income taxes, subsequent events, credit facility, operating income. There we go. Oh, I just saw it. And I screwed it up. Come on, Kevin. Operating activities. Higher level of new deposits, mix of system, lower proportion of projects without significant upfront billings. Ah, interesting. So I always think that's interesting. The more of these upfront deposits, that's not necessarily good. I dislike too many upfront deposits because it suggests most of the W is already on the cash flow statement, right? Like, you're already pricing in, oh, look at their cash flow. But if those were upfront deposits, that's less ideal, right? Deposits, the timing of vendor payments, that's for their cash flow. Inventory increased, and their cash flow yield's already very low. Delivery and installations, revenue. Wow, it's all the way down here is where they talk about it. Total revenue was driven by higher product revenue, And an increase in services revenue. Yeah, they're not going to talk about why. Increase was primarily due to stronger demand for our power solutions to meet the time to power needs of the growing market. Significant deployment for larger AI customer and multiple projects through joint venture with Brookfield. Well, that's the circular revenue part. Yeah, I mean, but that makes sense. Yeah, projects. Okay. So cost of revenue, cost of product. Ah, the stock comp was in there because we saw that stock comp get boosted. But they're actually seeing more manufacturing efficiency. That's interesting. So stock comp hit the COGS. As well as, I wonder if they build that into like sales commissions, right? That is interesting. Okay. So if I now go to the income statement and if I give them a lower margin, like let's go with, if you go with a 1.6 peg ratio, right? So like, you know, 1 peg, dirty, you know, 7% margins, 1.6, call that your 35% net, let's say. Let's run it at that. Let's go 2.55 times times 1.6 peg times 50% forecast growth. I'm at 204. 255 times 1.6 at just 25%, get to about 100. So, you know, if we price this, the upside here, you have to get pretty bullish now to get to 300. I get why there's a lot of excitement, and it was at 300, but to really justify that 300, you'd probably have to see higher margins. And this spend just continue. So there's definitely some risk baked into this one, especially now with the Nancy Pelosi trade. You know, people get really excited about, you know, the insider trades. But that's interesting. Let's go look at their earnings call briefly. And in the meantime, let me also go see what else is going on the Qs. What are we still down? 72 bips still. Still lower than we were at the open. Okay. So now, quickly call the earnings call. We're going to cheat a little bit on the earnings call and just get some bookmarks to go through. Yeah. Bloom Energy social media volume quadruples. Yeah, because everybody's talking about Nancy Pelosi. That's hilarious. Nancy. Okay. Let's get that beamed over. Okay, Bloom Energy earnings call. I'm gonna write that down too. I think that's kind of funny. Volume 4x. And then let me run this through really quick. Okay. Stock. Bloom. So, let me see here. Okay. That's fine. One sec. All right, sorry. Okay, good. That's done. So now let's look at that earnings call. and see what juice we have in here. I really want to see like order forecasts. So, because I want to see that growth rate. I'm going to type in forecast. No, how about the word growth? Okay, we do have the word growth. Tailwinds of rapid TAM growth and increasing market share. That's really good, right? So bullish TAM. Then I've got, consequently, we have visibility and conviction of the growth trajectory into 2026 and beyond. You control the cost of the Model T, blah, blah, blah. With that in mind, go through some of the numbers, whatever, blah, blah, blah. Margin expansion, which should continue to drive margin expansion. Yeah, that's the key. They're already guiding that. That's what you need to really push this higher. Or the valuation higher. But that's still very good. It just probably justifies closer to a 1.6, 1.7 peg as a manufacturer. Operating margin of 21%. What is this? That's gross margin. Operating margin closer to 21% is their guidance. Well, hold on a sec. What do we got over here? Income statement. I've got gross profit. Yeah, there's that 30. Well, that's a little, what, 35.5 divided by 10.65. That's 33 on the gross. So 33.3 gross guiding 35%-ish. Okay, and then on the net, they're bringing about 198 divided by 1065. 18.5% net. Ah, yeah. Yeah, that's, you know, that's why the forecast peg, it just can't be this high. So it might even be lower, right? Because they're actually closer to 20%. 20%, you know, might be closer to, call it 1.4. Let me just run that math really quick. I'm curious about that. 255 times 1.4 times 50, 178. 178.2. And then 255, 14. What? Yeah, half. 89. So it really depends on the multiple you give this. What peg do you want to give it? Yeah, 18% net. They're guiding 21%. Okay. That's growth. Let's look at 8 years ago, 21%, negative 21. Yeah. See, like, they literally talk about margin swings a lot too. They know it as well. And so you're on an upswing right now, and that's why the stock is performing so well. Let's look at the bookmarks. Months of AI compute, blah, blah, blah. But, okay. Legacy backlogs are until 2029, right? This is why we need more Bloom Energy backlogs. Customers can get air permits with our technology faster than they can with combustion alternatives. Yeah, because you're talking about months instead of years. Okay. Resilient supply chain. Whatever. Okay, what do we got here? That's the EPS growth, guidance mix. Okay. No, we've seen this. Don't care. This is pretty boring. Okay. So nothing ridiculously exciting there. Obviously, a lot of trade attention is going to come into Nancy Pelosi's disclosure. Okay. Let's see. What else? Any technicals we have on it? Let's pull some technicals on it. The Qs are still recovering. We're back to market open pricing right now. So that's good. We, you know, it makes me think somebody got liquidated. Like, I mean, not as bad as Leo, right? But you see those crazy sell-offs at the open. It's just weird. But that's okay. Okay. Bloom Energy has only recently been positive on net margin. That's true. I mean, they lost money 21, 22, 23, 24, 25. Wow. Okay. Let me see what else I can get here. I'm just looking at some historical data. Consensus estimates for net margin do take them up to about 22% by 2028. That's kind of where you top out. Okay. Okay. Let's write that down. So income, we've had negative margins, you know, 2021 to 2025, just went positive, top out at 22% in 2028. So there's a limit here. These are pricey to manufacture fuel cells. So it's kind of hard to actually... It's like you're never going to turn into like a software style margins, right? You're a manufacturer. That's just the way it is. Will there ever be a millennial money revival? Probably not. I think it would have been cool if we were like all living in Vegas. So basically, I just needed to move there. And, you know, everybody was together. I think that would be the way to do it. So I'm a big fan of in-person. You know, virtual was cool. I mean, All In still does virtual. So I don't know, maybe maybe it is okay. I don't know. Yeah. It was a cool time. Okay, so let's put some bottom lines together on this. Because this was a lot of intel. While I do that, let me listen in over here and multitask.
We have truly a new regime who's going to be more product driven. So I own some.
Your mom's a new regime.
I'm going to stay there. I want to see what transpires, but to me, this is always going to be the safe play in technology.
Well, he's still, as Tim Cook's going to be breathing all things.
I mean, see, they make great margins. Actually, honestly, you could kind of compare Apple to Bloom. But Apple probably brings down from memory closer to 35%. So Apple justifies a higher peg than these guys do. I will verify that in just a moment. So let's see here. Apple. Okay. Hold on. I'm still grabbing some of these screenies here. Okay. Let's go. That's the Oracle doc. We saw the Oracle note from them. Deposits, the upfront deposits. Upfront deposits coming in as deferred revenues. People always end up seeing that in their cash flow statement, and then they're like, look at all this cash flow. But, you know, that's less than they're going to get up front because they're deposits. And that's the whole point. That's all right. Bloom Energy. So the big thing was bullish TAM. I'll just finish screening these. Bullish TAM. Let's Let's grab this. This was their guidance. This was their operating guidance. So gross margin, net margin, margin swings all over the place, and the talk about backlogs. Okay, perfect. So let's put all of that together and come up with some bottom lines. And Apple's becoming more of a service business too. And those margins are very high. Okay, so Bloom Energy. Drop their data in here, and then we can really break this down a little bit. All right. Boom. Send all that through. Okay, so Bloom, I would argue that it's a really critical hardware play coming out of negative margins, right? So critical AI hardware play coming out of net negative margins. The upside to margin is limited due to high manufacturing costs. We see some of that in the income statement already. Therefore, justifies a lower peg than, say, an Apple. What about... Let's see here. Let me pull Apple really quick. I think this would be a useful time to do that. Investor relations. Apple. Come on. Uh-oh. It's frozen. Come on, Apple. It's not that hard to load your SEC filings. Apparently it is. Stupid thing's frozen. Can't do anything on it. Okay, fine. Restart the Google Chrome. That's a bummer. But it's okay. That's technology for you. Time to buy a Dell. All right, let's try again. Apple. I can't believe trying to load Apple's investor relations ended up crashing Google Chrome. Okay. Here. So net sales, I've got gross margin. Yeah, see, look at that gross margin. 54.7 divided by 109.4, but that's heavily because of software. That's 50%. So their net income is, their net is 27. So actually you're getting closer to Apple. Theirs is really propped up though by services. Because Apple's products, 47.1 divided by 78.6, cost them 60%. So I got a 40% gross margin. Okay. So 40% gross margin versus like 35. Yeah, you're getting there. You're getting there. Okay. All right. I think that's a fair comparison. So I would almost call them like the Apple of AI infrastructure to some extent, minus the software part. So I got to rewrite this. Bloom Energy BE. Gross margins on products are approaching Apple. Apple last Q gross margins are 40% on products. Bloom gross margins are on products 593 divided by 935, 63.4, 36.5. 36.5% on a product. So it's actually similar to Apple. Benefit for Apple, so call it a peg booster, is the extra services revenue that Apple has, which Bloom Energy really doesn't. So, you know, Apple's going to get that extra ARR that Bloom just won't. So currently, currently it's trading for, what are we currently trading for? We're trading at like, call it, what, 205 or something like that? Let's see the current valuation. Bloom Energy. Yeah, 205. Okay, 205 divided by the forecast of 255 in earnings. Currently trading for 80x earnings with 50% average 4-year growth, 25% tapered at end of that 4 years. So the way I would usually do the math is that right now it's trading for 80 divided by 50, it's trading for about a 1.6 peg. That's, you know, without a big services component, that's fair. You know, the upside is limited. Upside is limited outside momentum, right? So I'd go pricing power, yes, though, so I'd call it greenish. Greenish. Stock comp boost, somewhat hit pricing power. The potentially on sales incentives, right? Okay. The balance sheet, momentum, and then the valuation. Valuation for the company is yellow, you know, fair-ish. Okay. Momentum on the week chart is mid-range, so call it yellow. And then the balance sheet, they just paid off a bunch of debt, which was very useful. So it's greening. You know, greening, they just paid off a chunk of debt. Their 2030 convertibles. Okay. So yeah, I mean, it's fair what's happening. I don't think it would be something that I would jump into just because I think it is very momentum driven. Short-term pop, heavily due to Nancy Pelosi 15K share plus options. Disclosure July 24. That day, the stock traded between 184 to 215, I think it was. You know, we saw it get down to 185 today. Okay. So let's put that into Bloom. And let's make sure we also have the current estimates for it. Bloom Energy, just a little bit higher. Cool. All right, so that's Bloom. Huh, okay, we might do like a little summary on that, but I want to look at Apple for a moment. See, in Apple, think about Apple, I mean, Bloom's growth is insane. Apple's growth is significantly slower, but that's already factored into the EPS growth level. Because just for comparison, let's put Apple in as a comparison. APL. Apple valuation. You know, just to compare. So Apple's trading for like 310, call it. 310 stock. Forward EPS, I'm cutting this off. Forward EPS for Apple is, let's find out. Let's see what their forecast is. Let's change that to APL. Okay. $8. $8.80. Okay. So $8.80 for Apple's EPS. $8.80. Forward growth. Yeah, it's only like 10%. 8.61, 11.21, 8.55, 9.62 divided by 4, 9.5%. Projected EPS growth. So that puts Apple at a $310 stock. These are at totally different parts of the growth curve. 35x PE, and if I divide that by 9.5% growth, dude, this is trading for a 3.7 peg. Apple is, you know, fundamentally overvalued at this level. I mean, I hate to say it, but, you know, Apple could probably be trading for closer, I mean, with the services biz, what are their net margins? Fundamentally, 29, 30. Yeah, they're bringing down a lot more to the net. 29. Because Bloom's not going to get to these levels. Divided by 109.4 with the service. Yeah, 27% net. Fundamentally, going to drive more net income than Bloom due to services. Maybe that justifies a, you know, 2 peg, something like that, right? That really suggests Apple is over. So if I go 2 divided by 3.7, that's 40%. 40% over fair value at Apple, where BE is closer to fair. And a lot of that, I think, is probably just hype on the CEO transition. So CEO transition hype, maybe. But, you know, you got to execute. So it's a little bit of work to do there. Okay. Okay. Cool. All right, so we'll answer some questions in a moment, but I think I want to do a summary of that. Let me just see if anything else is kind of, or I guess maybe you can always answer some questions now really quick, because I got to fix this anyway. Okay, what do we got here? I'm a new investor, and sometimes I don't understand the full context of your warnings until I get hit in the face. I've stepped squarely into every pitfall you've warned about. Oh, well, I mean, thanks for saying it, and I'm sorry that happens. Has happened to you. Das sucks. But, you know, it just, I know that can seem frustrating, but, you know, just if it makes you feel any better, I always like to say, write it off as learning money. You know, it's like the college education for investing in business and finance or whatever. Because otherwise you just go crazy with like, oh, I made this mistake, I screwed that up or whatever, and then that's depressing. What age did you baby start watching TV? I'm conflicted letting my 8-month-old start watching educational shows. Ours were watching at 8 months. It's just the issue is you just have to balance the time, in my opinion. So really trying to focus on, okay, you know, all right, we're doing 20 minutes of this, and then we're going to go play with Thomas the Train. So that balance, I think, is really important. So I don't think no is the answer, but I do think, you know, it also depends on what. Some of the stuff is just pure brain rot. Some of it is useful, like the counting or the little addition games, or what is this? That's a square. Or like, what color is this? Purple. Like, the kids love that kind of stuff, and it actually does help them. Like I'll see the little babies walk around, and I'll be like, "That's a jellyfish." And it's like, "Oh yeah," because you were just watching like the ocean life version of one of those shows. So I mean, there's some value to that. Just don't want, as with everything, you don't want to overdo it. Okay. So. Okay. Oh, SpaceX is holding on to its line. Look at that. Like, perfectly on its line. It's always scary. It's too perfect. Too perfect. All right. Let's see here. Let's go listen to the boomers for a moment and get a little change of pace. And then we'll probably do a little summary on Bloom. And then we got some NVIDIA stuff to look at. There's a lot to do.
Yeah, to solve ultimately two issues, and that's why it comes to what they're contributing.
On
the one side, we saw this huge convergence going on between public and private, and if we look at what's going on with big institutional clients, they're investing across public, private, active and passive, all in one integrated fund. But the second challenge is it's quite complex to do that from an investment and operational side. The three firms came together to try and build solutions that say, well, let's build integrated solutions that are administratively easy to use. From the Blackstone perspective, they're bringing their deep private expertise. From Vanguard, active core fixed income and index. And from Wellington, two things, our active equity and our institutional caliber portfolio construction capability.
All right, and the one we kind of focus on here is the WVB All Markets Fund, which is a mixture of all that. Let's say I have a portfolio, I'm a 60-40 investor with a little spice. What am I selling to buy this?
So with that, these funds are through a financial advisor. The first thing I'd say is the 60-40 is important. The WVB All Markets is, at its heart, looks like and feels like a 60-40. That's the construct. So what you could do is put it as part of the core of that portfolio in discussion with your financial advisor, if that makes sense. In terms of what it's trying to do is provide a more diversified asset class exposure than a 60-40, so it can fit quite nicely into that.
What kind of demand have you seen from Wellington clients for a product like this?
So we've just finished a trip around the U.S.
Wow, that was boring. Just talking about these stupid all market, this fun, that fun, wow. Loser. All right. Okay. So let's do a quick little rundown on Bloom. Let me just also do a quick little check here on some more of these sticks. So I got Tesla turned red, couldn't keep it up. UiPath is coming up on $17. Wow. That's cool. I've got Cyber softened. I've got CoreWeave. CoreWeave had these fantastic earnings, but man, they couldn't keep it up. Let me go to the day chart here. Yeah. They popped on earnings, and they basically gave it all up again. It's just sort of the data center trade is getting a little rich. But that's all right. It's all a cycle. All right, let me see what else there is on Bloom. Okay, so gross margin. Let's see. Yeah, Apple, I know is, okay, that's about a 75% gross margin on the services. And that's the thing that Bloom doesn't have. Because the more products Apple sells, the more that becomes a sales pitch for the services. So you're really much more concentrated on the manufacturing side. That creates some risk. And that's probably why Apple is pricing so much stronger, right? So Apple's pricing reflects that ARR the products enable. you know, in my opinion. Okay. So the Oracle deal they have is the vast majority of their Q2 revenue. That's really interesting. The Oracle deal is probably one of the biggest risks. So, did they say that? Concentration. Geographic customer risk. Here we go. Yeah. Look at that. During the 3 months, revenue from 2 customers, the second of which is a related party, Note 11, accounted for 44% and 21% of our revenue. Wow. During the prior 6 months, revenue from 1 customer accounted for 73% of our revenue. Ooh. That's really heavy on their AI fund and Oracle. This is almost a supplier to Oracle's drunken debt. Ooh, that makes me more bearish. I'm going to write that down. That's a big point. So, probably the scariest line. Okay, so this is 73% of rev in last 6 months, 1 customer, Oracle, and 44% of Q1 was Oracle. Sorry, that was Q2. So, Oracle is drunk spending, and Bloom picks it up. You know, they're picking up the dollars. Okay, let's see here. Okay. Well, how much is the company short? See here. I've got it's not like really high, but it's grown. Okay. Let's see. Okay. Good. Good. Okay, so yeah. Okay. So this is actually more than just a data center bet. It's like a bet on Oracle. So how's Oracle stock performing? Let's go find out. Oracle. I always think it's funny that, you know, as Oracle stock goes down, you can kind of say like, oh man, they didn't see that one coming. It's just being an a-hole. But, you know, it's like what Elon always says. Fate loves irony, you know? Oh, is the Bessent meeting at 10 a.m.? Thank you for mentioning that. Let me see if I can see. Because I'd like to cover it I'm going to take your word for it. I'm going to try to get this Bloom Energy summary out in 8 minutes, and then I'll pop into what Bessent's saying. If I miss the first 10 minutes, or sorry, not 10 minutes, like the first 2 minutes of Bessent, assuming he's on time, it's not that big of a deal. All right. All right, here we go. Here it is, Nancy Pelosi's periodic transaction report, which is a fancy way of saying she bought the dip and it was probably her husband, but it doesn't matter because dang, they just spent millions of dollars buying Bloom Energy and Intel. In this, we're going to break down everything that you need to know about Bloom Energy, but it's worth noting they spent millions of dollars. I see at least $15,000 worth of share purchases. I see call options that were purchased with a strike price of $100, so well in the money for a year out. They made these purchases on July 24th, so as usual, it's been 2 months. Oh, actually, no, it's been exactly 30 days. It's been exactly 30 days since the transaction, so of course we get the news late. But if you keep in mind what was going on a month ago, you'll remember that that was exactly when Leopold was getting Leo folded. Who knows what kind of insider info Nancy Pelosi had, but that's okay because on the 24th, the stock traded between $183 and a high of $218. That's literally in the strike range for where Bloom Energy is trading now at $205. So, is it a good deal? And should you buy the stock? What even the heck do they do? Okay, let's keep this really simple because obviously it is well down from its high of $351. That is a fall of 61% from peak in the value of this company. So, what drove that? Fundamentals, momentum? The answer is both. So here's the thing about Bloom Energy. Bloom Energy is a fuel cell provider that gets fueled with natural gas and then chemically converts it to energy. So it's a little bit different than just like lighting it on fire, like a gas engine, for example. But what's fascinating about Bloom Energy is they've had really bad margins, and because of this data center boom, their margins are blowing up. And when you look at their income statement, it's really good right now. Now, it didn't used to be. They had negative margins in 21, 22, 23, 24, 25. You get the idea. But now, look at this. Their revenue has 2.65x'd to over $1 billion. Their gross profit is sitting at about 33 to 35-ish%. They've literally got gross margins on their product that are like 37-ish%. And then, of course, you've got like install and some of these other lower margin things. They bring about 18.5% to the bottom line now. And in their earnings call, they're guiding about 21% that they can bring to the bottom line and about 34% that they can bring to the top. Now, why does 34% on gross margin matter for the full year? Well, because that's really similar to Apple, which is kind of exciting because, Apple's a pretty high margin business. We know their stuff isn't exactly the cheap for a pretty penny. But if you go to the Apple financial statements, you'll see that their products also sell for about a 37% gross margin. Now, the thing that's different about Apple that gives Apple a big premium is they sell services at about a 70 to 75% gross margin that Bloom Energy doesn't. So the Apple products that are selling for about 37% margin. So, you sell $100 worth of stuff, $37 goes into the business that they can then spend on research and G&A or advertising or whatever. Then they pay taxes on it, then they get their net, right? They got $37 out of 100 left. That is great, because it doesn't just give you the $37. It leads more people to sign up for subscriptions to iCloud or, whatever, the Life software that they have for music or the subscriptions for any of their other products, storage included. That's a big W for Apple because it's really high margin. Bloom, on the other hand, you have to think of it as just mostly, the vast majority of it being the higher gross margin manufacturing side. The reason that's important is because it caps their net. We're really not expecting to see the net income for Bloom to really ever go beyond 25% because they don't have that services side. They're still making things that cost a lot of money. And these fuel cells are great because you could stand them up in 3 to 4 months, whereas, you know, a natural gas facility at a data center might take you somewhere around 3 to 4 years to stand up. So there's been this huge boom in let's just use fuel cells to stand up our data centers so we can get up and running and lower our time to revenue on data centers, which is really important because guess the biggest risk for Bloom Energy? Their main customer. So this is customer concentration risk, which I think is a really big red flag. That's not to say I'm bearish on the company. We'll talk about a price target in just a moment, but they have got serious revenue concentration. 44% of their Q1 or their last quarter's revenue came from Oracle. And in the last 6 months, 73% came from Oracle. Oracle is, you know, the dirty sort of data center play whose credit default swaps continue to skyrocket because people think they're taking on so much debt, there's a high risk of default. Oracle stock has not exactly been doing them any favors either. If you look at Oracle stock peak to where it is now at 143 divided by 351, which is eerily the same, almost the same top that you had in the mid 350s range over here for Bloom Energy, that's down nearly 60%. And it's mostly because of the debt they're taking on. Well, who's picking up that debt? It's Bloom Energy, which is now getting a big momentum boost because of Nancy Pelosi. Intraday, it's up like 11%, just intraday on this Nancy Pelosi disclosure, riding right here at my 206 line, which is a fib retracement line. And maybe we'll be able to sustain that and break back up, but you could see since June, after the Google and SpaceX suckening, the stock has been falling. Why? It could be visibility into growth. And that's always what's really important about these companies is we try to forecast growth. See, Apple's growth isn't that high, but it's stable. Apple's growth is like 9% stable. And that means they're trading for about a 3.7 peg right now. In my opinion, Apple's actually about 40% overvalued right now because I like to combine, you know, a 35 PE ratio divided by the growth and go, I don't want to pay that much for that growth. Now, there's hope that the CEO is going to help transition the company to more products and more AI revenues, but a lot of that hope is already priced in now, right? Bloom Energy, on the other hand, let's look at the forecast for Bloom Energy. So if I want to go really aggressive on the upside and I give them a really juicy, like closer to software level price to earnings growth level, I could take their forecast earnings per share of $2.55, give it a multiple of 2.4, times 50% growth, I get a 306 price target. But the problem is the growth that's going up to 50% is going to taper off, especially as Oracle buys fewer of these in the longer term. It's expected in 4 years, 3 and 4 years, to taper down to 25%. And so if I run this at just 25% growth times a 2.4 multiple times their earnings per share today, my fair value today is actually 153. So at 205, you know, we're closer to this, but like, what's my upside, right? My upside is expecting that this can keep booming and growing forever, but I'm really reliant on Oracle. So what that means is I need to expand to different customers. I need to sell to Oracle more. I don't want to bet on Oracle, or I need my margins to go up. Margins, they're good, but we're already seeing some of the pressure here, right? Revenue's up 2.6 times and product costs are up 2.9x. So costs are up higher than revenue. And they say part of that is because they had to pay an increase in stock-based compensation on their sales, which to me suggests that like their salespeople are grinding really hard to get those sales and contracts signed. And if I got to pay more than I'm able to increase the prices or revenue, then it just sort of makes me question like how long and sustainable is that revenue. So I'm not saying this is a bad deal. I'm saying there's concentration risk. There's a lot of momentum in it. And the company is growing margins. I got to give them that. They do acknowledge that margin swings a lot. They say it over here. Hey, we've been negative. We went public 8 years ago. In between that time, we've swung from negative to positive. There's so much going on in terms of changing, but we're really bullish on our total addressable market. We think there are massive tailwinds. We're going to be able to increase market share, get more customers. You know, maybe Oracle is just the start. They also have a related party that buys their own products. This is a fund that they basically operate in partnership with Brookfield Asset Management. And so in some of their concentration risks, you'll actually see, hey, some of our sales went to a related party entity. That's their AI fund, and their AI fund naturally buys Bloom Energy products. But again, in the last quarter, that represented 21% of their revenue. So their own sort of circular financing was 21% of their revenue. Oracle was 44% in the last quarter. The quarter before that, Oracle was even more, right? So if you lose the circular part or you lose Oracle, you lose a lot of that growth momentum that we're seeing. Now, hopefully you could just land new customers, but that's the bet that you're making on this income statement. Now, cash flow looks good. Cash flow yield a little low though, okay? We've got about a 1%, less than 1% cash flow yield. You've got Palantir is also about a 1% cash flow yield, very different from a software stock that is going to be trading at, like a 10% cash flow yield. An example of which might be like Salesforce. Salesforce was one of the buy alerts that we sent at about $163 per share. Remember, you can always be part of that over at the Meet Kevin membership. You get all the courses, every trade alert, every private live stream, all the alpha, the fundamental analysis, the technical analysis we do. So stuff like this on a daily basis in our course member live stream. Join us, use coupon code JHOLE. Tax professionals say this could be a tax write-off as well. And use that coupon code before it expires on August 27th. So let's just continue and look at a little bit of their balance sheet. So their balance sheet is decent. We've got $2.6 billion in cash, and I've got $800 million in bills to pay. So I'm pretty decent on the balance sheet. I do have 2.4 in long term, though I will say those long terms are mostly convertible liabilities for 2030 that have a 0% coupon. So it's not like they're dying or drowning in debt here when they got a 0% loan, basically. It's pretty good. So there's a lot to be excited about when it comes to Bloom Energy. And I get it. I get the momentum. I think the technology is brilliant. I think it's really, really smart. But I do think there are some risk factors. And so our stock AI tool, which basically tries to use my brain and tune algorithms in combination with artificial intelligence, gives you a couple forecasts. We'll look at both Apple and we'll look at Bloom Energy. So Apple is very interesting because I calculated before I looked at the stock AI tab, I calculated how much do I think Apple is worth. And I run their peg at what I think a reasonable peg is, like a 2.4, 2.2, somewhere in there. And I think Apple is overvalued to the tune of 40% was the estimate I came up with. My stock AI tool at meetkevin.com shows me at a 45% downside for Apple. So not really excited here just because so much hope is priced in. Maybe that growth rate will skyrocket though. And if the growth rate for Apple skyrockets on new products and foldable phone, then you could justify a higher fair value, a higher terminal fair value for this company. But we're really relying on growth and we're not getting Apple for a discount to justify hedging against that growth right now. If I look at Bloom Energy, I sit at 124 with this target on stock AI. Now why? The reason we sit lower there is because the examples I gave you on the income statement were the more aggressive style pegs. I think 306 to 153 requires a higher net margin that this company is not going to achieve. So more realistically, you're probably somewhere between, depending on what growth ratio you use, between $90 to 178, which means for me, this is more of a short-term trade than it is a fundamental hedged buy at this point. Could be a momentum play, but that's my take on Bloom and Apple. Make sure to join us over at meetkevin.com. Go. Let's now get into Scotty B. Does look like I missed the first 2 minutes, but let's go listen to Scotty B.
On its behalf. They turn a blind eye to seaborne fuel transfers and overland transits. They condone illicit use of their banks, all the while concealing the extent of their complicity. The president is making phone calls to world leaders with specific requests to cease their interactions with the regime. We are already seeing results. Over the weekend, comments from Iranian leadership clearly acknowledged the effect of this campaign, and nations that facilitate any interactions with the regime should quickly heed our message. Those who stand with the United States will reap the rewards of our partnership. Those who tether themselves to the Iranian regime should expect to share in the isolation of a withering regime. Teams from Treasury, State, and the U.S. military are now meeting with their global counterparts to tell them that the United States expects action. Every country has a defined timeline to shut down activities we have identified. If they do not take action, we will do so unilaterally through Treasury authorities. For example, every branch of Bank Melay must be shuttered and dark. And let me be clear, any entity that facilitates money laundering on behalf of Iran will be removed from the U.S. dollar system. The clock just started ticking. The new sectoral sanctions determinations issued today target 5 of Iran's most vital lifelines that it exploits in other countries: digital assets, technology, gold, aviation, and shipping. These measures broaden secondary sanctions risk for anyone foolish enough to continue conducting business with this regime, and will accelerate the speed with which we pursue them. As I speak, Treasury's Office of Foreign Assets Control is also sanctioning over 60 entities, individuals, and vessels around the world that enable the Iranian regime to procure illicit nuclear and missile technology, conduct cyber operations, and generate oil revenue. This is a sustained campaign to collapse every last option for Iran. Let there be no ambiguity as to the position of the United States. An economic engagement of any kind with this murderous regime will expose those responsible to the full reach of American power. For decades, this regime has drawn strength from a calculus that regards Iranian retaliation as certain and American enforcement as negotiable. Under President Trump, that era is over. To the ordinary soldiers supporting this regime, as more and more of your paychecks stop or are supposedly just delayed, ask whether your commanders are leading your country to triumph or to ruin. And recall that the Berlin Wall fell when ordinary soldiers decided not to shoot at their own people. And to those who enable Tehran, do not discount the cost of testing Washington's resolve. No nation should expect to enjoy the rewards of our system while helping those who seek to destroy it. It is now a time for world leaders to make a decision between prosperity and isolation, peace and terror, America and Iran. The campaign we begin today will gather force with every day that follows, and it will not end until this regime stands alone. With that, I welcome your questions. David from Reuters.
By the way, if you're not using it yet, you could also see this on the Alpha Wire, these headlines from Bessent coming through here, right?
You have at your disposal is the ability to impose secondary sanctions on banks and financial institutions that facilitate transactions for Iran. Chinese banks have often been talked about being targeted, but we don't see any of those institutions targeted here. Is that something that is coming in this campaign, or is the very delicate trade truce with China something that could prohibit you from going that far and taking that very big step?
We want to make clear here today that no one is above the reach of U.S. sanctions. That if they facilitate transactions and are part of the ecosystem that turns Iranian oil into money into repression, they will be targeted. We find that the best way to engage with countries is through quiet diplomacy, and we are level setting with every country to tell them our expectations. We know who they are, they know who they are, so when the hammer of U.S. Treasury actions falls upon them, they will have no one to blame but themselves. So, Richard from CBS.
Thank you, sir. Thank you. You said the president is calling world leaders with specific asks and that there is a defined timeline. Who is he calling and what are the asks?
We're not going to name names. That we've already seen some results, and that I am confident the president, as you all know, is quite persuasive, and we are following his calls up with calls from visits and calls from the State Department and from the U.S. Treasury, expecting them or telling the leaders, the countries, and the entities exactly what we expect and the timelines. And I would expect that very quickly, if they do not respond, then you will see the ramifications of their actions.
Can you say how far the timelines are?
Again, I'm not going to set timelines, but we do not have infinite patience here. Jennifer?
Thank you so much, Mr. Secretary. Jennifer Schonberger with Yahoo Finance. You just said moments ago that no one is above U.S. sanctions. What specific secondary sanctions or penalties is Treasury prepared to levy against Chinese banks and shipping firms if they do not comply? And then secondly, as you look to take these unprecedented sanctions, you've also said that as the Iran conflict fades and oil prices recede, that will help bring down long-term bond yields. In the meantime, you have mentioned your toolkit, and I'm curious if you are looking at reducing auction sizes for longer-term dated Treasury debt going forward, and what other actions you may consider from that toolkit.
Yeah, well, why don't we work backwards? We issued the quarterly refunding announcement 2.5 weeks ago. We are going to continue with our regular program of auctions, so you will be hearing from us again at the beginning of next quarter. In terms of, as I said, every country, every entity should know that they should be prepared to face U.S. sanctions. And no one is above this. We are going to hold everyone accountable, and this is economic asphyxiation of this regime. And Jennifer, as I said, no one should test our resolve. So, Josh from New York Post.
You said you weren't going to name names, but there's been some reports that the United Arab Emirates is among some of the first nations to take seriously these words from the United States to cut off all business interactions with Iran. Is UAE leading the way in this respect?
I would think that the actions that they took last week were not coincident, but likely causal. And I would expect that we would see a broad array of countries taking similar actions as we continue our engagement. The UAE have been very good partners and have taken the brunt of the Iranian attacks in the Gulf. And what have these countries gotten over the years from appeasing Iran? They were subject to violent attacks. While we were bombing Iran, they were bombing them. So it shows that with this regime, appeasement does not work. And on the other side, with this regime, trying to buy appeasement will no longer work in the eyes of the United States of America. And I want to emphasize that we are spreading out across the world as we speak, that you will see a wave of sanctions when you leave this meeting today, And you should expect that cadence to continue. And I would expect that you will see a major announcement of a financial institution being sanctioned by the end of this week. So, Samira from Sky. Yep. No. No. Are you? No. I'm looking for Samira from Sky. No. Hi.
Does the United States and President Trump still want Canada to become a state? He did say that they're getting all the benefits of being a state without being one.
I think he would like Canada to come to the table and negotiate in good faith. They were offered quite a good deal last week. They chose to reject it. Unfortunately, Prime Minister Carney rose to power on an anti-American, anti-Trump platform. I believe he was more than 20 points behind, and he seems to have gone back to his old playbook. And I think one has to ask oneself, is he trying to benefit himself, the Liberal Party, or the Canadian people? Because they were offered a very good job. So, yep, you.
Thank you to Secretary Bessent. If I could shift to bond yields quickly. We saw them tick down today after some turbulence and going up last week. Can you tell us if there's any possibility that there'll be more bond buybacks anytime soon?
Again, we haven't bought a single bond yet. The next time we have an operation is September 9th. So we will see on September 9th. All right. One more. Let's see. You in the front.
You described this as an economic D-Day, but D-Day wasn't a threat of an invasion, and the U.S. didn't give a timeline to Germany. So why not impose the sanctions today?
Well, we are giving everyone the opportunity to remedy bad behavior. Why would I want to blow up the global financial system? We believe that it is important to level set and give people a cure period, but they should know that that will move very quickly and that we are serious. Secondary sanctions are a very powerful tool, and we here at Treasury, this is Gene Lang.
What I just heard him say is, we don't want the market to go down, boys and girls, so we're gonna soft walk this. This all sounds like a freaking nothing burger.
To use secondary sanctions is because we do not take their use lightly. So we believe that a warning shot and a level set of expectations is appropriate. And if people do not want to meet our expectations, then we expect, and they should expect, that they will leave the dollar system. Okay, thank you all.
Lol. Bro, come on, man. That was supposed to be putting the pants back on? What a freaking joke. Sorry. Golly. Man. All right, let's do a summary of that. That was just some baloney. All right, here we go. Well, Treasury Secretary Scott Bessent just came out to level set with the global economy because this economic D-Day may have just gotten tacoed, but trust us, the hammer will fall. Okay, honestly, this was a clown show once again, and this was really disappointing. This was the big meeting, the economic D-Day press conference. So literally, it was supposed to happen last week. But the market was red last week, so they didn't do it last week. Instead, they scheduled it for Monday. Okay, well, today is Monday, so today they had the press conference. And in the press conference today, they're like, yeah, we're not really going to announce all of the sanctions yet. But I would expect by the end of the week, you'll hear some more sanctions get announced. These people are literally panicking To the point where, you know, we're watching the Alpha Wire, obviously, at the same time, which you can get this for free in the Meet Kevin app. Free for now. Well, just use it for as long as you can. We're going to keep it open for a while. But anyway, you can download the Meet Kevin app, and you can see the Alpha Wire, and you can follow this along. But it's very interesting. We believe a warning shot and level set is an appropriate action, says Bessent. Or do not take the use of secondary sanctions lightly. And so we're kind of following along with this. We watched the press conference. And so basically, the bottom line I got out of this is that the Treasury Department and Donald Trump are calling people up, and they are threatening that we're going to impose more sanctions on you unless you do what we want when it comes to cutting off Iran from digital assets, technology, aviation, gold, and shipping. They're imposing 60 sanctions on individual entities and vessels. We didn't, you know, this was nowhere near as bad as a D-Day as it could have been. Like a D-Day could have been, we're sanctioning everybody that sends ships up and down the Caspian Sea, and we are now introducing another element to this sort of global war that's going on, where you've got Ukraine versus Russia, and then you've got Iran versus the United States and Israel, but then Iran is a close partner to Russia, a lot of shipping going on through the Caspian. So does Ukraine come in and start helping enforce some sanctions in the Caspian? We've already seen Ukraine accidentally sink a Russian ship carrying Iranian military cargo. So, like, we've already been poking around on these ideas. That would be more like an economic D-Day. More blockades, more real pain. This was pansy crap. This was nothing. They do not have their pooping pants on, because this was nothing. And frankly, they said the quiet part out loud. You literally had a reporter say the following: why not just impose the sanctions today? Why are you pre-announcing that we're going to be making an announcement, and then now you're making the announcement that you're going to be making an announcement? And Treasury Secretary Bessent literally responded and said, well, we want to give other countries a period of time to cure their practices of trading with Iran, and we don't want to blow up the global financial economy. Ah, bingo. Got it. Right. Can't put the pants on. Now, I'm not here saying we should blow up the economy. But what I am saying is Treasury Secretary Bessent loses credibility by the day. This is why when they came out with their little mini Operation Twist, and they're like, we're going to issue short-term debt to go buy the long end and buy 10, 30-year or whatever, or announce that we might or will or whatever to try to manipulate the market. It's no surprise that the very next day, all of that got unpriced. It's not a surprise that the 10-year is at a 3+ year high, and the 30-year is at a 19-year high. None of those things are really a surprise when people don't think you're credible. And that actually doesn't bode really well for what comes on the 27th, which is in 3 days. On the 27th, we have Jackson Hole. Yes, which is also, of course, the day we have a coupon expiring for the Meet Kevin membership. We literally have the coupon code JHole. But what matters about Jackson Hole is that Kevin Warsh has to build credibility that he doesn't have, given his actions in 2008 and how wrong he was in 2008. He's coming in with low credibility. Then he talks about 2% to the left of the decimal, loosening the inflation target to 2.99%, which then he's had to backwalk that, which again reiterates his lack of credibility. So now you've got Warsh, who stands on really thin foundations of credibility, virtually no credibility. And then you have Bessent, who can't really make his Operation Twist work, and now the economic D-Day is basically like a, you better or else. He's even literally asked, like, well, are you going to punish China, for trading with Iran? Everybody should be prepared for the hammer to drop. I expect more announcements later this week. A major financial institution will be sanctioned by the end of the week. And then, of course, this just sets up the taco because, that financial institution, they started fixing things, so we're going to delay the sanctions. This was a nothing burger. This economic D-Day was a bunch of talk to try to get Iran to comply. The most that you got was the UAE cutting off trade with Iran. But they're getting bombed by Iran anyway. They're not jumping up and down about their partnership with Iran. They'd much rather get some more patriots from the United States. And so we're leveraging that relationship. But is this really like a big strong arm over a big country like China or Russia or frankly the Iran situation? No. And I think Iran is kind of calling the bluff here on America that Donald Trump doesn't want the stock market to go down. Unfortunately, even just under the threat of this economic D-Day, we've seen the NASDAQ 100 go from the 735 where it was last Monday, which was our target. We had a 735 price target going all the way up, hit 735, and we're like, now our price target is sub 700. It's not magic. It was because of the threat of the economic D-Day, the deterioration we've seen with Iran, NVIDIA earnings coming up. So there's logic to all of this that goes into our alpha reports, but it was correct. And now we're bleeding. We're at 707. We're straight down from 735. We're not yet sub 700, but I think there's a chance we can get sub 700, especially with NVIDIA earnings on deck Wednesday, and then, Kevin Warsh credibility building day at Jackson Hole on Thursday. Now, best case scenario for the short term is Kevin Warsh basically pulls a Bessent, which is kick the can down the road. Our task forces are working on it. We'll get back to you. If he actually wants to use Jackson Hole to put the pants on, which Bessent couldn't do, that would be bad. But they're all Trump puppets. Bessent is a Trump puppet, and Warsh is probably a Trump puppet as well. That's how he got the job. But now he's in the job and he can't get fired. So, does he remain a puppet is the question. We'll see. The odds are, the default bias and the market expectation is that they're just going to keep remaining puppets. That Bessent will be useless, as he so far has proven to be. And Kevin Warsh will also just kick the can down the road to his task force, which is a task force. We've broken down all the people on the task forces. These task forces are built by people who desire rates to be zero and no money printing, which we kind of know the direction that ends up leading. It ends up on the left side of a V-shaped D-covery on not getting the money printer to bail you out. So it makes the down a lot harder. But, that's okay. I guess it's free marketism, and so we'll end up seeing what happens. But the point is, short term, these people have no credibility. If Kevin Warsh wants to put the pants on, it's going to suck for Thursday, and the market will go down a lot more. Hopefully he doesn't. Hopefully he just kicks the can down the road, and then we can kind of stabilize post-NVIDIA earnings, and the party can keep going. But hope is not always the best strategy, so stay conservative. And if you want those alpha reports, make sure to join us at meetkevin.com. But in the meantime, what did Treasury Secretary Bessent say? A whole not a lot of nothing. Let me see here. Let me see if there are any other notes. Asked why the U.S. is telegraphing plans rather than immediately imposing sanctions, Bessent defends the approach, insisting that a warning shot is appropriate. We are giving everyone the opportunity to remedy bad behavior. Man, this is such bullcrap. Sidestepping questions. Yeah, we covered all this. I'd expect to see a broad array of countries taking similar actions in the future. This was in reference to the UAE indirectly. He didn't directly mention the UAE. No targets yet on Chinese banks or shipping firms that we're aware of. Bessent just threatens that the hammer will drop. Don't be on the side of Iran. If you want to work with us, you have to be on our side. But that's always, surrounded by taco parties. It's just a clown show. It's a clown show. So just all this means, practically, is more volatility in markets. So be more conservative. But long term, I don't think you want to bet against Trade America. Okay. So
the inflation scenario, but I understand what the Treasury Secretary is trying to do. I understand what they're talking about from a national security and global security perspective. And in that regard, I might separate the economics in the short term from longer term security and safety issues.
So you layer on this breakdown with Canada and you start to wonder, Joe, Crown Royal whiskey, goose down jackets, ice hockey equipment, confusion over cars. Does affordability just get worse?
I don't think it gets worse. I mean, the inflation data, Joe, have trended a bit lower. The core CPI is around 2.5%. That's not terrible. I think, unfortunately, perhaps the president may have been too aggressive in saying he was going to get inflation down as fast as he'd like. Yeah. But the trends aren't terrible. So I don't think it's going to worsen the affordability issue. But we'll see what happens. I mean, I understand people's concerns. There's issues in terms of affordability on the mortgage side, lending side. But the reality about rates, though, is that this rise in rates has been global. And the U.S. rise in rates, Joe, has to be put in the proper perspective. It's the strongest economy among the industrialized countries. The demand for capital is high. You see it with this hundreds of billions of dollars coming to market from the hyperscalers. Like, this is raising demand for capital because U.S. investment opportunities are so strong. And a part that is because of the president's policies of prudent business-friendly deregulation, low tax rates, low taxes on working-class Americans, so there's no tax on tips and overtime. Those are all positives that will help on the affordability side. Maybe the criticism that I level against the administration is they need to maybe message that better, because these things poll very well with everyday Americans, and maybe that's what we'll hear more of going into the midterms.
Yeah, it's messaging, guys. It's messaging. That's where we're screwing up. It's not the actual underlying fundamental problems of how bad tariffs are or how bad war is. Don't mind any of that. That's fake news.
Joe, as you talked about your view on inflation and some of the forces that are out there, the demand boom for AI infrastructure, which, yes, is obviously creating more demand for capital, but also could be inflationary in its own right. Do you think he could realistically set the stage for a hike coming soon?
Well, the Bloomberg, as you know, if you look at your Bloomberg terminal, the probability of a September hike is 40%. We've got inflation data on Wednesday. I'm upbeat on the economy, and last year, if you look at what the Fed did, they cut rates 3 times, a total of 75 basis points to guard against unwanted weakness in the labor market. Last year, private jobs or headline jobs were only up something like 10,000 a month, and that was perhaps at the time the right thing to do. The economy, in my view, is very strong. Job growth is improving. You'd want to take back some of that emergency easing. So I could see the Fed raising rates in September. On Jackson Hole, Kevin Warsh is probably going to say we need to get inflation back to 2%. What I'd love for him to say, which I don't think he will, but if he's listening, maybe.
Yeah, there's an investor update tab under the Meet Kevin app. So if you go to the Meet Kevin app, you can see there's an investor update tab for investors, which I think is really useful. I could probably go in and do another quick little update too and throw another one in there. Maybe we'll do that. But yeah, doesn't hurt. So, but yeah, I'll regularly throw things in there. I think that's a pretty easy way to just communicate with investors. So just download the Meet Kevin app and you could read it there.
Treasury Secretary Scott Bessent, now chief economist of SMBC Americas, here with us on Balance of Power, reflecting on what we just heard moments ago from Secretary Bessent as he outlined so-called economic D-Day against Iran.
Nothing.
Here's part of what he said.
Just crap.
Let me be clear. Any entity that facilitates money laundering on behalf of Iran will be removed from the U.S. dollar system. The clock just started ticking.
Yeah.
So as our clock keeps ticking, let's turn now to our political panel. Rick Davis and Jeannie Shanzano are with us. Rick, of course, partner at Stone Court Capital and Republican strategist. Jeannie, a Democratic analyst in democracy, a visiting fellow at Harvard Kennedy School's Ash Center. Welcome to you both. Rick, we've talked repeatedly since this conflict between the U.S. and Iran began about whether or not the U.S. and the president specifically is credible when making threats, because he so frequently pulls back from them.
It's always taco, dude.
Infrastructure, then backing off for the sake of negotiation. Should other countries who listened to the Treasury Secretary today take him more seriously in this instance, or could it also just be another bluff being called out?
Yes, it is.
Yeah, this was a little bit confusing, the statement today by Secretary Bessent. D-Day, he's been calling it D-Day for quite some time, was on June 6th. That was a day that the world remembers. I'm not sure anybody's going to remember today's press conference because it was basically a warning, not a D-Day. And so I don't know how seriously our enemies are going to take this threat, because that's who we're talking about. We're talking about people who are aligned against the interests, both economically and security-wise, against the United States. And so, sure, great to have the Secretary threaten these entities and countries. Great to have the toolkit that we have as a country to be able to make an impact. But this has been going on now for over 6 months. The sanctions themselves have been going on for over 50 years. At what point are we actually going to see a result, something like a D-Day? We didn't get that today, and we didn't get a timeline to get it in the future. So I'm still scratching my head going, what in the world did we just see happen at the Treasury Department.
It was
today.
a joke. It was a
Certainly
literal
not a
clown
detail.
show.
Well, do you feel the same way, Jeannie? The secretary was asked about China. No one is above the reach of U.S. sanctions, he said. If China facilitates transactions, it will be targeted. What's to be confused about?
I think the real question here is, what is the administration trying to achieve? One thing they seem to be trying to achieve is regime change. And unfortunately for the all of us and the administration, economic sanctions against autocracies like Iran are very infrequently effective at regime change, because economic sanctions like this harm populations. And the thinking is the population will rise up against this regime and will overthrow it or change its ways. There has been no sort of history with Iran, and Rick mentioned the last 50 years of economic sanctions. They have weathered all of it. And now, thanks to what the administration did with starting this war in February, we have a more hardened regime in place. I don't think there's anybody who studies Iran who thinks that this regime will do anything except kill protesters without even batting an eyelash if they try to rise up now. So if it's not regime change they're after, and there's, again, very little research evidence that that's effective, the only other alternative is we are going to badger them back to the negotiating table. That's probably our best bet. But economic sanctions of this magnitude, if they go into place, are probably just going to do what this regime wants to do, which is become more hard line, not likely to get back to the negotiating.
Well, and the regime knows, too, if the market goes down, that's when Trump paper hands. So that's why Bessent has to go so soft and soft walk this. No credibility, because you can't.
They say, no, we're saying we're going to sanction them. So I'm not really feeling like this is going to be effective. The only way out of this is going to be diplomacy. And all of this is a self-inflicted wound by a president who got rid of the only negotiated settlement we had, which is the JCPOA, and then bombed them twice and has now woken up to the fact neither of those things is effective.
Well, on the subject of self-inflicted wound,
I mean, kind of honestly well said.
Consider what actually might come about economically if we do see these secondary sanctions implemented, if Iran actually is choked off, if its oil is never making it on to global markets, and if this happens and Iran chooses, instead of going to the negotiating table, to retaliate against other Gulf states' energy interests throughout the region, could this actually exacerbate some of the political problems that the president is facing at home if it leads to higher energy prices, not even to say what could happen as a result of the tariffs against Canada that are now being implemented back in return?
Yeah, just focus on the Iran question. And I certainly am for D-Day, and I do believe that
this D-Day was bullcrap.
Exacerbate the domestic problems that exist in Iran, and I do believe that the only ultimate solution is not negotiation, but regime change in Iran from Iranians. So the fact that Secretary Bessent made a point of saying this is how they change governments in the Soviet Union, I think is a good indication that they're not going to the negotiating table. The question really is what you said, Kaylee, is like, how tough can the administration be if it has to weather economic punishment at home because of the policies that they're now going
Basically, how much can we how much can we sustain or be okay with the market starting to fall because we suck and we don't have credibility and our policies and government suck? But I mean, we could know that just by the fact that it's government, you know. Like, government's always gonna screw up. It's like classic. It's just embarrassing, is what it is.
If it's actually implemented by the midterms. And maybe that's why we didn't see a timetable, because the reality is if they come out today with crippling secondary sanctions on India, on China, on places who are doing business with Iran, you would probably see a negative impact on consumers, negative impact on the economy. And
well, the stock market would just drop 1 or 2%. Or more, 3%, 5% over many days, right? And then all of a sudden you start getting calls on Trump, hey man, stop the bleeding, bro. Portfolio's going down. We're not able to sell as many subscriptions on Truth Social. Which, you know, that's a whole nother thing, but whatever.
Officials all weekend to learn that they believe the trade war with the United States, which they do call it, may last well beyond the midterms, that this could in fact be a new long-term reality. Does the U.S. look at either of these instances of economic statecraft in the same way?
I'm not sure this administration does. I'm not sure the U.S. government does, but we should be. The damage in both of these instances is so long-term and so widespread. You look at what President Trump has done to our allies in just the last week, let alone in the last year and a half or two that he's been in office. You have South Korea. You have Canada.
Yeah, that's true. We just snubbed South Korea, too.
It goes on and on. Now we're going to be secondarily sanctioning potentially allies for their operations with Iran. We are getting ourselves into an almost impossible position here on the world stage. And what the secretary did today was he issued an existential threat to the Iranian regime.
She's not wrong.
When you issue that kind of threat in foreign policy, that means they are going to fight to the death. And the question now for the U.S. is, are we prepared, and this gets to your long-term question, to fight to the death? Are we willing to put troops on the ground? And the answer is no, and they know it. And yes, everyone would like regime change.
Dude, this chick's good.
But we shot ourselves in the foot in February when we went in. The time to do these harsh economic sanctions and to try to support regime change in other ways was before the end of February when people were rising up. And why they didn't do that remains an open question, but it suggests that what they want to see and what they have in mind is not long-term, but short-term wins. And that's not how Iran plays this game, and that's why we're here 50 years later.
Yeah. Damn.
Well, Rick, I'd like for you to weigh in on the Canada portion of this specifically, to Joe's point about Canada's expectation that this is not going to get any closer to the resolution that may be desired prior to the midterms, or maybe even not until President Trump is out of office. Characterize the strength of the U.S. and Canada's positioning in what could very much just be a tit-for-tat escalatory cycle when the Canadian Prime Minister has soaring popularity because of this trade war with the U.S., and President Trump's own approval rating has been consistently falling.
Yeah, President Trump's rating on the economy now is sub 30%. I mean, that is a historic low for a president. And as you point out, Prime Minister Carney has actually benefited both politically when he was running and since he's been in office from the challenge with Donald Trump. So when you're looking at who holds the political cards, absolutely it's the Canadians, and their fact that they are willing to put out to folks like Josh Wingrove of Bloomberg that they're going to settle in for a long fight, that they don't care about the U.S. political cycle. If anything, they're going to manipulate it to create havoc in states like Maine and Michigan and Wisconsin that have critical elections for Republicans that could determine the future of the United States Senate as far as political party control. They know what they're doing. Mark Carney's a savvy guy, and I think he's playing his set of cards that Donald Trump likes to use so much better than the current White House.
Boy, it's going to be an interesting conversation with Premier Ford tomorrow. Great panel, but this is going to be more drama than many may have bargained for. Rick Davis and Jeannie Shanzano, thank you both. Bloomberg Politics contributors, fascinating view from our Republican strategist and Democratic analyst. We're going to dig more into what's happening in the geopolitics with Iran on this economic D-Day. As Scott.
Quick follow-up. I want to do a quick follow-up on the Bloom Energy thing, just to give a little bit of a bottom line on this. So let's do that really quick. Okay. So first thing, just so you could see it. Wrong one. What? Oh, it's this one. Hold on. One sec. You can see all the recent congressional buys in the app here, and I think it's kind of cool. So check this out. There it is, in the Meet Kevin app, under Suits, Nancy Pelosi's purchases. Here we go. And then I want to also follow up. So we got that, and then I want to follow up and just remind, or put like a bottom line, because I feel like I didn't like have a really good bottom line on Bloom. So for a bottom line takeaway on Bloom, the big play here is, can they get more customers? And can they grow their margins faster? That's the real play on Bloom. My take is that you really want to see expansion, not only to customers, but margins both happening. What that's probably going to rely on is not just an expansion of what artificial intelligence is used for, whether it's in healthcare, robotics, space, whatever, AGI, which, I don't believe in AGI, but whatever. What we really want to see is an expansion of that boom, kind of like what we talked about in that memory cycle, where you can expand out that data center plateau before you kind of get that eventual decline. Ideally, you get some more S-curves of AI data center growth, and you really get fuel cells becoming sort of a core product for not just Oracle that they purchased, but also other data centers. So that doesn't make Bloom Energy a bad company. It's a concentrated risk. Now, that doesn't mean companies with concentrated risk are bad. It's just who's the counterparty. So in this case, the counterparty is Oracle, which credit default swaps are skyrocketing on. We really want to see expansion to other data centers rather than just Oracle. A company like Cerebras has a lot of customer concentration in, ultra-fast token artificial intelligence, ultra-fast token generation. NVIDIA competes with their Grok product, which they just announced is in full production. But this is really useful for customer service and voice artificial intelligence, low latency communication. But Cerebras has really big customer concentration with OpenAI. OpenAI is going to be like, an Oracle is for Bloom Energy. That needs to expand. And if Cerebras can't expand past OpenAI, that's bad. And so, then you kind of get stuck and people just use the NVIDIA product and the Cerebras product doesn't go anywhere, especially if NVIDIA can scale faster. Those are all real risks. So that doesn't mean don't invest in a company. It just means know what to look for when you're investing in a company. It's okay to invest in a company with concentration risk if you think it's going to grow beyond that. Like, do we think Palantir is going to grow even more beyond just sort of like this government exposure that they had, years ago, like 5 years ago, right? Oh, are they going to expand to commercial? The answer was absolutely yes. They keep expanding. Commercial revenues are going to exceed government exposure. So it just depends on kind of where you want to place that bet. And then as long as you place that bet and know that, then you can kind of monitor how things are evolving. Is margin increasing? And is that customer concentration declining to where they're broadening out? And then, of course, it would help if the entire artificial intelligence boom kind of keeps going and we expand that plateau. That's pretty critical for Bloom Energy. It's sort of a bottom line on it. Okay, good. So I think that's useful extra color. All right, let's go back over here and hear more about Bessent.
Sending it back to the Stone Age.
Well, yeah.
Well, to that
forgot
point,
about that.
Professor, our audience should know that you grew up in Tehran and you immigrated to the U.S. after the revolution in 1979. Iran has basically been under sanction that entire time. Since then, it's been about half a century. So why realistically would the regime bow to a tougher sanctions regime like this, assuming the U.S. does everything it says it will when it has not cowed to them in the past?
Well, Iran has been under 47 years of sanctions. I've written a book about that. And the reality is that, first of all, it has developed ways to survive under sanctions. So it's not like a country that has not previously been outside of the global economy that is all of a sudden subjected to sanctions. They build their own missiles, their own drones, their own industrial products, and they can survive under a great deal of hardship. Secondly, sanctions work really when you actually offer something on the table. That's the way it worked with President Obama. He, for the first time, introduced secondary sanctions on Iran, squeezed them hard, and then he said, here's a table we can negotiate over the nuclear program, and this is going to be a realistic diplomatic negotiation. The reality is that President Trump is offering nothing. He's basically saying, I'm going to squeeze you until you surrender, and the Iranians will not surrender. In fact, today, the Iranian Speaker of the Parliament told the visiting Pakistani military chief who went there to see if he can resolve the dilemma, that there is a pathway out of this, which means that the United States needs to go back to the MOU that it signed in June and implement the MOU. So for the Iranians, there is already a diplomatic off-ramp. And no, I think the Iranians will not give in. And they've already said that they will not tolerate any more economic pressure, that they will attack the infrastructure in the Gulf. They will put pressure on the global economy. They may shut down a lot more of the trade in oil and gas that goes over the Red Sea. Their proxies in Yemen, in Iraq will begin to put more pressure on Saudi oil facilities. And Iran may get much more aggressive in the Gulf. The U.S. has been escorting more and more tankers in the past 2 weeks, but those tankers may not come under a lot more fire than they had in the past 2 weeks. So yes, the United States can escalate, as Secretary Bessent says, but the other side also gets a vote. And the Iranians are aiming at the U.S., but the real target for them is the global economy. Whatever they do will be designed to get the attention of the energy markets, to get the attention of other dimensions of the global economy, and to make it much more difficult for the U.S. to have its cake and eat it too.
Treasury Bessent, Secretary Bessent said a major financial institution will be sanctioned this week. Vali, do you have any thoughts on who that might be?
No, I mean, we know that already all the major Western financial institutions have got out of any kind of a business with Iran. Iran is not able to use the SWIFT financial transaction mechanism, which means that even if banks wanted to deal with Iran, they don't have a regular way to deal with Iran. So that major financial institution is perhaps a Chinese institution or a Hong Kong institution connected to China. And my sense is that it potentially can invite a Chinese retaliation if the U.S. did something like that. So the U.S. is essentially expanding its war in the Gulf to a much greater war between itself and other global actors around the world, which seems to be shooting itself in the foot. It is basically expanding the geography of this war out of the Gulf into the financial markets, and it's going to get entangled with some major global actors with whom it has other business and other sets of issues that it has to deal with.
Well, the U.S., of course, says all of it, whatever comes next, is with the end goal of making sure Iran never has a nuclear weapon. Does what you're describing, Professor, bring the U.S. closer to achieving it?
That was the goal when the U.S. bombed Iran's nuclear sites in June of 2025, and President Trump declared that Iran's nuclear program was obliterated. The Iranians were negotiating exactly what he wants, namely that there would not be any Iranian nuclear weapons program or major threat to global security with Iranian nuclear program. And he decided that he would settle the whole thing militarily. He'll just go to war with Iran. They will either completely cave in or that they would basically fall from power. None of that is happening. Right. Iran has come out of this war stronger. It's been now months that the U.S. has got entangled in an endless war. President Trump has no way to finish this war diplomatically or militarily. He's stuck. And we're not even talking about Iran's nuclear program. He throws these words out there as a sort of a throwaway. In reality, the entire discussion is about the Strait of Hormuz, which was not even an issue before he went to war. We have to first resolve this issue of the Strait of Hormuz. We should have to first resolve the free flow of oil and gas out of the Persian Gulf through the Strait of Hormuz. We have to first get to a ceasefire before we can even think about Iran's nuclear program. So in a way, he's actually pushed that issue much farther out, and he's not able to resolve the steps that the United States has to get through before it can arrive back at a conversation about Iran's nuclear program.
All right, Professor, thanks for joining us. Vali Nasser, Professor of International Affairs and Middle East Studies at Johns Hopkins University School.
Yeah, I mean, I think both of these folks were pretty right on there. This is just embarrassing. So, oh well. But everyone knows that. You know, they're playing the game of, hey, Trump doesn't want the market to go red. If the market goes red, we just have to wait. He'll flip. So, all right. All right, let's see here. So let's see here what else we've got. Let's see. Okay. Oh, we were gonna do a quick update. So on the investor updates tab, so this is quick update. So that was about a month ago. Update on fundraise and funds. Okay, quick update on prior updates below. These are ballpark figures, just intended to be a quick update and not exacts. We believe our market value of real estate, cash, security, and liquid assets. Real estate and liquid assets plus developments, all at fair market value, sits around 100 mil. The let's see, we've got about 16.3, 16.5-ish, roughly, mil in liquid assets available, 90% about percent of which are cash or treasuries, / money markets, and probably the fundraise, tentative fundraise. So this is the investor updates tab for Reinvest. If you want to see that, it's in the Meet Kevin app, so I'm going to post that there. I guess I could do, yeah, tentative fundraise, still targeting late September for our Q4 acquisition strategy for our usual. That's more like late Q3, Q4 acquisition strategy. So nothing's really changed here. Otherwise, things are pretty stable. Target conversion price around $1.90 a share. Cool. Anything else? I don't know. Otherwise, in-house management is expanding. Rentals are doing well. And development continues on Reinvest AI, homes, stock, and our long-term real estate acquisitions and developments. Cool. So that's just sort of like a quick update. So I feel like this is a nice little useful page for then people to just sort of see, like, some of the latest updates. So that way it's just an easy way to consolidate where people can look. So I think that's kind of cool. Okay, cool. So let's see here. Let's see what we've got. Amex credit limit. Amex credit limit throttling, somebody's talking about. Yeah, credit is always such an interesting thing. They will jack your credit in one way or another very quickly if they sense little changes in trends. But that's probably all in part driven by AI these days too. Software rotation. So Bold Brett asked about the software rotation. I think this is still happening. We can quote reply this. I think this is actively in progress. The software rotation. I mean, if you look at here, let me get rid of myself for a moment. If you look at Palantir, CRM, Netflix, Intuit, all bottomed. Let's see when. Let's go find out. So Palantir bottomed June 24th. Now, ServiceNow, for giggles, in April. CRM bottomed June. Netflix bottomed July. And Intuit bottomed June. So really, if you look at software, these guys all bottomed between April, which was this one, April bottom, and July, and most of them in June. The bottoming really started forming in Q2. So look at, which was the one that was July? July was Netflix, I think. Netflix, yeah. So Netflix, July. This was June. June. Actually kind of interesting if you look at it that way. The Q3, Q4 bottoming is really happening for software, which is really exciting. So that's good. I'll throw you a little heart. There we go. Okay, cool. Bessent conference is over. Posted a summary on the channel already.
0.6%. The NASDAQ 100 index down 0.8%. Tough day for a lot of semiconductor names. The SOX, the Philadelphia Semiconductor Stock Exchange.
Yeah, we talked about that.
Will be given a defined timeline to shut down the Iran-related activity. We have identified if they fail to act, Treasury will act. But the Treasury Secretary was asked, for example, about actions he's prepared to take on China. Without getting into what timeline he expects China to make adjustments in, he said he does expect the Chinese side to follow up on his warning here. All countries, he said, are subject to this, but without a lot of detail about what kind of action the United States might take. The Treasury Secretary was also asked, why is it that you're not taking immediate action now on these secondary sanctions against Iran's trading partners? He had an interesting answer. He said, we're giving everyone the opportunity to remedy bad behavior. Why would I want to blow up the global financial system? We believe that it's important to level set and give people a cure period, but they should know that we'll move very quickly and we are serious. So what the Treasury Secretary is saying here is that these kinds of secondary sanctions would blow up the global financial system. He doesn't want to have to do it, but ultimately he will do it if he's forced to. And so the question here is, what is this message coming out of Washington today? How is that being received in capitals around the world, particularly capitals like Beijing in particular, where leaders sent a message last night saying that they're concerned about this U.S. action and they're worried about too much economic pressure on them. So some really open questions here, guys, I think, in terms of how this will be received and when it'll happen, if it happens at all.
It's true. All right, Eamon, thank you for that.
All right, one big question still remains. Can Washington turn up the pressure on Tehran without also turning up oil prices? Let's bring in sanctions expert Daniel Tannenbaum. He's a partner at Oliver Wyman. Dan, appreciate you joining us. Listen, you're a sanctions expert. You know so much about this. We had sanctions on Iran. Many of those were either done away with or sort of suspended when we got that memorandum of understanding a couple of weeks ago. Sort of that.
Yeah, all right, let's go check out the Wall Street Journal and go back to where we were on some of this. If a house drops below loan amount, are you still able to refinance? Sure, you just have to bring in more cash, or get a different kind of loan. I mean, like, for example, if, basically the only option is bring in more cash. If you have a $400,000 loan and the home is worth $380,000 and you're going for a 80% loan to value, you're going to have to go 380 times 0.8. That's 304. You have to pay that $400,000 loan $96,000, and then you can refinance. But what benefit are you getting? It's not like you're going to take cash out. You're putting cash in, right? Well, the cool thing about a mortgage is you don't have to refinance. That's the whole point. You don't want to be in a place where you're ever tied to refinancing. If you get tied into refinancing, you're screwed. So you should never buy a home with the anticipation that I will refinance in the future. It should always be, I get to, if the opportunity presents itself. Okay, let's do, where's the journal piece? Oh, that's right. Okay, so the journal piece was here. And then, okay. Okay, so this is the trade war talk about Carney. This is where we left off. And then we still have the NVIDIA announcement to look at. Grok. Because they just announced that. I think it's kind of strategic that why they're doing this right away, right before. Oh, with Nebius, the first to adopt. Oh, good. Okay, so we'll look at that in just a sec. Let's finish this. So, Trump issued his latest threat against Canada last month under Section 338 that for countries that discriminate against commerce against the United States, okay? No previous president has used this power. Well, of course. I mean, he just sort of doesn't matter what his basis is. He just wants to do what he wants to do. Deadline set for midnight on Friday for Canada to reach a deal to avert 50% on tariffs. Yeah, but I thought some of it was Jan 1. Yeah, like the autos is Jan 1 on January 1st, 2027. Right, so it's already been shifted. Like it already kind of got taco delayed, right? Okay. Trump's threatened tariffs took okay, that's fine. To justify his new tariffs, Mr. Trump said Canada discriminated against the U.S. by retaliating against his national security tariffs on autos. He also claimed that Canadian provinces restrict the sale of U.S. beverages in response to restricted sales of alcohol in response to the tariffs last year. Well, yeah. President, longstanding grievances over dairy. Most of these issues could have been addressed through a renegotiation of the USMCA, but Trump doesn't want to update the deal. He wants to rewrite it unilaterally. As Mr. Carney noted Saturday, the president has contrived an array of pretexts, from fentanyl trafficking to trade deficits, to bludgeon Canada with tariffs. Trump's complaint about the trade deficit with Canada is particularly ironic since the latter, Canada, owes entirely to its imports of heavy crude oil that is well suited for U.S. refineries. Oh, the U.S. owes. Okay. So, in other words, we're importing more oil from Canada because we can go refine this. Excluding U.S. Canadian oil, we would have a trade surplus, but U.S. refineries would operate at a lower capacity. Interesting. Last week, two sides were close to an agreement that would reduce the U.S. auto tariffs to 15% on Canadian vehicles, same rate as South Korea and Japan from 25%, and steel and aluminum to 25% from 50%. These reductions would have helped U.S. manufacturers. Prices for steel and aluminum have gone up 22 to 40% over the past year. Wow. It was just passing on the cost to the people, you know, the ultimate people who end up wanting to buy this. I mean, not all of it passes on. It's sort of like the whole chain ends up paying portions. GM last month projected $2.5 billion to $3.5 billion hit this year from tariffs. U.S. automakers have been lobbying the administration to reach a truce with Canada. Mr. Carney said Saturday the major reason the deal blew up is that the Trump team refused to ease tariffs on heavy and medium-duty trucks, including the Ford plant in Ontario. So why is Trump punishing Ford, America's largest auto producer? Right. I mean, that's their point of view. We don't know. Yeah. What a mess. Oh, the comments are going to be hilarious. They don't load. Okay, well, that's all right. Usually nothing other than comedy gleaned from that anyway. All right, Treasury Secretary Bessent said we're launching a new campaign, so we saw this. This was all bullcrap. Economic D-Day, blah, blah, blah. Okay, they didn't really provide any commentary. That's lame. Okay. Oh, yeah, this is what I wanted to look at, too. What is this mold thing? Mold is driving American homeowners crazy, and they want builders to pay. It's in showers, behind walls, deep in linen closets, black and slimy, white and fuzzy, or green and spongy. It's making homeowners struggle to breathe, costing them millions in repairs and healthcare bills. They say mold is driving Americans crazy. But hey, mold can actually literally drive you crazy. Like it is implicated in mental illness. You know, you get like a Stachybotrys. I think that's the variety. Let me see. I don't know how to spell Stachybotrys. I'm gonna see if I can spell it correctly without looking. Is Stachybotrys implicated in mold mental illness causation? Let me see. No, I spelled it wrong. How close did I get? It says, Stachybotrys. So I got Botrys correct. That's actually pretty cool that I got that right, that part. Botrys. So I got that part right. But I wrote Staccy, and it's actually Stachy. Dang it, dude. I was one letter off. Stachybotrys is associated with neurological and psychological symptoms in clinical discussions, but mainstream medical and scientific organizations consider direct causation of mental illness unproven. TBD, I suppose. So this is probably, maybe this is more like, you know, just what people like to use for lawsuits or whatever. Oh, yeah, I have mental health problems now because of mold. Mycotoxins released by mold can trigger inflammation and potentially affect the central nervous system. Correlation versus causation. Large-scale epidemiological reviews note a clear statistical association between damp, moldy interiors and higher rates of depression. However, researchers emphasize that living in substandard or damp housing introduces many confounding stressors: financial strain, physical illness, poor air quality. So basically, like, is the mold causing you to go crazy, or is you going crazy causing you to let mold grow in your house? Oh, that's quite interesting. That's interesting. Oh, man. Have you seen that home inspector? Oh, that's like a new trend right now, is the home inspectors trying to like tear apart new construction stuff. Dude, it's so common to point stuff out on new construction. And then, you know, of course it's perfect timing because it feeds into this narrative of like, oh, you're paying 7% for a home and the builders are trying to rip you off. And then like when you actually put a dollar value on most of the issues that these inspectors are finding, it's almost always nominal. I'm not saying always because I don't know who you're talking about or which videos you're referring to, but I've seen a few of them and I'm like, all right, like, come on. You know, they're like, A, they're going to fix it. And B, we're often talking about like grout and caulking or like, you know, splits in lumber that get plated. I'm not trying to defend the home builders. There's some stuff that's really stupid, but some of it is just like when we put a dollar value on it, we're generally talking about a fraction of the cost of the build, and it's often more related to finish work. Okay, so but yeah, send me an exact one. Happy to look. Can I mean, let's see. Let me see if I don't think I can play audio on this though. So I'd have to pull it up on there. Can I do it? Can I pull up? Can you do TikTok on web? Let's see. Interesting. He says he found $400,000 of issues with the home he bought. Is that on a short? I'll go look. Let's see. I'll tell you if it's 400. If it's 400, it's 400. I'll believe it. But I want to see. Let's see what he's talking about. Let me see if I can log in. I just don't use TikTok, and I guess now I have to log in. Okay. Oh, great. Now I have TikTok on the computer. Okay, so this is CYFY. And honestly, it's really good branding for a home inspector's company, right? Really good branding. Oh, I'm assuming it's the pinned one? Let me know. Is it this one? This 11.8 million view one? That would make sense. Boy, he's got a lot. These are great branding, honestly, for these companies. We'll look at that $11 million one, or 11 million view one in just a sec. But let's see if I can hear this. Hold on, audio.
America's best builder. This is the builder that makes $40 billion a year. The only thing holding this thing together is gravity. So here we got our connector plates that hold these members together, and, well, that's what I like to call Bluetooth penetration. Builders never were good at penetration. Look at that.
Okay.
Well, we just had another heavy monsoon come through with some sideways rain, and our new build roofs just don't hold up. I wonder why. I wonder why these billion-dollar builders build the roofs that...
And that's always... Who's the builder? Let me see. Who's he talking about?
Now remember, this is America's best builder. This is the builder that makes $40 billion a year.
America's builder. Oh, okay. Hold on. See the fourth video? So that's the one you're talking about as the fourth video? Okay, we'll go there in just a sec. Oh, D.R. Horton is called America's Builder? Huh, I didn't know that. Let's go look. Let's go look at their financials. D.R. Horton, Q3 earnings report, 8/24. Okay. So... shoot, what's... okay, let me get this. Let's see, because it's lagging. Give me a second here. I just want to try to minimize some of this jittering. One sec. Okay, so 1 second here, and we'll get into this. Okay, let's see if that fixes it. Okay, that should help. Let's see. Okay. So, there we go. D.R. Horton. This is their income statement. So this is for the 3 months ending June. This is buy season. This is $9.2 billion in revenue. Okay. So did he just multiply this by 4? Because their last 9 months is at $23 billion, which is closer to $30 billion in revenues. Let me see here. D.R. Horton. DRI is the ticker for them. Financial forecast. So D.R. Horton is expected to make $32.6 billion. Okay, so we're just a smidgen off there. But it's okay. It's just 20% off. I mean, like, that 2x4 is off by as much as his math. Okay, so we've got revenue, we've got net margins of like 9% at the business. So this is not like the highest margin business that at least they're building in. Tougher time to be trying to resell, obviously. But let's take a look at this. This is net income 918. Yeah, look at that. 918 divided by 9227. They bring down less than 10% to bottom line. right? So, you know, there's not that much margin. It's not like they're like, I mean, when you say $40 billion on gross, it's kind of misleading because they're making $3 a share. And what's it trading for? $148. So that's per quarter. EPS is projected to be $10.46. So they're making $10.46 projected annual on 148.6, which is selling for a multiple of 10.46, 14x. At probably about 14% growth. It's trading for about a 1 peg. So it's actually, they're actually not that expensive right now. Wow. Yeah, look at that. Yeah, because they've had negative earnings growth, which is expected to bottom now. Plus 16. Oops, I screwed that up. 12.69 plus 16.08 plus 31.79 plus 19.0. Interesting forecast. I mean, I got forecast growth is about 19.9, right? So the valuation of this company is 14 divided by 19.9. 0.7 peg. Holy smokes, that's low right now. That's incredible. Is their balance sheet trash or what's going on? That's really cheap, though. So I've got cash at $2 billion. Deferreds. Ooh. Holy smokes, dude. Yeah, they need to sell these inventories. $9 billion of inventory. 9 to 11 billion dollars. Ugh. That's a lot of bills. $12 billion in bills. Yikes. But they don't have long-term debt. Oh, well, it's just not. No, notes payable could be long-term. Those are 7. So their bills are actually 1.3, call it 1.4 plus 3.6-ish. 5 billion in bills, 7.1 billion in long-term. Yeah, it's not great. They need to sell those homes. So just to pay their bills. Are they raising money or what are they doing? This is a refi right here. And borrowing. And they're rebuying stock. 2.2 billion buybacks. Interesting. Interesting. Okay. Okay. All right. There's a client of his talking about his inspection. 4th video. Okay, we'll take a look at that. Let's go see. So, that gives us a little color here. Let's see what he says here.
Holding this thing together is gravity. So here we got our connector plates that hold these members together, and
okay, we saw this already. Saw the loose roof tiles.
Important message if you're. Let me show you.
That's it?
This is one of the downsides of waiting till you're 1 year for an inspection.
Right. I've actually done exactly this before in my home, where I found a wall cavity that had missing insulation. I have a picture of it somewhere. But actually, I wonder if I can find it. I think what these are is they're a really good advertisement for home inspection, like just having somebody do a once-over that's not affiliated with the company, because you are going to find a lot of stuff. It's a great thing. But it's, when you put a dollar value on the stuff, it's usually chicken dooley stuff. Like, frankly, that 2x4 on the roof, should it be fixed? Of course. How much does it cost to fix? $50 to send somebody out at $25 an hour with a hammer to go fix it, right? So like, half of his video is about a $50 problem. It's a problem, right? And it's like, well, why wasn't it caught earlier? Agreed. That is a problem. But let me see if I have. I wonder if I could just do like the search on the iPhone and just type in the word like thermal, and if that works, that'd be cool. No, that doesn't work. It does show me insulation. How about if I put in FLIR? Ooh, FLIR somewhat works. Oh, this could be cool. Oh, I have pictures of my babies here with a FLIR camera. That's hilarious. It's what happens when you buy a FLIR the first time. You just like go around and FLIR everything. It's so fun. I found it. That is so funny. That actually worked. Okay, airdrop. This is whenever this loads. This photo is from December 2015. Look at this. Right here. December 2015. That's a window. That was just literally drywall. And, you know, this was in the winter, so, you know, I think we were running the heater. It's like 70, yeah, you can see it's like 74-ish on the wall, and outside it's cooler. And you could see the cool coming in, and, like, the builder literally forgot this little section here. Very interesting. Okay, so let's go back to what he's complaining about.
So this new build had a ginormous roof leak that had to rip out the walls and ceilings. If
Right.
you look closely, you can still see the big rectangle patch. This
Show?
is one of the downsides of waiting till you're 1 year for an
Okay, like, things get patched.
inspection. Look at this, new build. Underlayment already destroyed.
Yeah, okay. So let's do another one. Let's see if there's something that's more juicy, because that wasn't that juicy. It says the fourth one, this one?
What is up, Si? I wanted to give you an update on our house that you did an inspection on 4 months ago. If you look behind me, as you can see, our countertop is completely removed. And the reason why, if you come over here, this wall is completely warped. You can really see it with the cabinets that are leaning up against the wall. Not only that, if you look right behind me, there's still blue tape on the wall in a lot of areas on the house.
Okay, let's get to the point.
We gotta get fixed. So that is our update on our brand new build here in Arizona.
Well, hello, Romeo. Let me introduce you to my new build bathroom. Can I look at the tub real quick? Yeah. Just a quick peek. Was there any blue tape on it? Do you remember? No? Okay, yeah, it's just loose. That's all it was. Okay, perfect. Can I just grab a picture real quick? Okay, one more second again. Is that okay? Yeah, yeah. Okay. Okay. And then
What, the top panel's wobbly?
I'm really curious how it's going to look when they run the beat of Culkin, because you got...
Okay.
Wait,
Come on, dude.
better.
There's nothing in this. Like, that, there was nothing juicy in there. Okay, what's this one?
This is a German wall, made out of bricks and plaster. And look,
Yeah, this is also like the famous argument. It's like, oh my gosh, why do we build homes with 2x4s in America? Well, A, it's cheaper, duh. But B, if you built with bricks and plaster in an earthquake area, it would all crack. Your house would be crap. The lumber is flexible.
and how thick it is. 10 inches thick.
This is an American wall.
Yeah, so you're going to tap the drywall. Okay, classic, yes. Which is actually very interesting because in Germany, some of these thicker walls, they'll often even put drywall, like drywall layers on the inside so you could actually hang things. And then you would have that same echo, right? Like, you know, you want to go hang stuff in plaster? Go ahead and try.
It's made out of paper.
It's actually gypsum fiberboard, but okay.
And our exterior walls are made out of the same stuff. Just a little...
Yeah, I mean, these are like your vapor barriers.
Could say Arizona.
That's not the wall. That's not the wall. That's literally before you put the wall on, the stucco. See the metal? That's what you're gonna put the stucco on. That's just some of it drives me nuts. But okay, whatever. So let's go see what we have for. Let me see what they're talking about here with Hormuz really quick.
What goes across on the east-west pipeline across to the Red Sea there to load at Yanbu. Challenge with that is even today we have seen at Yanbu a tanker being struck there by the Houthis, and so this remains a very volatile situation. You can see that in the day-to-day numbers that are coming through, but the key point to bear in mind here, Brian, is that we are not at pre-conflict levels here, and prices are telling us. Prices are the things to watch here. You know, we've had a lot of thrown at us over the last few days, and yet WTI is hanging around 85, Brent is well above 90. So watch that price action as much as anything, rather than the minutiae of the day-to-day.
And I want to say that you guys have an impossible job right now, and you and your team at Kipler Marine Traffic are doing a great job. We've been calling attention to the charts. How about this? Is the one thing we can be certain of, Matt, is that prices are up, right? Because if you're doing ship-to-ship transfers, or if I'm putting oil from a ship to a pipeline back to a ship, I know one thing. It's going to be expensive.
That's part of it, Brian, but it's just we're not kind of back to that pre-conflict levels on a consistent basis. And so we are still here now, coming up to the 6th month of being in this conflict, and we don't see barrels flowing freely. That is the problem here.
Remember,
you know, we've got the problem on the product side of things. Refinery runs have been down for so long. We can see that coming through in diesel prices, right? They're double what they are for a barrel of oil.
We were gonna, before we keep going with Hormuz here, we were gonna keep going with this because we thought this was really interesting. So what is this? This is mold driving people crazy. So we were looking up causation versus correlation. We found that very interesting. Modern energy efficiency codes have lowered the margin of error for builders when it comes to moisture management. Right, because buildings have gotten so tight that they've actually started to include like fresh air valves to like let fresh air into the home because they're so airtight now. Insulation has gotten so good. Okay. So mold has been linked with exacerbating asthma, respiratory, online communities, functional wellness have connected it to emotional disturbance, heart problems, often without scientific backing. Yeah, that makes sense. You gotta build up the lawsuits. Claims have sparked a rise in the number of lawsuits against home builders. Homeowners say their builders have made mistakes when attempting to put up homes as quickly and cheaply as possible. Why do they underline this? Let me see. What is this? Flimsier cabinets and fewer windows. Home builders are skimping on the basics. Windows are expensive. Let's see here. Builders are opting for cheaper materials and rejiggering designs with cost savings top of mind. Yeah, I mean, it's just so expensive to build. This is an example of shrinkflation is kind of really what this is. So I'll make a little note on it. But it's shrinkflation turned quality deflation, right? To keep pricing lower. You know, these companies aren't making like a crap load of money. They're, and I'm not trying to defend them, but it's like the margins are tight because it's very competitive. Well, it's now feature smaller, and that's why a lot of the higher margin companies, they actually end up going into the luxury section. Like I would say Toll Brothers, I bet you their margins are higher. Let's go find out. SEC filings. I think they have a higher median sales price. I'll Google really quick. DR Horton versus, what's it called? Who did I say? Toll Brothers median home sales price. Let's just see what it says. So DR Horton on average sells for $370,000. Toll Brothers operates in the luxury segment closer to $1 million. Wow. Yeah, so this is a 3x difference in quality. So quarterly. Oh, they must have an annual then. Nope. I guess it's coming up. Okay, let's go look at that download. That would be PDF document. Toll Brothers. Toll Brothers 10Q 824. Kind of interesting. So here, the margins are, they're higher, but they're not that much higher. Actually, surprisingly, not that much higher at all. That's after taxes. Are we doing after tax on both these? Let me look at income from operations. What did I look at over here? Balance sheet, net income, income before taxes. Well, to isolate that, let's do 1226 divided by 9227. 13.2 operating. That's probably where they are. 346.6 divided by 2531. 13.69. Barely any different. 13.2, 13.69. Wow. That's interesting. Yeah, the margin's almost the same. And those aren't the greatest margins, you know? It doesn't hold a candle to, like, software, you know? Oh, well, look at this slow march up. But still basically where we opened this morning. Haven't gone anywhere. Okay. So let's keep going with that mold piece. So that's this. Let's see. Crown molding that used to be standard. Oh, cabinets with crown. Oh, okay. The cornice at the top. Okay, yeah. Okay. Mortgage relief. Let's see. This goal is to deliver homes without carrying. Functional homes without carrying avoidable costs. Sure. Of course it's trying to push margins up because the margins are tight. Vinyl floor, yeah. Yeah. Many homes now feel cookie cutter. Sure. Yeah. I mean, that's just compression. It's deflation. Let's see here. Inequality. Builders say the fears are overblown. Many of the lawsuits engage vastly different opinions on the health impacts of mold. Mold can cause different reactions in different people, and how it impacts isn't completely understood. TikTok and Reddit channels discuss toxic mold syndrome, a series of vague symptoms including sudden fits of anger and brain fog stemming from mold in the body. Oh, RFK says mold causes autism. Bro, everything causes autism to this guy, except red meat. Oh my gosh. People often attribute things they don't understand to dampness and mold. Okay. Mold litigation isn't going away. That's true. Many lawsuits pursue damages for more than the total value of the home. High-profile litigation involve a number of homes. Plaintiff lawyers are looking for hundreds of millions from home builders. D.R. Horton, the largest home builder, faces litigation involving thousands of Louisiana homes. Ugh. Who say shoddy building practices fail to keep the moisture out. That's probably why they're selling for, you know, such a low multiple. Let's see here. Its reservations for claims have risen to 1.1 billion at the end of fiscal 25. Wow. Meanwhile, someone will try Florida is alleging in litigation Lennar, a home builder, built more than 450 defective homes with improperly installed roofs and mold-ridden walls. Well, that'd be a problem if there's a big leak. Self-insurance reserve earmarked for liabilities rose 21%. D.R. Horton didn't respond. Lennar declined. New energy regulations make these issues more reasonable. Standards for keeping the envelope tight and insulated. Okay. The claims are tangential at best. Blah, blah, blah. Okay. Is this next to a tub? This is bad. Mold and... Oh, this is in a cabinet. Oh, this is under a drawer. Which is... That's a sink. So it looks to me like there's probably a... this could be as basic as like a caulking issue around the edge where the sink sits. And then it just slowly drips into here. You should notice that when you're using your stuff, though, right? But that's the problem is, like, how often do people look at the back of the cabinet? They don't. Or under the drawer. They don't. So this is why, you know, it's important to regularly inspect the properties. Inspections are really important. Yeah. Yeah, I think what this really does is it reiterates the need for inspections. Like, you got to know what the condition of your units are. We have a sort of a habitability app that we built. We don't license it, or I mean, maybe we will in the future, but it's for doing exactly these inspections on our units. So let's see. Mold Assessment Company said the home was uninhabitable. Mold assessor. At the end, $75,000 on experts. Just remove the mold. Like, dealing with this is you're spending more money. Ashley spent, dude, $75,000 on experts for this mold. Do you know how many mold problems I could fix for $75,000? Oh, and it's in Texas. So what it is she bought it in an overbought area. Now you've got buyer's remorse that the market value went down. You let the mold get worse. I don't know, man. This is a little shystery. Does it say where it is? Yeah, look at that. Bought her home in 2022. She bought at the damn top. Holy smokes. Let me go see if I can find the address. Home builder. I'm assuming she's in a lawsuit, so let's go find out where it is. Ah, there. Look at that. Suing home builder Lennar over severe mold and moisture issues that forced her to abandon her home that went under market value. That's probably what it is. La Marque, Texas. Okay. All right, here we go. Redfin Data Center. I'm not saying, the builders are right here. I'm not trying to take sides. I'm just trying to like put together like, as a reasonable person, what should your like actions be here, right? Okay, so let's see here. We don't know when she bought, but you can see the pricing has been nothing. So $260 was the median in September of 2022. And now we're sitting at $249. And they've gone as low as $227. $225, right? Let me see if I can find the lawsuit. Got it. August of 2022. There it is. Right there. That's when she bought. So, like, it's not saying that, there's, like, crap doesn't happen. Crap does happen. But I think sometimes there could be other incentives to making it seem worse than it is. Litigation is a good one. I mean, let's write down some of those. So we've got litigation lottery. Right? That's often what people are looking for. So you've got litigation lottery. I mean, she's investing in that litigation, right? More than what it would cost to like fix the actual problem. Litigation lottery is one. Buyer's remorse is probably another. Lack of inspections. Okay, so there are two types of these. Purchase inspections. Like, don't assume because the home is new that there aren't defects, right? And habitability re-inspections. That's pretty important. But, you know, as we've seen, you know, mold, it's not yet proven to be associated with any illness, but apparently linked to inflammation, inflation, and like symptoms, asthma-like symptoms. Right? Does that mean like you're gonna die because you were exposed to mold? Well, that's not in the data yet, right? So usually the solution is, or the best strategy, okay? Inspect, fix, reinspect, like, you know, check under cabinets, sinks, etc., and then deal with the moisture issue. If there is no moisture, you can't have mold. Without moisture, you can't have mold growth. You know, you can have leftover mold, but you can't have mold growth. So that's kind of my toolkit, if you will. Toolkit for mold. Okay, let's see what else there is on that. So we looked at that. That was the mold thing. We looked at this. We looked at pricing. We looked at this guy. And does he? Somebody says, did he just break a tile at 25 seconds? Yeah, well, they should be properly mortared underneath. I don't know. Okay, that's that. Okay. So let's now go on to NVIDIA for a moment. So what do we have here? And then we can always come back to this. AI build-out driving REIT demand. Oh, wait, let me listen to this for a moment. It's about real estate.
Is how certain is that power allocation? So the good thing is when we look at our investments in the listed REIT universe, the Digital Realty, the Equinix of the world, they actually have the majority of their pipeline that has contractual power. But if you look at some of the private players out there that have massive development pipelines in Texas and in some of these markets that are really front and center, when you think about the moratoriums, that haircut and that timeline and the ability to even get it done is real. And I think that is going to be a real.
But you're tying it still to power availability, not political permission.
I think in a way they are hand in hand. I do think that when there is contractual power with the utility companies, the probability of that getting done is significantly higher. But with that said, we are monitoring the permitting, the local jurisdiction, and whether or not they have the ability to get that done. And there are certain times and scenarios where things could get tied up in court. Yeah. There could be scenarios where timelines get much more prolonged. So I do think that is a risk, but the bigger the development pipeline, the bigger the risk.
See what's on Doom.
You mentioned dairy, you mentioned wildfire smoke. There's also some issues that came up at the last minute in the negotiations regarding trucks and whether they would be tariff exempt. As Prime Minister Carney mentioned, the U.S. seemingly wants to remove autos and steel and aluminum as areas in which Canada can thrive. So it just seems that there are various issues that have come to light, French language requirements. So, which is the most important one, we're not really sure.
Well, I'm glad you're keeping track of them for us, and we appreciate you taking the time this afternoon. That's Melissa Chin, Bloomberg News Toronto Bureau Chief, joining us from Toronto. Coming up next on Bloomberg Business Week Daily, a check of markets and stocks on the move. This is Bloomberg.
Okay. So, where do we sit now? Let's go find out. See what else there is. info. Amazon becomes vital sales outlet for independent merchants. Sure. Like, if I was selling a product, I would absolutely want to get my stuff on Amazon. NVIDIA discusses Perplexity investment at $30 billion valuation. Wow. Okay. NVIDIA and Salesforce in the spotlight this week. Oh, good old earnings. Good old earnings. While NVIDIA costs are going up, memory chip prices are rising, raising the prices to maintain. Right. Salesforce will be the same day as NVIDIA. Well, that'll be very interesting. Okay, let's try. Let's see what other info we've got. So, Bessent announces Operation Economic Outcast against Iran. It's just sad. Is Scott Bessent the Fed chair Trump always wanted? I feel like weren't there times where he's like, oh, you should just do both. I'm pretty sure it was. The search for consciousness inside of LLMs. Okay, so this is going to be an AGI piece, isn't it? I'm pretty sure this is an AGI piece. Recent experiment on Claude Sonnet 4.5, LLM from Anthropic. Researchers asked it to count to 5 and at the same time introspect deeply. So the artificial intelligence model complied. 1, 2, 3, 4, 5. So far, so normal. During the task, researchers were watching what was going on inside of the neural networks. When a user asks a question, the words are turned into chunks of tokens, text, that are converted into numbers. They're then passed through artificial neurons to reach a final layer, which produces a token. Repeat the process a bunch of times, you get another series of tokens, blah, blah, blah. For a long time, these layers have remained in a large or black box. Okay, Anthropic researchers were able to look inside those layers using a mathematical tool they had developed. What they found surprised them. As the model counted the sequence of numbers, different words popped in and out of existence in the layers underneath. One was countdown. About halfway through, halfway appeared. Then the words consciousness and AI and Claude all appeared. After the model spat out the number 5, it did nothing else. But the word done appeared. Something like an internal thought process in Claude, words that were related to eventual outputs but invisible to the user. Okay, this isn't a big deal. That's just the way it achieves or arrives at its final answer. Let's see. Anthropic's researchers. Okay. The idea that machines could become self-aware and feel emotions has been, a staple of film, literature, and legend. Blah, blah, blah. Illusion of conscious personhood. Chatbots has given rise to the illusion of conscious personhood. What a line. That's a crazy line. Chatbots, the rise of chatbots has given rise to an ever more powerful illusion of conscious personhood. Man, that is like a 50 IQ line right there. Holy moly. Okay. Intel inside LLMs do not in fact work like brains, but they excel at simulating much of our brains do. Many philosophers, biological traits might be necessary to produce consciousness. Biological traits might be necessary to produce consciousness. So no AGI? Conscious AI would have implications for humanity. They could suffer, this, that, blah, blah, blah. I don't think we're really getting anywhere with this. All the neural correlates can find another, blah, blah, blah. Think different. That's the Steve Jobs line. Unlike the activity of animals, which are observed, outputs of LLMs are not a reliable guide of what might be going on underneath. This is because the training of models requires feeding them trillions of words of human-produced language. These contain countless accounts of consciousness and how humans convey feelings to each other. Right. The sum total of this training is... I don't know what the heck that word is. That's crazy. I think it, like, to me, my takeaway generally in this, that LLMs are really good at replicating us because they're trained on us. Okay. So let's see here. LLMs over time. What did they say? Biological traits. They score lower. All right. Yeah. Not so useful. What is this? Don't care about the seafood shack. Local business group sues Mamdani over plan to open municipal grocery stores. That's interesting. Wall Street is counting on Nvidia to keep the party going. All right. Let's see. Excuse me. Oh, yeah. Okay, here we go. Local business group sued Mamdani. Coalition, blah, blah, blah. Will put us out of business, basically. Well, yeah. I mean, that makes sense. The government's basically in a lost lead this. Escalated U.S.-Canada threatened diesel prices. Man, getting a little boring. What's going on? Okay. Where's the entertainment? Go look at them sticks again. We'll have to start talking about mold again. Still down 80 bips on the Qs. No. Okay, so Bloomberg, what is this? Musk sees SpaceX's orbital data center launch near end of 27. I mean, his time frames are always a little funny, but I'd like to see what they're talking about. Broadcom credit risk soars on mega debt financing. Yeah, it's always debt financing. Let's see here. Okay. This is interesting. Decreases in home values due to general economic conditions can lead to an increase in meritorious and non-meritorious construction defect claims. Interesting. I mean, that's not a surprise. And I also got some trends here on the warranty reserves and how they've sort of been moving. And pop those up really quick. So, okay, let's throw this up on screen, and then we'll go to the SpaceX one. So that was here, housing. Gonna work. Oop, nope, not yet. Come on. There we go. Wall Street Journal on construction defects. Okay, perfect. Now I can put the picture in. Okay, perfect. So basically, Wall Street Journal has a story on increasing construction defects related to mold. I pulled some data and found warranty reserves and accrued liabilities, including litigation reserves. Rising. There is a link between values going down and more lawsuits. And then let's just throw in my thesis. Why is this happening? Okay. Why? Okay, then I want to see the SpaceX story, and then we can always summarize the housing one. Cool. Just put my notes somewhere. Okay, so what's going on here with SpaceX? Elon Musk says SpaceX's first AI satellites powered by NVIDIA will initially launch in the fourth quarter of next year and hit significant scale in 2028. This is not a surprise that this is just, 2 days before the NVIDIA earnings. It's sort of like the Grok announcement. Oh, we're in full production. And now this. Oh, yeah, look at this. So this is the Grok announcement. And then Musk, wouldn't shock me if Jensen's like, hey, man, can you give us a shout out before earnings? SpaceX, in partnership with NVIDIA, has designed a space-optimized Reuven NVLink 72 system for launch to orbit in Q4 of next year with significant scale in 2028. That sounds good. And then, of course, you've got NVIDIA replying with the little clap emoji. So it's like, hey, Elon's got to pump it up before earnings. That's cool. I think the space compute thing is a little ahead of schedule, and it's being hyped a little ahead of schedule. Put it that way. Public approval of Iran war falls to 31%, and Trump's approval sits at 33%. Oh, that's interesting. Pretty low. Okay. So let's go to... Let's just go see what else is going on out there. Times, Trump the tariffs. We saw this. Go see what some of the institutions are saying in a moment, too. Microprocessors made by NVIDIA are powering Moscow's AI drones. That's not good. Okay. Let's see what we got over here.
Very viciously.
Is there a level in the 30-year yield that would cause the Fed to move in? Because you're saying the market's in control. How does the Fed react then?
Well, first, I think the 30-year, while it's valuable for a lot of long-term investors to model their portfolios, the 10-year is really the most important rate to look at. That's, if you are a CFO today, that's what you're looking to model your business projections. If you are an investor, that's what you should be looking for. So the 30-year, I think, is not the right rate. I would argue the 10-year is the right rate to look at to figure out where the economy is really going in the longer term.
When you think about kind of what these long end rates are saying, what are bond investors kind of telling everyone about inflation and about the macro environment right now?
So first of all, bonds investors should be really satisfied today. They have been chasing spread. They've been really effectively trying to figure out if spreads widen or contract to earn their outcome or yield. And the rates resetting give them some comfort. Now, the downside of that for bond investors is they have very little to work with now. Yields are the spread is so compressed that if you pick the wrong credit, you will have losses on the credit side. And that makes it very tricky to be a bond investor right now. So the end investor is much better off the fixed income managers have to be smarter in this environment to pick the right credit. So it's a different situation now in the marketplace.
Does that create maybe a little bit of stasis? I mean, we had the head of PGIM's business, fixed income business on last week, and he said something similar. He kind of quipped that, you know, he's a credit investor who hates being a credit investor right now.
Yes.
Yeah.
You are so right. And then I would expand that, Romain, to say the credit market is not just public fixed income. There's a very, very large and growing private credit market. And so from my standpoint, I would look at credit across both public and privates. And I know for the longest time, people have to choose between one or the other. I would say this is not the time to choose between one or the other. You pick the liquidity you want, you pick the risk level you want, and then you can find value everywhere.
Well, can I push back on that? Because, I mean, let's just fold in all of this debt issuance that we're seeing surrounding the AI trade. Because that definitely seems to be competing to a certain extent with basically any other sort of fixed income asset right now. Is that something that will sort of right-size itself in due time? Or is this going to be a longer-term story where as long as these issuers are, I mean, they're coming to market with issues that are bigger than some of these treasury auctions?
You are absolutely right. We are seeing a complete re-rating of how large our credit markets can get. Our public credit markets have always been large, but the private credit market got very large, and now you see a lot of crossover credit happening. You could argue where it's going to be sourced from. At some point, you get to a natural capacity limit of how much credit could be issued. But right now, they're all re-rating. And they're re-rating because you have these borrowers who have never borrowed before. So they are not leveraged. They're not under stress. And that's allowing the market to expand today. They will hit their natural limits. And like any credit cycle, you will see stress. But that is not for today.
Talk about those limits, though, and kind of when Principal expects to hit exposure limits to single names, to names that haven't been raising and now suddenly are raising billions.
Our view is in certain parts of the economy, you are at that limit. You know, there's a lot of talk about AI, and AI is not just a credit issue or a stock issue. It's an economy issue. And there are parts of this economy that are going to get resized because of the AI effect. And so from our seat, you have to look at credit in the context of where the economy for that particular sector is getting resized. What might have looked well 10 years ago doesn't make sense now from a limit. And we have to constantly think about the flywheel effect of economy.
I always think it's interesting when the suits start getting on saying, oh yeah, you know, we're gonna be a little more conservative with the debt. You know, we've been a little too aggressive with the debt. 10 years ago, bring on the debt. Today, there's still opportunity, but we're going to be a little more conservative. Yeah, whatever. Clown show.
Corporate debt issuance, like the bigger things that can really
they're talking about debt issuance too!
But that's where they're much more concerned about what's happening with things like the national debt right now. That's getting a lot harder to swallow, those huge numbers that are coming out there. And I think that's probably going to have more of a weighing. But
huge numbers, so hard to swallow.
I think at the end of the day, as long as earnings are hanging in there, and they are, and I think this week we have NVIDIA on Wednesday, and then we have the Fed speaking on Friday, I think NVIDIA is going to be the bigger story. But if they can prove that this AI demand story continues, and especially what they're saying with memory chip pricing, and how that's affecting their demand and their customers' affordability, I think that's going to be a lot more important than what the Fed says or doesn't say, because people want clarity. I think the one thing we know from Warsh to this point is he doesn't want to give that much information. People just need to get used to it.
Well, I just wonder if he's now, in some respects, forced to give more information. Don't forget, it's not a news conference. It's no Q&A. It's a speech. And we remember when Chair Powell gave his speech right before the rate hike regime. It was 8 minutes. So who knows what we're going to get. Do you agree, though, that NVIDIA is the biggest story this week because you don't expect
I've argued
much
on the show
Friday?
AI is a much bigger story than the Federal Reserve. And I've made that case. I'm certainly not alone, but I've made that case for a year or two. I'll just add real quick with respect to Warsh. Everyone's focused on the forward guidance side of things. If there is going to be a surprise from him this weekend, it's going to be him, I don't want to say feeling the pressure, but choosing to respond to the demand, not for forward guidance, but for some...
So Jackson Hole starts on the 27th, but Warsh's speech is actually the morning of the 28th. How interesting. She is right. The agenda comes out on the 26th. The reception is on the 27th. Warsh delivers the opening speech on Friday. And then you get like the interviews and panels and all that stuff. Huh.
Guidance. But I'm not telling you today, this is what he was saying, I'm not telling you today where I'm going to hike or cut, but I feel like I can give you the ideas in my mind on what the mechanisms are to get us from point A to point B.
Sure.
Rick Reeder agrees with the reforms that Chair Warsh is talking about making, and even he last week when he was sitting here says the market does need a little bit more, so maybe that it can settle down.
They need better tools to figure out the accuracy of inflation, right? Because that's the other thing that they're focused on. It can't just be core PCE. He's looking at a lot of various different metrics, looking maybe at the trailing 3-month. That's what Rick Reeder also talked about. The trailing 3-month is 1.6% in CPI. So there's other ways to look at inflation, and I think that's what they're going to try to say. And I just think it's too early, Scott.
Yeah. And I'll just add real quick on the NVIDIA side of things. As Courtney and Steph just both argued, and I would agree, everyone expects them to beat and raise, that the quality of the earnings report in that sense is not really questioned. The issue is going to be around, as Steph alluded to, what we'll call the circular financing and the funding of the AI infrastructure. I think if Christina Partsinevelos was here.
And she's going to be here in a second, right after you're finished. But go ahead, finish your thought, I'll bring her in.
I imagine what she's going to say is the company's position is we have all this money, we generate a ton of money, and we are seeding our future and the industry's future for the next however many years.
Let's bring her in. Christina is waiting anyway to talk to us. And look, the stock's been on a 6-day losing streak. It's down again, and that was after a nice move higher. So it maybe complicates the story for investors a bit going into Wednesday.
Because investors right now are just hesitant what's going to be that next major catalyst to move the stock, which is maybe why they're not getting in. Dan mentioned it, the numbers at this point really aren't the story. Beat assumed across the board. We know that. Demand surging, lead times have stretched from 6 weeks a quarter ago to nearly 40 now. Wall Street actually is specifically in the guide, the first real read on how fast the new Rubin chips are ramping, the next iteration. Then there's also the margins. NVIDIA told customers it's raising AI server prices as much as 17%. It's reported that, driven by soaring memory costs. The question is whether that protects its mid-70s gross margins, you can see on your screen, which is estimated to decline in Q3, maybe even more, or if memory still eats into it. Watch, too, also for the Vera CPU, a new multi-billion-dollar line as AI agents take off. And then, to your last point, all of you on the panel, hanging over it is the circular financing debate. NVIDIA is bankrolling the same customers who buys its chips, like it's up to $105 billion backstop for an OpenAI data center in Ohio. That's just one example.
That's where this, I'm going to pull it up. This, there was a section of the All-In pod that drove me nuts, because Sachs just laid out this data that I just thought was not right, and I think it's worth talking about. Let me go find it. Okay. Oh, I found it. Okay, that's, yeah, where they also talked about the DSPs and all that. Okay, so this is the, like, a week ago one. Let me see here. This was, yeah, 9 days ago. Okay, let me pull this, because this is like the foundation of what's going on with hyperscaler spending. And we need to find 40. Let's see, where in it they specifically talked about 100. Let's see if I can find that. That was financing plans, how the market can all fall apart. Yeah, okay. Here we go.
Speaking of our guy, Jensen,
Where was it?
I would find it. Value guarantee.
It was. Come on. Overbuild. Okay, I will find that. Oh, but I can't. No. It's impossible to find. Oh, whatever. I might just not reference it, but it was in this segment. Let's just look together.
And you
your GPUs, that'd be a disaster for everyone. This
Here.
is that you get a glut of compute and you get an
Got it.
overbuild.
That's it. You get an overbuild.
And in the same way that we had dark fiber after the dot-com crash, if you had dark GPUs, that'd be a
Okay,
disaster
so
for
that's
everyone.
at 103, but where does he mention... So that's at 103, call it 20. Where does he mention the 100 ARR?
Outcome. Because it is so hard to build gear. Can I shift gears for a second?
Absolutely.
To tell you what's so brilliant about what Jensen did
Well,
here?
there's
Or
one
Gavin, you
part,
wanna respond to that?
no.
Drained by the ability to finance this build out. And what he's doing is alleviating that finance constraint so that he can grow as big as the TAM actually is, right? It's
Right.
talked about on our previous session.
But where's the 100?
I think Wall Street banks and private equity firms providing financing based on the expected cash flows that will be delivered from these GPUs.
In some ways, NVIDIA is kind of becoming the central bank of AI.
Yeah, we've made that reference as well, that Jensen's Powell.
Protected, right? You have asset-backed financing, and
Not worried about this.
Where's the dollar?
A mortgage-backed security.
Well, that could lead to a car crash. But actually, this is why I think it's the Anthropic IPO is really important for the market.
Here we go.
Is getting those quarterly earnings,
Yes.
to be able to see their numbers every quarter. I think it'll become probably the most important signal that the entire industry has.
He's so
Why?
right.
Because you've got all these people out there saying that AI is a bubble, this CapEx is not justified, there won't be an ROI, and everyone's going to be looking to Anthropic's quarterly earnings as the pace car. Not just them, it'll be them and OpenAI and SpaceX, but you'd have to say that Anthropic right now is the pace car. And they're going to be looking to them to see if the demand signal is there. And if there's a hiccup or a wobble, you know,
It'll
the
show up
industry
there first.
Yes, it will.
Comes on the brakes.
If
Where's
the pace
the-
car slows,
100 billion. 100 billion.
Everyone in the chain. Everyone. And I think the Anthropic S1 is kind of going to make that clear.
I will find it. Because there's a part where he kind of hook, line, and sinker sort of absorbs. Oh, I found it. Oh, okay. It's right after the 103 part. Ah, okay. Oops. Where did I just put it? What did I just do with it? It's all right. No problem. Got it. Okay, so it's about 104 in. So I gotta write the times down when I write these notes in the future. And I don't have to re-find it.
Tweet.
Okay, so 104.
They get sent overseas.
I'll tell you where it could, all of a sudden there are too many people racing to provide this compute, and now there's an
Where's the
oversupply,
Elon part?
and the market crashes. Sure, against that outcome, hysteria / hoax T that there's not an oversupply relative to that. Jensen did share. What Jensen did was so brilliant. It's because the numbers are getting so $1 billion of capex. The company just raised $100 billion, and it can grow as big as the TAM actually is. Right? It's removing that constraint. So, for just to take one example, Elon wants to add somewhere around 6 to 8 gigawatts next year. We know that that would cost $300 to $400 billion of capex. The company just raised $100 billion in its equity and debt offerings. So obviously, they would have to go out and finance that somehow. And as we talked about on our previous episode, the simplest way to finance it would be to get seller financing from NVIDIA, especially given that the payback period could be as quick as 1 year. So now Jensen is creating you could say the line of credit using these big banks, using these big private equity shops, and he's making that available. And that's going to now benefit all of these downstream purchasers.
Yeah, but that's still not where my Elon comment is, because he buys the 100 ARR hook, line, and sinker. Let me see here. I'm going to try the... Oh, is it at the beginning?
Run rate, we talked about this a bunch, will end the year between 100 and 120 billion. This is an extraordinary ramp up of revenue that we have never seen in Silicon Valley. At a $2 trillion valuation, obviously you all can do the math, but it's 16 to 20 times sales, which is a fraction
in this
of
segment.
what SpaceX...
That might be one. So where's the Elon part? Dang it! Alright, that'll be my last look, but I'm pretty sure should be able to find it. Is it here?
As you know, Elon said that they were expecting, right? So if all of a sudden there are too many people racing to provide this compute of compute, and you get an overbuild, and in the same way that we had dark fiber after the dot-com crash, if you had dark GPUs, that'd be a disaster for everyone, especially if you built out your compute infrastructure expecting a spot price of $30 to $50 a watt, as you know, Elon said that they were expecting, right? So if all of a sudden there are too many people racing to provide this compute, and now there's an oversupply and the market crashes, that'd be the risk factor. In a weird way, all the political headwinds, I think, insure against that outcome. Because it is so hard to build data centers for all the reasons we said. There's a whole...
This is an argument that has been circulating as well. I personally think these companies hedge by building in multiple places on purpose to avoid that.
Panic slash hysteria slash hoax going on. That actually, it's those political headwinds, I think, will almost guarantee that there's not an oversupply relative to the exponentially growing demand. So
that's really helpful. And he's comparing that to exponentially growing demand. Hopefully it does actually grow exponentially. Okay. All right. I think 109. Let's try this.
There'll be a pileup of companies behind it, because Anthropic, they're making 100 billion per gigawatt. Okay.
No, they're not. That's the line I've been looking for. Found it. So they're not. They're making, you know, that was a sort of fatal flaw. Because right now they're expected to have, what, 64 billion? So call it ARR now, annualizing 1 month after Claude, right? So we get this explosion in Claude in Q1. So we get a $64 billion ARR, annualized ARR run rate. Okay. Current gigawatts. 1 to 2 disclosed. Okay. Capacity 5 gigawatts. Oh, there are multiple 5 gigawatt deals. I think there are 2 5 gigawatt deals. What deals are they doing? Anthropic secures. Let me see really quickly. Google, Broadcom, and Amazon. Right. So that's what it was. Let's write that down. So capacity, I've got 5 gigawatts coming from Amazon. And then I've got another 5 gigawatts coming from Google and Broadcom, who's now taking on debt to kind of sort of, you know, make that happen. Okay, so that's our annual run rate now in billions, which sort of implies, well, I guess, oops. Oh, I screwed that up. Oh, there we go. Oh, man. Hold on. Why does that not work? I just want a new line. I just wanted a new row. I'm so bad at remembering which key it is to put a new row. Okay, current gigawatts at 1 to 2. So best case rev per gigawatt, 64. That's best case scenario. Worst case rev per gigawatt, would be the lower end. So that would just be, 64 divided by 2, right? And then so if you take the midpoint, which is potentially more realistic, so midpoint rev per gigawatt is actually probably somewhere around 64 divided by 1.5. That's just taking the midpoint. That's probably closer to their ARR, but after co-work explosion, right? So how sustainable is that? But markets, as you just heard from Sachs, right? Sachs buys hook, line, and sinker 100 billion ARR per gigawatt. Enough to pay Elon's 30 to 50 billion per giga. Most expect the break even, or I shouldn't say the break even, most expect the stabilized revenue, or I should say cost per gigawatt, to be closer to $8 to $14 per. So, hence there's a big multiple. And it's like, if this is right, if this is correct and this is correct, very bullish, very bullish. This would then be neutral to bearish, right? And then obviously oversupply would be even worse, because that's not oversupply pricing. That's like neutral pricing. So this would be even worse. Returns. So that's the question. That's the danger you want to avoid. And based on Anthropic's current numbers, we're at 42 in revenue. Okay, that's not enough to pay for 30 to 50 in cost. That's why you lose money. That's why I actually agree that the Anthropic IPO is so freaking critical. So I think that's really useful information, and why, like, people are on pins and needles about this Anthropic IPO as a catalyst. Okay, market closes in 30 minutes, but we'll go through that more in just a moment. We'll kind of summarize that, string that together a little bit more cleanly. Wow, look at that Tesla bounce, right on my line. It's like within 70 cents of my line. SpaceX, right on my line. Walmart, a couple days ago, bounced on this line. Right here. Well, I guess it's more like rejected it yesterday, or Friday, rather. Okay, how else are things going? Qs, still a little bit of that bleed. Kind of expected before all these big catalysts. Although that, Bessent announcement was a nothing burger, huh? All right. Here you go. Throw another coffee on and turn my tea on here. And then we'll summarize some of these things and kind of keep looking. Okay. Oh, hold on a sec. So, what is this? Samsung HBM was up 122% quarter on quarter, suggesting HBM revenue to rise 80% quarter on quarter. Nice. Hyperscalers have lined up $2.6 billion of future spending. Yeah, that's crazy. And it's a lot of it is to service this data that we just went through. Okay. Yeah, we heard about Bessent's end of the week threat, which is really just to kick down the road again. That's their classic nonsense. Let's kind of see what else is going on here. Let's see. Anything in the wire services? Not really. After the Bessent meeting, we really haven't gotten any kind of juice here. Just approval numbers. That's boring. I wonder how the JPY is doing. Let's go look. USD. Ooh, yep. Deteriorating as well. 159. It's almost back to 160. Bessent couldn't do that either. Oh. Ay. All right, let's listen over here. I'm going to go get some coffee and I'll listen in as well.
Connecting the two brands' audiences with benefits like redeeming Built Cash for credits that can be used towards Equinox experiences. Pleased to say joining us here in Studio 2 is the CEO of Built, Ankur Jain, and Equinox Group Executive Chairman Harvey Spivak. Great to have both of you back here on the program.
I mean, this is great. It's our first time doing this together. This will be fun.
It will be fun.
Thanks for having us.
Well, I know how great Equinox smells on the inside. What does Built smell like now? No, in all seriousness, talk to me.
By the way, in every move-in at a Built apartment building, we should probably give you an Equinox eucalyptus towel as a move-in
You can
gift.
smell them on the street. Walking by an Equinox, you know there's an Equinox here.
Now. I'm good.
It's better than the Abercrombie smell in high school.
Wow. All right. Well, there you go. All right. Let's start. Let's get serious now. But I am curious, though, Ankur. I mean, we talk about the partnerships you have. Obviously, apartment buildings, airlines, hotels, restaurants. Why gyms?
I mean, look.
Yeah.
Built today represents 1 in 4 apartment buildings across the United States. And when you move into a new home, you're resetting some of the most important lifestyle decisions that you have. It's what's your new pharmacy? What's your favorite go-to restaurant and bar? Where do you park your car? And one of the biggest decisions everyone makes is, what's my new gym? And so when we thought about what's the gym that we want our members to connect to and have our concierge be able to coordinate your training sessions, your spa, your workout classes, I mean, there's really no place better than Equinox.
I certainly understand what you get out of the partnership with Equinox. Harvey, I'm going to kind of pose the same question to you because I've always looked at Equinox.
All right. Back. How to get to coffee in a quick little bite. Okay. So where do we stand? Well, we need to talk about the sacks, the mold. What's this? WAPO. Seniors making 6 figures reach over 1/3 of all Social Security benefits. Wow. Well, I mean, you paid into the system for your whole life. All right. We saw the Bloom Energy. Nancy Pelosi. Good old Nancy Pelosi. A splash of Bailey's in your coffee. All right. What else here? Let's go see what these suits are saying. Let's see here. So this is about Warshy Warsh. This is JP Morgan. JP Morgan. Fed chairs, open remarks on Friday morning. Jackson Hole. Blah, blah, blah. Often not marking move-in. We'll see about that. Standard deviation of daily changes in the 2-year is around 5 bips. Yeah. That's in the daily changes. Okay, daily. Well, whatever. Let's see. The Fed chair's opening speech typically addresses bigger pictures for monetary policy. That's fair. It all comes down to a surprise. So we did this analysis, and our analysis indicated it all comes down to the surprise factor. If we go into Friday expecting limited action, just like JP Morgan says here, the risk is a hawking. The risk is hawking and a surprise. The pants get put on, so to speak. Let me see where we had the data on that. That would be Fed in the Meet Kevin app. Oh, 20th, 4 days ago. Where did we talk about? Here. A history of surprise J-holes. Dovish surprise in 2025, hawkish surprise in 2022. And so when you get the hawkish surprise, that's when the market really has a poopers. So, I don't think we'll get it, but there's always a risk of that. Okay. So, what else? So that's a nothing burger. Specifically, the after effects of the pandemic forced the Chair Powell to communicate sizable shifts, blah, blah, blah. Could resemble the more muted Greenspan years. What? Look at this. With Chair Warsh eschewing forward guidance, this year's market response could resemble more of the muted Greenspan years. Right. So that's why nothing is the base case, because everyone is convinced we'll get no forward guidance, and then he'll move on. Makes sense, because that's what Trump would want right now, too. And it's kind of like a puppet game. Like, see no evil, speak no evil about, like, what actually is going on. Okay. All right. What about over here on Warsh? This is Morgan Stanley's. Some negative momentum in equities has continued. Pullback in treasury yields follows sizable announcement. Yeah, last week, and the reversal. Ongoing oil price rise. 12-month Brent futures hit a 2-month high on Friday, which isn't far off the peak from May. So expectations of oil prices, of those higher oil prices, put upward pressure on yields as well, right? Conflict is said to stay in headlines. Right. The greatest coordination of economic isolation in the world. That was a joke. Terrorists are back in the headlines with Carney. Looking ahead, we've got Jackson Hole. In the last meeting, he hasn't decided yet whether Jackson Hole will be big picture or more of a traditional setup for action we're going to have between September and December. Right. So, if Trump puppet, he does nothing. Base case. And then if pants on, hawkish, bear case, there is no bull case. Bull case other than getting over it, right? The bull case is like you get the meeting over with, which is nice. And then you just don't have it on the calendar anymore as a caddy. Thanks. If Warsh goes for the big picture speed, any option include discussion of Fed task forces, AI's impact on the economy, alternative speech. Warsh could do a cleanup of the July press conference. That would be bearish. Counter one market narrative that the Fed policy actions could be delayed until the task forces have completed their work. Right. That would be a bearish risk. Whatever he decides, market pricing very much in balance for next meeting. Futures pricing in 39% chance. Okay, so let's go look at what rates are pricing in. Going all the way out to even like December. Like, what's it look like in December? That would be very interesting. And we have that right here. 42% chance now of a rate hike September 16th. October is pricing in a 43% chance that we don't raise rates. And then December is pricing in Only a 25% chance that we don't raise rates. Wow. Market treasure's coming. The rate hike's coming. Okay, let's go to the summer of next year. By June, there's only an 11% chance that we have not raised rates. And only a combined 42-ish% chance that it was less than one rate hike. And then a year from now, 11% chance no rate hike. Yeah, that stabilizes around 11, 12%. Wow. Dang. Market's pissed. All right. What else? More threats from Bessent. We've reviewed. Wall Street Journal. We've gone through this. Polestar says they were drug along by Trump. How about the Doomers? What's going on over here? Bond traders have ramped up measures of credit risk associated with Broadcom as it backstops mega financing packages. The yield on Broadcom's 5.15% bonds that mature in 2031 rose so far in August. Yeah, and their CDSs are moving up as well. It's not great. All right, let's listen over here for a moment. I'm going to eat some chicken in the meantime.
Go from here could have a big impact on how stocks will trade in the weeks ahead, of course. Chris Ferrone, Chief Market Strategist for Baird Strategas, joins us back at Post 9. Welcome back.
Great to be here.
How do you feel about the market, given what's at stake this week?
I mean, you have to tip your hat to the resiliency of this tape, not just with yields, what they're doing with semis and tech here again. This remains a highly, highly rotational tape. And you've seen healthcare emerge, I think, as the rotational winner over the last 3 or 4 months.
And you believe that.
For us.
You believe it.
Listen, that's been a very vocal call for us this year. It remains such. But also, look at other parts of the market. Materials.
I agree with that. I think there's a lot of opportunity in healthcare, actually. Big fan. I mean, the Moderna stuff is just, I feel like, the tip of the iceberg.
Mindful that maybe some of the industrials are starting to soften here a little bit.
We were talking about that earlier with our panel. Is that related to the cyclical trade and to rates?
I don't know. I think there's a very split industrial sector emerging. It's not just unique to the U.S., it's true globally as well. It seems to be running parallel or coincident with this weakening of the utilities. So you wonder if there's this overhang into the midterms with the data center build out.
Do you think that's an issue? I want you to tell me more about that, because I'm asking everybody about it who comes on and talks about those types of stocks that have had weakness of late. As this issue has grown louder, the polls are really going one way. And you have to imagine, as you just said, as you head even closer to the midterms, it's going to get megaphone-ish.
Well, I think it's important. These are corrections and uptrends for a lot of these names, whether it's Caterpillar or Cummins or Quanta. They're still in good long-term uptrends. If you're going to follow the typical midterm pattern, they should bottom ahead of November. And we'd look for that to kind of lean into some of the strength here. And I think additionally to that, when you look globally, banks still act great throughout all this as well. So I can't think of many times in my career, Scott, where global banks are making new highs across the board and you're on the verge of a big problem. And
Okay. What happened? That's it. They're cutting us off. They're cutting us off. The Chinese are cutting us off. All right. Let me see. I'm going to go in the meantime look at, let's see the poly market pricing. Somebody in the chat suggests that. Poly market.
Still in an uptrend, I want to give it the benefit of...
Okay, let's just back off of that. Poly market, September rate hike. Let's see. So, that is being priced in at only 33%. So the September rate hike over here is priced in at, I mean, that's close. That's close to similar. And then rate hike in 26, poly market puts a 56% chance with 7.9 million of volume. So if I go over here, it's a little lower on poly market on both sides. Let's see here.
You know, I would be more worried about it if that move out of the semis was a move out of the asset class of equities, but that's just not what has happened here. As they've sold the semis the last 4 or 5 days, we're back to the highest percent of stocks in the S&P above their 200-day all year, 75%. This is a market still with pretty good trends, maybe not the momentum profile that drives us to new highs immediately here, but I still think we're in a relatively good condition to be a buyer of oversold condition as we get into the fall here. And just on rates for a moment, I think the big miscalculation all year for a lot of people is picking a number on yields and saying, okay, that's the level where trouble comes. I think the level where trouble comes is not a level. It's when the leadership shifts very defensively. And we just haven't really seen that to any big degree here. When the market is telling you higher yield,
when Anthropic rolls over.
but it's defensive taking hold, that's when I think your alarm has to go up.
Staples and utilities are the two leadership groups today. So,
yeah, I mean,
I'm not going to say one day means anything, but
utilities are a day removed from 52-week relative lows.
Yeah.
So let's not take one day there.
Sure.
I think on balance, money does not want to leave the asset class of equities. 470 10-year yield is not the level that does.
Why would you?
Not yet, but the Qs are falling into the close now, which you kind of expected with the leverage rebalancing that we warned about earlier. That on a red day, the close often gets hit. Well, not always, but I see volume coming up a little bit right now. So, we'll see. We'll see how it continues. Netflix, Intuit, Salesforce, green, ServiceNow, barely green. Bloom Energy, Nancy Pelosi trade, already fading. Yeah, oh well. Darn hardware. Okay, what about the wire service? Let's go look at the glorious wire service. Oh, I gotta sign in again. We're fixing that. There's way too much signing in. It's like every time I open a new tab, I gotta sign in again. Okay, so let's see here. Pentagon Chief Administration has not ruled out using military force against Iran. Oh, great. Just what we want. Chipotle, volume up. Are people buying the dip on Chipotle? OpenAI ChatGPT 5.6 model family is now available. And then there were the approval ratings. Let's go look at... That was CMG. CMG is at $37. Down to $48 billion market cap. Kind of a messy fib here. Good rejection here. That's a good test. This has been a great line. But this has been more like a rubber bander. All right. No problem. No problem. Google's up 1%. SpaceX still 134. Bitcoin didn't quite make it to 80. Just rejected 80. Let's see here. United Health's almost at $400. So definitely a pop-up over here on United Health. And they went through some heck of drama there, huh? All right. See what else. Kratos Defense, or Kratos, they're down 7. Oh, wow, look at the momentum this had. This is on the week chart here. Market cap at 10 bill right now. Oh, they've really come down since about January. That's interesting. Starbucks is breaking through 100. Wow. Boy, they've been trading in kind of all over the place for a while. Boxable still exists. I just can't even believe this thing went public. Like, this was the SPAC level, and so after the SPAC, it's down 60% or whatever. But I think this is even before the lockups that are still coming, like a lot of them. What do we got over here?
Watching, what do you see?
Expedia, because this company is the S&P's top performer right now, hitting a new 52-week high. On Friday, Evercore lifted its price target on the stock to $430 from $375. You can see it's trading only at $339 now. So travel stock peers also higher today, including TripAdvisor, Airbnb. So the flow from Friday moving into today. Shares of Canada Goose, unfortunately dropping on a double downgrade from Wells Fargo. Analysts say President Trump's new Canada tariffs now represent a bigger headwind to full-year margins, and the super El Nino weather event also could hurt the brand's key outerwear season with record warm temperatures expected. So shares down almost 6%. And then shares of Rum Group, which hosts President Trump's Truth Social platform, are gaining after the company entered a $13.7 billion deal to supply an unnamed cloud company with AI chips. Rum Group said it currently lacks the funding to build out its own GPU infrastructure and plans to raise the money through debt or equity. Shares up 2%.
Christina, thanks so much. Thanks. Christina Partsenevelos. A break. Get in the market zone is next.
Relentless innovation has changed the way we invest.
Just the timing.
Innovator
timing. All right, no problem. It's okay. It's like they literally just came back from a break. I'm like, all right, I'll be able to listen to them yap for like at least a minute. All right, nope, just kidding. We're going to go right back on a break. Losers. Okay. So 8 minutes to the close. Qs are slipping. We've got a few things to cover. I want to talk about the Sachs piece. We have the mold piece. I don't think the Warsh piece is pretty generic. That's this. I don't know that there's much else here. This we've kind of already covered. Market is still pricing in. Market pricing is still very much in the balance. Futures pricing in 39% hike. Nvidia earnings have been a big macro event in their own right, with reactions on par with jobs reports and CPI. Wow, that's an interesting comparison to make. But in most recent quarters, the positive earnings surprises haven't been as big as we saw in 23-24. After each of the last 4 Nvidia earnings, Nvidia price actually fell the next day. And then, of course, we had the price hike reporting this weekend. Okay. The lack of any U.S.-Iran talks mean oil prices keep moving higher. Yeah. Leading to fresh concerns about inflation. Yep. That's fair. Just never-ending shocks. A bit of risk on tone. Friday after the flash PMIs, those were good. We covered those in detail. Those were better than expected, especially with employment. Kevin, what do you think about healthcare maybe being the next catalyst for the leg up in the market during AI robotics? I don't know. That's the issue that I have with healthcare, because that's one of the 3 things that could really move you up. You could move up on healthcare. You could move up on robotics. You could move up on AGI. But the big issue is, are these healthcare companies using open weights? Are they using the latest and greatest frontier models? What's actually needed to run the computations they're making? And that part's unclear. Because I think Moderna, for example, uses some of their own proprietary algorithms and weights and data with AI. Let's find out. Moderna use. Let's just see here. So here is a page from them. Just like the introduction of the personal computer, AI is on the way to transforming everyday lives. I agree, it's going to be huge in healthcare. 90% of technology executives agree that AI is the center of the next. Only 10% of AI projects make it into production. At Moderna, we're committed to not only changing this narrative, but leading by example. Earlier this month, we hosted our Investor Day, uniquely positioned with AI. Library of data, biggest asset as a digital-first biotech company, blah, blah, blah. I don't know if they're going to tell us. AI Academy. We developed MChat, Moderna's own generative AI product. After only 2 weeks of development, what? We launched MChat in May of 23. That's actually fast, though. They launched that really fast. They probably just plugged into GPT and just wrapped it up. But that's not the interesting part. What's with the double space right here? I don't know, it looks like a double space. AI Academy for their employees. Okay, I don't really care about that. Oh, and then page not found. Are you freaking kidding me? Digital investor event presentation. Moderna. Science Day, oncology. Oh, they have a lot of meetings. Wow, they have a lot of meetings. Conference call. Transcript. Let's pull the conference call. Let's see what they actually say. AI. Oh. We're using artificial intelligence to try to develop the next algorithm. That's what I'm talking about. That's exactly what my expectation was, but it's like, what are you using? Are you using the open weights or what? Okay, so open. See, the word open weight doesn't come up. What about model? Doesn't come up either. LLM, that's just enrollment. Chat, OpenAI, Anthropic, AI. AI would be the only other thing to look at, but unfortunately you get a lot of intro word stuff here. Yeah. Waiting on the data. Ah, that's unfortunate. All right, well, so that's the question. It's like, if they don't need the frontier level stuff, then that slows down that catalyst thesis. All right, I'm gonna hit the restroom really quick, and we'll get the bell, and then we'll do some summaries.
The rates story is just from the U.S. It's global, so there's definitely some momentum there. But overall, I think the earnings picture is constructive. That has us very optimistic, and we are overweight to equities in client portfolios.
You are overweight equities. You suggest to stay overweight with a focus on large and small caps. Small caps, so, okay, that when you said you expect the Fed to cut, I was like, okay, that's probably why she's picking small caps. But right in the here and now, if rates are elevated, isn't that a problem?
It is, yeah, and I do think a lot of the bad news is priced in on the rates picture. If you think about where it's coming from, it's not really being driven by inflation. There's a number of other factors, whether it's AI-related debt or U.S. funding pressures, as well as just general uncertainty around the Fed and the Treasury policy. So I think the balance of risks is probably more to the downside for rates from here, and that would be constructive. But even if the Fed cuts, if the long end stays elevated, you're absolutely right. That's continued pressure on parts of the economy as well as small caps. So we really do need to see that long end move lower as well.
All right, Megan, we'll talk to you soon. Thanks for being with us. That's Megan Shu. We're counting down to the finish today. Looks like the Dow's going to hang on to its green territory, but the other parts of this market today are going to go out in the red. Again, this is going to be a really critical week. Ramps up to Wednesday, the first stop. And then we finish on Friday with Chair Warsh and his highly anticipated speech. And who knows what happens with interest rates between here and then.
Oh, just in time.
The bell's bringing an end to the trading day at the NYSE Community Financial System ringing the bell, and at the NASDAQ Investor Holding doing the honors. Welcome to Closing Bell Overtime live from Studio B at the NASDAQ.
Very cool. Okay, so that's it. How do we end up closing? And then let's do a little a bit of looking at some of these core things here. So, we got... Oh! Brent actually came down to 92. Well, that's good. Probably because the sanctions war that we're now, you know, imposing on Iran is a giant nothing burger. It's pretty bad. In the sense that it's a nothing burger. And the economic D-Day was a nothing burger, which is just a little embarrassing. But let's go look at this. Then we got, so negative 2.5 on Brent. Bonds 4.7. Qs were down 77 bips. So not like, I mean, from market open, we went down. We didn't go down a lot much more. You know, obviously a lot of volatility in the day, but could have been worse. So that's good. Okay. Let's see here. All right. I think that's... Is it? No? Still... The feed is just a little bumpy right now. Let me try this really quick. It shouldn't kill my mic. Let me try this. Okay, yeah, it should still be good. So now that's gonna reload. Perfect. Let's try that. It's always interesting to see why chips on computers start having little issues. Tech support! More tech support! Okay. All right, we'll see. So let's see how else other things closed. Qs. Oh well, here it indicates a whole percent. Oh, so it did actually fall more because on CNBC it indicated just 77, which was just a little bit more of a decline. But the Qs here are down a whole percent. Palantir down 225. CRM back. Oh, look at that rejection. Wow, that's clean. That's a clean reject. Down to 209. $80 on Netflix. Intuit earnings tomorrow. Salesforce and Nvidia in 2 days. Those will be really fun to see. So we'll see how that evolves. Okay. Well, let me listen then for a moment while I fix this, and then we'll do some summaries.
Segment up, and I think that's the concern going into a market where perhaps yields are, continuously staying high. This weighs heavily on the growth sector, like these chip names, not Nvidia per se, but I think that has a lot to do with it. The fact that there's really no major catalyst for this entire group in the next 4 to 5 weeks.
Right. Yeah, we've gotten all the earnings, therefore we know what all the capex budgets are.
Exactly, except for Nvidia,
not
right?
Too clear. Right. It's not too clear what the incremental fresh news is going to be. We will look out for it. Christina, thank you.
Thanks.
Well, Treasury Secretary Scott Bessent speaking earlier as the U.S. issues new sanctions on Iran and countries who trade with Iran. Eamon Javers was at the news conference announcing those sanctions, and he joins us now. Eamon.
Mike, the Treasury Secretary stopped short of issuing massive new secondary sanctions on Iran's trading partners, saying he didn't want to rattle the global economy. Here's the Treasury Secretary earlier today explaining why they didn't decide to pull the trigger on this today.
Don't want to cause a crisis.
We believe that a warning shot and a level set of expectations is appropriate. And if people do not want to meet our expectations, then we expect, and they should expect, that they will leave the dollar system.
So what Treasury did today,
they
Mike,
didn't play the clip I was hoping they'd play. I was hoping they were going to play the clip where they're like, oh, well, we don't want to cause the whole global economy to have a problem. That was pretty much what their argument was. So not ideal. Okay. All right. Let's look at a couple things. So the first thing is let's pull up. I think we'll do the Sachs piece, and that has to do with our spreadsheet. And we'll look at the relevant clips, about 6 minutes of that. And I can also pull, there is a tweet thread that I can pull up that I replied to, so that'll be useful. So we'll get that. Okay. Then we've got the housing summary, which I think there'll be some good takeaways there. Yeah. All right, good. So let's do it. Let's hit those 2 topics. All right. Well, folks, I have found the face of transparency, the face that tells us exactly how to monitor for the end of the AI bubble, the popping of the bubble, the implosion. And it is eerily similar to what we've been talking about on the channel. We'll go through where we agree and we disagree, but some of the things you hear here are going to be very similar. But first, let me show you the face of who's going to tell us what to look for the end of the AI bubble. There it is, if it is himself, Mr. Sachs. So Mr. Sachs goes through in this pod from about 9 days ago, broke this down, and we're going to go through and analyze some of the key components of just the AI bubble narrative. And when they're looking for what the turning point is. Again, very similar to what we've been talking about here. But a fatal flaw as well in some of their analysis. That's a big one, because a lot of this comes down to assumptions around numbers. And if you got a fatal flaw in some of the numbers, then the entire analysis or the sort of likelihood of something imploding becomes a little problematic. So let's talk about some of those numbers first. The most important fatal flaw comes, and then we're going to go through what to look for and all that. The most important fatal flaw comes when we talk about data center compute and how much we could actually earn from data centers. The current expectation is that a company like SpaceX might be able to charge somewhere around, maybe call it $30 to $50 billion per gigawatt. And the reason for that is companies like Anthropic might be able to earn $100 billion per gigawatt. That's sort of the idea that, oh, okay, we're going to be able to pull off these incredible rental rates. And that is a foundational thesis to thinking, oh, well, this is a sustainable expansion. Okay, but that also tells us where the turning point in the bubble is. So let's analyze what we have right now for Anthropic's ability to pay $30 to $50 billion per gigawatt. This is an approximation of what we have now. The annual recurring revenue for Anthropic as of a 1-month data point annualized out after the release of Claude Code and Cowork is $64 billion. Now, that number was actually recently raised. And so a lot of people look and say, whoa, are we just multiplying by 365 the single last brief period of July and therefore getting to this run rate? Maybe exactly what's happening. This is how it came through the wire service. Anthropic revenue run rate hit $65 billion by the end of July, according to Bloomberg. This would really only take 1 day, and then you analyze it out. So we're not sure, because that's substantially higher than the about $46 billion run rate that was reported literally 2 days before this. So it's almost like there's some IPO sales pitching going on. Bloomberg reported annual recurring revenue at $11.5 billion per quarter ending in June, so that's the second quarter, but the first month of the third quarter apparently ended at $65 billion ARR for Anthropic. Now, why is that so important? It's so important because if you assume that right now Anthropic has built out about 1 to 2 or has access leased or otherwise to 1 to 2 gigawatts of compute, then we can actually calculate how much money they're making per gigawatt of compute. at least through an approximation. If they are making $64 billion of annual recurring revenue, and they currently have 1 to 2 gigawatts of compute, then they are making somewhere between $32 to $64 billion per gigawatt. This is simply the best case scenario. We assume they're making 64 off of 1 gigawatt. Or worst case scenario, they're making $64 billion off of 2, which would be somewhere between $64 to $32 billion per gigawatt of compute. If you take the midpoint, you get to about $42 billion of revenue. Now, why does it matter? It matters because Elon Musk tells us that the revenue that we're going to make for these data centers is going to be somewhere in the neighborhood of $30 to $50 billion. But in order for $30 to $50 billion to be sustainable, we would need, if our cost, is $30 to $50 billion, and that's our cost, then we would need what currently people expect, somewhere around $100 billion per year in annual recurring revenue to actually be able to pay just the compute cost of goods sold. And then, of course, you have training costs, your SG&A, your research, whatever. All the other costs, taxes, you name it, to actually create a profitable enterprise. So this would be totally fine. You spend 30 to 50% on costs on compute, that could be reasonable. There could still be plenty of money left over. But the problem is, this is not what we're seeing in the data right now. What we're seeing in the data right now is that the revenue we're making is somewhere between $32 to $64 billion, with a midpoint at about $42 billion at Anthropic. The issue is this comes right after the explosion of co-work. So how much of this is sort of peak Anthropic enthusiasm? And these are the numbers we're getting at peak Anthropic enthusiasm. So obviously, anything that would keep us indicating that we could get $100 billion per gigawatt of compute would be very bullish, right? 100 billion ARR, very bullish per gigawatt. Elon says 30 to 50 billion is what we want to charge at SpaceX. That gets our cost to build down to maybe a 1-year payback. That'd be great. I can build a gigawatt of compute for $50 billion and I can earn that back in 1 year. Let's all go build compute. The neutral to bearish expectation is that we're going to be closer to $8 to $14 billion per gigawatt of revenue. That's not great, because if you're building out data centers on the basis of $30 to $50 billion per gigawatt and you're only earning 8 to 14, obviously that would be neutral to bearish. And of course, if we go into an oversupplied territory, then returns would be even worse. And that's where things get really interesting about the David Sachs piece. So let's go ahead and pull up the David Sachs video. And we're just going to play about a 6-minute component here. Obviously, I'll jump in and comment on it. But David Sachs is first asked, hey, like, what would be bad? Like, what would the turning point be for AI? So let's get into that.
Slow and steady mystery stock popping to.
Oh, I played the wrong audio. Loser. Okay, let's try that again. Here we go.
So we're steel manning.
The biggest risk is not on the demand side. The biggest risk is that you get a glut of compute and you get an overbuild. And in the same way that we had dark fiber after the dot-com crash, if you had dark GPUs, that'd be a disaster for everyone, especially if you built out your compute infrastructure expecting a spot price of $30 to $50 a watt.
There it is.
As Elon said that they were expecting, right? So if all of a sudden,
so think about that clearly for a moment. If everybody, and this is exactly what we've been talking about on the channel. Sometimes I almost wonder if David Sachs, and if he does fine, that'd be great. Are you watching our stuff? But I want to see, because there's still the mistake that comes up and in their expectation of why maybe there's not a concern here. But think about that. If everybody's building thinking we're going to make $30 to $50 billion a gigawatt, and you don't because there's an overbuild, then you've got a big poopy doopy. Let's keep listening and you'll hear that.
There are too many people racing to provide this compute, and now there's an oversupply and the market crashes. That'd be the risk factor. In a weird way, all the political headwinds, I think, insure against that outcome. Because it is so hard to build data centers for all the reasons we said. There's a whole moral panic / hysteria / hoax going on that actually.
So one of the problems I find, and this isn't my core issue with Sachs here, but one of the issues that I find with this is Sachs suggests, possibly from a political lens, because it's obviously, Sachs worked for the Trump administration as a crypto czar, helped Donald Trump get elected, really aligned with the administration. It is, of course, very popular to argue that the very thing that you're harping on all the time, like, yeah, AI growth, everything. It's really easy to say. The irony is the craziness of the radical left is actually our hedge for our AI data centers. So in like a weird way, David Sachs is telling you, hey, the crazy liberals are protecting my investments. So it's almost like David Sachs should be thanking the crazy liberals by his argumentation. I personally get it. I get why there are these arguments about these, political headwinds and wanting to deter data center building because of alleged water use or energy use, and it's going to increase the price of electricity or this, that, or whatever. A lot of these allegations, a lot of them, extreme or inaccurate. You've even got now the governor of Texas, who has been historically very friendly towards the expansion of data centers, now wanting to audit every single data center before they give a single new permit. In my opinion, some of that pushback is suggesting that that's your best hedge against an overbuild is a little overblown. These things are going to get built somewhere and one way or another. So would I hang my hat on, oh yeah, as Sachs would say, the radical left is going to hedge my bets? Would I make that bet? No. I would not call that my put option. I would not call the radical left, again, their air quote, my put option.
It's those political headwinds, I think, will almost guarantee that there's not an oversupply relative to...
Almost guarantee is way too confident.
...the exponentially growing demand. So in a weird way...
It's also not exponentially growing. And that's another mistake. So let's be clear, like, he sounds really good. And I respect Sachs for what he's done and what he does. All this sounds really good. But see how quickly we gloss over these things. I mean, he says 3 words. I got to freaking pause it and explain. Token generation, when you look at the Google I.O. event, has already turned negative on the second derivative. Now, part of that is law of large numbers, but if you're already going negative on the second derivative already, and we're supposedly early, then you're no longer exponential. You can't have a negative second derivative and call it exponential. What is a negative second derivative? It's a really positive second derivative is the rate of change is getting faster. When the second derivative, so the rate of the growth, how much that growth rate is changing, turns negative, it means you're still growing. So the first derivative is positive, but you're growing slower. So it's still going up. It's just going up in a more flat way, right? So you can't just say, oh, it's going exponentially.
You're protected against that. But Jake, could I shift gears for a second?
Absolutely.
To tell you what's so brilliant about what Jensen did here.
There's one part. There's one other part. In return for that, they get a revenue share above that floor.
Who gets the revenue share above the floor?
This is, by the way, now a little bit of a tangential discussion on NVIDIA. We'll listen to part of it, and we'll keep getting, in about 1 minute, we'll hit a little bit on the payback periods, and then we'll get on to the actual signal for the artificial intelligence.
NVIDIA.
Yeah.
So I think the way I think the deals will work is, hey, we're willing to guarantee offtake at, nowhere near $30 or $50 a watt. We're willing to guarantee.
I'm going to fast forward this. Gavin basically suggests that NVIDIA is giving a 25% residual value guarantee to some of their customers, which has been publicized, and that there's an opportunity for them to potentially take, some revenue share if revenue is above a certain level. Basically, a way of continuing this circular financing to make sure that cloud companies like, Nebius or otherwise can continue to expand their build-outs, and in other words, buy more NVIDIA chips. It's a little funny when we get into this circular financing, but let's listen to Sachs's reply.
That the TAM is getting constrained by the ability to finance this build-out. And what he's doing is alleviating that finance constraint so that he can grow as big as the TAM actually is, right? It's removing that constraint. So just to take one example, Elon wants to add somewhere around 6 to 8 gigawatts next year. We know that would cost $300 to $400 billion of CapEx.
Remember what I wrote on my SpaceX documents. On the SpaceX documents, when the earnings came out, I said, on the filing, they're going to have to come up with about $414 billion of extra debt. and their preference is debt over stock issuance, which is good and bad, there you go. It's the same number. It's no secret. We're all seeing the same stuff. It's just how we essentially draw conclusions from that information. Like, that's a lot of debt. That still needs to be sucked out of somewhere. And we saw last time we had a suckening. It was June. It led to the Leo fold in July. All right.
The company just raised $100 billion in its equity and debt offerings. So obviously they would have to go out and finance that somehow. And as we talked about on our previous episode, the simplest way to finance it would be to get seller financing from NVIDIA, especially given that the payback period could be as quick as 1 year.
Could be. See a lot of the assumptions that have been layered in here, okay? Politics will stop overbuilding, token growth is exponential, and the payback period could be as low as 1 year. Those are huge assumptions. And, the payback period is related to that $30 to $50 billion of revenue that Elon wants to pick up from compute. Maybe it'll happen, but look at the assumptions that are built in. And when you see the assumptions, then you can kind of make the determination like, okay, are we getting closer to, the toppy doodla? They actually, Sachs comes up with a very similar thing that I've been harping on for a while in terms of the potential top and how to measure it. And it comes after 3 minutes of yapping from Gavin and the others. And it is right at 109. I'll play from about here.
Yes.
If Anthropic slams on the brakes, there'll be a pileup of companies behind it, because Anthropic, they're making 100 billion per gigawatt.
No, they're not. Okay, again, this is where David Sachs reads the crap on X, and I don't think he's putting his critical thinking hat on. I think he's scrolling on X too much. They're not making $100 billion of ARR. Right now, annualizing out the last day of July, they're at 65, supposedly. Okay, we don't know if that's just because of the co-work explosion. We don't know if that's going to last, if that's going to get whittled away by open weight models. We don't know. But David Sachs here just literally told you they're making $100 billion. That's enough to pay Elon's 30 to 50. But they're not. They're making, on 1 or 2 gigawatts of compute, they're making about 64, 65. Now, what's the problem with that? Well, the problem with that is they have massive compute coming online. What I also wrote over here that I didn't talk about yet is they have 5 gigawatts coming from Amazon and another 5 gigawatts coming from Google and Broadcom. Now, not all of those 10 gigawatts will get built, but even if half of this gets built, that's another 5 gigawatts, which is 2.5 to 5 times as much power as they have now. So is their revenue going to be able to scale to keep making what they're making now this many more times over? Well, according to David Sachs, demand is exponential. So in that case, sure, why not? But that's not what we're seeing. We're not seeing exponential demand. We're seeing declining second derivatives on token usage. They're still really big numbers, but that's a concern.
Okay, if compute, that's why they're able to pay SpaceX, say, $50 billion a gigawatt.
No, they're losing money. They're not able to. They're losing money.
Spot price for compute. That's why SpaceX is then able to pay $30 billion to NVIDIA for chips for the build out. That's why NVIDIA is able to.
The build out is going to be way more than, and this is the other problem. The numbers compress so much more than what David Sachs is saying. And it's fine. Maybe the exponential ramp will come. But it's not 30 billion that you're putting into the build out. That's the problem. He's telling you, oh, they're making 100 and they're going to spend 50 to Elon and Elon's going to give 30 to Jensen and everybody's going to win. But the reality is Elon's probably spending, 50 for the entire data center, right? We forgot that there are other components to the data center. It's not just the NVIDIA GPUs, it's the CPUs, it's the memory, it's the flash storage, the hard drives, it's the server racks, it's the building or whatever else. 30 billion might very well just be the GPUs, but realistically, that's probably going up to closer to $40 billion on the latest generations of GPUs. Well, then you got all the other crap that goes into the data center as well. And this $100 billion figure is not validated. It's not what reality is right now. The put option of, we'll call it the liberal put, or put liberal. It's probably backwards. And then again, the exponential. we can see there's a lot of sloppiness in this presentation from Sachs. And it's a little disappointing, but whatever.
Pay TSMC and Micron and SK Hynix and all the way down. It's the entire food chain. So if there's like a wobble,
if somebody slams on the brakes,
if the pace car slows down, the whole industry is going to feel it. But it's still better for those numbers to come out on a quarterly basis.
I think it's such
in a vetted, gap compliant way.
So Gavin, as we're sort of saying here, there's a kill switch, there's a brake, whatever you want to call it. Is there enough space? Is there enough distance between the cars
and the people behind it? Blah, blah, blah. Okay, so we've gone through that. The whole point here is Sachs has just given a very clear heads up. And we've talked about this as well, but it's nice to hear it from another point of view. They're calling Anthropic the lead car. And if they slam on the brakes, as seen by quarterly earnings, everything else crashes in. Then, of course, there's this little bit of a debate of like, well, how much lead is there? You know, how much of a heads up or whatever. This is why probably one of the biggest catalysts is not Kevin Warsh. It's not NVIDIA earnings. NVIDIA's gone down 4 out of 4 of their last earnings after earnings, despite beating expectations. It's the S1 that drops for Anthropic. The S1 for Anthropic will be the most critical element of whether or not we are in a bubble and spotting the bubble. And understanding some of these different numbers that I gave here will be really helpful for you to track what's going on. I'm not saying anybody's right or wrong. Well, I guess I kind of am because we're not at a $100 billion run rate, and Sachs, I'll say, mistakenly said that they are. Maybe that's what, you know, FinTwit is projecting by the end of the year. Okay, but that wasn't what was said, but whatever. It's fine. It gives us the tools to look for identifying where we are. Does Anthropic get to $100 billion by the end of the year? How much more compute is coming online relative to how much they have? How are tokenomics improving or disimproving? How are the open weight models affecting Anthropic's ability to raise revenue? Honestly, almost all of this information is going to come to us from Anthropic's public filings. It's even more critical. Well, honestly, the SpaceX filings weren't really critical. We kind of knew that SpaceX was going to lose money hand over fist. Like, it was just a matter of, like, how bad was it going to look? The Anthropic ones are really going to be the first look at a leading frontier lab. That's going to be insane. We'll be covering it a lot, obviously, in the course member live streams and the Alpha Report. Make sure to join us there at meetkevin.com. Use that coupon JHOLE before the Jackson Hole event, and it'll lock in a lifetime access to our Alpha membership, courses on building your wealth, buy-sell alerts. Check it all out over at meetkevin.com. Okay, cool. So that's Sachs. Now, let's do a short little breakdown on the mold. The mold. I think the mold thing is very interesting. Maybe other people don't think it's very interesting. But I think there's some value here. Okay. So all right, let's pop this up. Home inspections on shoddy real estate and construction defects are taking off. And in this video, we're going to break down what this means for you. Should you avoid ever buying real estate? Should you be deathly afraid of mold? What about these TikTok videos of new construction homes getting torn apart by home inspectors? What is actually the bottom line, and how do we learn from this? Let's get into it. First, we have to, of course, start by watching at least 1 or 2 TikToks on this construction defect trend. Let's start with this one right here.
This is America's best builder. This is the builder that makes $40 billion a year. The only thing holding this thing together is gravity. So here we got our connector plates that hold these members together, and, well, that's what I like to call Bluetooth penetration. Builders never were good at penetration.
All right, there are some pretty remarkable lines there about Bluetooth penetration and builders not being good about penetration. One of the first things that you have to know when you watch these videos is that real estate is by definition flawed. You have to know if you own a home, you rent a home, there are gonna be problems. You're gonna have to get problems fixed. And that's what makes inspections really, really important. Now, there are shoddy builders, there are shoddy landlords, and then there are good landlords, and there are good builders. And you could even go to the great level, right? All of them know that real estate is not perfect. The good landlords and the good builders fix the mistakes. And the reality is, this is a $50 problem to fix. Should it be fixed? Absolutely. Should it have been missed? No. Does it happen? Yes. And that's why it's important to get a third-party set of eyes on real estate anytime you buy it, so you could be aware of what you're potentially getting into if you're a buyer, or if you're a builder, you can make sure you don't end up getting TikTok videos like this. In fairness, though, this is not a very expensive fix, which is typically what we find when we talk about home building and home building TikToks in America. I'll give you another example. Here's an example where in the same video, we show the D.R. Horton America's Builder sign in the background and this idea about, oh, they make $40 billion. Well, first of all, they don't. D.R. Horton is expected to make about $32 billion, which means the TikToker himself was off by a factor of 20%, which is pretty much probably how off that framing was. Okay, maybe the framing on that piece was a little more off, but the point is, there are flaws on each side here. It's sort of like, you know, et tu, you know, the logical fallacy of and you. But anyway, it doesn't really matter how much money they make. I want to show this next example, but I will show you how much money they net, because maybe they are starting to cut corners because they don't actually make that much money. A company like D.R. Horton, while they might bring in $32 billion a year, 9.2 per quarter, they're only bringing 13.2% of that down to operating income. And after taxes, they're bringing down less than 10% of the bottom line. That's almost as bad as restaurants. Like Chipotle makes more net income. Cheesecake Factory does not. They don't make a lot of money at all. Their net income's pretty bad. That said, it's not just D.R. Horton. It's Toll Brothers, which has a 3x median home sales price. I want to say D.R. Horton's home sales price on the median level is about $360,000. Toll Brothers is somewhere around $960,000 to $990,000, somewhere around that $1 million range. They're bringing down 13.69% in income from operations, and they're also bringing down a fraction over 10% to the bottom line. So maybe there is an incentive to cut corners, or maybe there's just an incentive not to look. I kind of think there's the reality that 95% of real estate work gets done about 95% completely. That last 5%, nobody really wants to go back and look and make sure it's done. Was the anti-tip bracket on the stove? Did we do all the insulation right? Was every nail put in correctly? And that's why engineers do design homes to where they don't rely on every single screw. There's a lot of redundancy. I'm not making excuses for builders. It should all be fixed. But my point is, a lot of this is serving a different purpose. That post that we saw in the attic, the 2x4, in addition to what we're about to see with the FLIR camera, and I'm going to explain that purpose.
Please go call a roofer, walk your new build roof before that 2-year warranty expires. Let me show you today's roof. Monsoon season is going to cause a lot of roof leaks. So this new build had a ginormous roof leak that had to rip out the walls and ceilings. If you look closely, you can still see the big rectangle patch.
Okay, so basically, what this is marketing for a home inspector. And it is brilliant marketing. First of all, they're showing a FLIR camera where we know a roof leak was patched and there's no insulation. And that's what it looks like. So it's not like the FLIR camera discovered this roof leak. However, it can discover missing insulation and it can discover things. great marketing, though, because most of us don't have a FLIR camera. I do. And I have to say, I have personally found missing insulation in my own home from a 2008 home builder. And I called them before my 10-year warranty was up, and they came back and fixed it. Now, should I had to have deal with that? Should I have had to get a FLIR camera? No. But when we bought the home, we inspected it. I actually inspected it myself and found the issue and called them, and they fixed it. Should the problem have been there? No. Am I trying to defend them? No. But they did come back and fix it, and as somebody who's involved in real estate, I know this is just what real estate is. This was an example where, this is a window right here, this is missing insulation. When you open the drywall here, there was just a whole patch of insulation missing there. So like the heating, because this was in the winter, the heating was just getting sucked out of this room because the insulation was missing. You had this whole hole. It's like a leaky ship, you know? It's like, what is this? Which, that then brings up what's going on with mold claims. This is really common, and then there are also a lot of claims about, well, I mean, they just don't build American real estate like they build in other areas. Let's start with that one. We'll get that out of the way because this is a TikTok compilation. We're going to talk about mold. Okay, take a look at this. So what's actually very interesting about this is this TikTok is American guy in Germany, and this is America versus Germany, and it's sort of a reaction video. So let's just watch part of this, and then we'll explain.
This is the German wall, made out of bricks and plaster. And look at how thick it is. 10 inches thick.
This.
Right. So before we get into the American wall here, let's just be clear about a few things in Germany. It's also born in Germany. Bigger walls, pretty normal. Masonry walls, pretty normal. But the sound on the wall, I could also make on an American wall, depending on where I hit it. And this is one of the tricks that a lot of people don't like talking about because it doesn't make for good TikTok content. It's not the stuff that goes viral for everybody's like, damn home builders are screwing everybody, right? Okay, if I go up to a drywall wall like this, you know, I'm not going to see the stud, the framing members on the inside, but you know, you could hear where the studs are. You could use the stud finder. If I go hit right here, it's going to sound hollow and like crap. If I go hit on the drywall right where the stud is, it's going to sound just as solid as the guy in the German wall video. Now, a lot of German walls are so much thicker because yes, a lot of them are built out of masonry cores, and then they tend to drywall over them because you don't want a plaster wall to go hang your TV on. It's hard to drill into, it's hard to hang pictures into, it's hard to live with a plaster wall. That's why we even stopped doing plaster in like the 1940s in areas where wood frame construction is very normal, like post and beam construction in Southern California, for example. Now, why do we use wood construction in California when they're using masonry construction? All depends on where you are. If you look at construction in South Florida, you will almost always find the first floor of a Southern Florida home, where I also happen to grow up, is cinder block. Iron rebar and filled cinder block. Because you have hurricanes. So you have to be able to withstand hurricane force category 5 winds, plus the tornadoes that could spawn in a hurricane. They tend to spawn, if I remember correctly, in the top left quadrant is usually in a hurricane where the tornadoes tend to spawn. I guess that's where you get the ripe kind of circulation for tornadoes. Stupid little trivia there for you. But anyway, the homes are built for Florida with cinder block. Okay, well, that's American real estate. Well, why don't we build them with cinder block in California? Because we have earthquakes. And cinder block in an earthquake cracks and crumbles. Not ideal. Unless you want to go full steam, full steam ahead on steel then. You can go full steel like you do in a high-rise or a larger commercial building, but now you're paying substantially more and it's unaffordable for a regular homeowner. So what do? Build out of wood. Why? Because wood flexes. In an earthquake, your house can actually move and a drywall might tear, which the drywall actually somewhat acts as a little bit of sheathing. Not much. Plywood typically helps with that. That's much better. Or OBS is commonly used. But wood flexes on purpose in an earthquake so that you have less structural damage in the event of a big earthquake. That's by design. It's also why now we use, Simpson strong ties or frames at the corners of homes to help keep them more stable. I've got one in the studio that I'm filming in right now. It's 2008 construction. It's newer. Unfortunately, that then brings us to this, where, now we're going to show you the American wall, and it just makes for really good TV, but it's really misleading to what's going on. So here's the misleading knock.
An American wall.
Perfectly between the door jamb studs and the corner of the wall. Of course there's no stud there.
It's made out of paper and air.
Yeah, it's actually gypsum. It's drywall. Yes, it's basically paper. But again, we made you the example. The home isn't framed and built up on drywall. It's framed on framing, and that's not what he hit. And that's also not what he does here, which is also misleading.
Exterior walls are made out of the same stuff.
Just a little.
All right. So drove his pen through this foam insulative barrier, avoiding the studs that actually frame the house, and neglecting to mention that this is just an insulative membrane that is placed on the studs, which are the framing of the home, and before the stucco is applied to the home. So you're really like sticking a hole through a skeleton and going, ha, where's your six-pack, bro? You're weak. Like, well, bro, there's no skin, there's no muscle. You haven't put the actual stucco outer layer on yet. So misleading stages of construction. Not fair. All right, that's fine. Enough of the TikTok. Let's now talk about mold and then what to deal with this. So take a look at this. Here's a Wall Street Journal article where mold is driving America's homeowners crazy and they want builders to pay. And basically what's happening is there's a skyrocketing level of litigation against builders for claims of mold in homes. Obviously, water leaks, construction defects, they happen. And there are legitimate lawsuits, and then there are illegitimate lawsuits. We don't really know whose is whose, and ultimately that's up to a jury to decide. But what I tend to find is when markets lose value, litigation claims go up. So you see both a rise in legitimate claims and a rise in illegitimate claims. What we're seeing right now are accrued liabilities at KB Homes, D.R. Horton, and other builders are rising. Much more so at D.R. Horton, but also Toll Brothers is seeing their warranty reserve rise. And the Wall Street Journal is reporting that even Lennar is seeing higher sort of put-asides for litigation expenses or settlement or otherwise. Now, why could that be happening? Well, one of the reasons this could be happening is because some homeowners did unfortunately buy at a not great period of time, in my opinion. For example, the Wall Street Journal shows this individual's home, Ashley Frazier's home. Frazier has spent $75,000 on experts for her mold lawsuit. Now, maybe something really, really bad happened, but this is the sample. Now, that looks like mildew, but understand what this is. This is a vanity cabinet. This is a sink. This could have been something as simple as improper silicone sealing at the top, or who knows, maybe her children were using this cabinet and it all spilled along the back and it wasn't sealed and it dripped into the cabinet and then the mildew grew in here, or the mold, whatever you want to call it, right? This is a problem. But let me tell you this, it's not a $75,000 problem. Just like the stud at the beginning was a $50 problem, that cabinet right here, if that's the extent of the mold issue, which maybe it's much more than that, but if that's the extent of the mildew issue, we're talking about maybe a $600 dual sink vanity and the labor to repair drywall, the plumbing that's causing the issue, demo and reinstall. You're under a $10,000 issue for a bathroom mildew issue. You know, of course, if you got a backing up pipe and that's like a line under the bathroom and you got to jackhammer it up, hey, you know, maybe it turns into a $40,000 issue. But my point is, both of those numbers are still less than $75,000 being spent on experts. And that's because in America, there is a little bit of a litigious lottery hope that you're going to be able to make a massive settlement that'll make that $75,000 investment turn into a massive litigation settlement worth millions of dollars. That's the litigation lottery. That's the hope. But unfortunately, this area where Ashley bought, which apparently she bought in August of 2022, August of 2022 saw home prices at about $253,000. Home prices at the beginning of this year in that area sat at about $230,000, and they've sat at a low of $225,000, and they've now settled at about $249,000. So, in other words, she may have bought close to the high. I mean, if she did indeed close in August, she may have bought essentially at the highest point next to September over here at the entire last 5-year history that we've seen for the real estate market in this particular area of Austin. So is it possible that there was a potential desire to let this mildew issue get out of hand, because you had buyer's remorse because prices went down? Maybe. Or you just either didn't get a purchase inspection or you didn't get your habitability inspections or conduct them yourself regularly. So that's where we get into some of the practical advice for landlords and home buyers and people involved in real estate. Real estate's always going to have defects because just like humans, we screw stuff up, right? And who's building homes? Humans. So things get screwed up in real estate. The difference between a bad landlord and a good landlord, or a good builder and a bad builder, is, are you going to come fix it? Are you going to take responsibility that humans make oopsie doopsies, and do you have enough margin left over because you're not too skimpy and you're actually going to go fix it? I think the good ones will always come fix it. But there's also the question of, do you know? And maybe this is where Ashley in this case is right. Maybe she just had no idea that there was mold. I mean, who checks under these cabinets, which, now mold is being implicated in causing all sorts of mental illnesses or, whatever. But a lot of those are just TikTok allegations. Mold, as of today, is associated with inflammatory style responses that can make asthma worse, but it's not linked to dying or mental illness or some kind of long-term disease. Usually the best thing, and I mean, I'm not a doctor, right? So this is all still to be determined in studies and that. But usually the best thing is if there's mold, stop the mold. Fix the problem. Mold can't grow without a source of water. So solve the source of water. Stop water from getting in there. Get out. If there's mold, don't live there. Okay? Get out. And look for it. You have to look for it to know what's there. So, how do we prevent this? Or deal with this sort of stuff? What can we learn from this in the longer term? Well, my take is the best strategy when it comes to real estate is make sure you inspect your real estate to know what you're getting into. That's the most important thing. Yes, these home inspectors on TikTok are selling home inspections, and they're doing a great job of doing that with repairs that, happen and often are relatively minor. Not always. Some defects are really bad. But the next thing after inspecting, which you should inspect, whether it's new construction or existing construction or whatever, the next thing that, in my opinion, you should do is you should not just rely on that first inspection, you should regularly re-inspect for mold or mildew or any kind of water damage growth. That means checking around toilets, checking behind toilets, checking next to your tub or your shower for water that's coming out, checking around windows, checking under kitchen cabinets, bathroom cabinets, anywhere there could be a source of moisture in your home, behind your water heater, behind your laundry machine. Those are areas that somebody should be looking at every so often. It could even be the pan for your forced air unit in your attic. Is there mold growing in that? What about the condensate line? Very common place to find mold, by the way, in the condensate line. Those lines are really nasty. Anyway, so re-inspecting is effort. And most people don't want to put the effort in. And that's, I think, where sometimes there can be an incentive to let these problems spiral out of control so people can kind of negotiate bigger settlements. Unfortunately, that's just sort of a combination of good TikTok drama, corporate versus, litigant, lottery mentality, and ultimately people kind of letting problems get out of hand by turning a blind eye. Again, either landlord's not inspecting or tenants not caring, which does happen. There are times where tenants will let a problem that they clearly know about get out of hand, which is just as bad. So, as humans, kind of all have to look at the real estate issue and go, we could probably do with less drama on social, but it does make for good entertainment. Just put a little bit more of a realistic hat on when you're thinking about buying or selling or being involved in real estate, and usually it'll end up being all right. All right, cool. What else? Is that it? I think that's it. Let me see if we got anything else here. Let's see. Bessent. No. Yeah, no. Nothing really else. Let me listen in over here from
He said last call that they're planning to return 50% of their cash flow. So I'm not really sure that you're going to get something new on this call. But I think as you go into next year, I think they will set up what their longer term capital return plan is. And I think the fact is that they're the ones making all the money. And so I think that they can stay on a very consistent capital return plan here. They can really jack up the repo. But again, I think that would be more next year than it would be this year.
Right. Yeah, it's very analogous to Apple after the.
We shall see. Okay, what do we got over here?
On smartphones everywhere.
Fine then. All right, that's all I got. Thanks so much for being here. We'll see you in the next one. Goodbye. Good luck. I don't know how to turn this off. Oh, there we go. All right, see you later. Bye.